It's Thursday morning. We have the FTSE 100. Okay, let's talk about the numbers that we are going to see. Here we go. It is time for the opening trade. It is a very limited opening trade. We're going to watch this. We are on tenterhooks. We are anticipating a rise of around 0.6%. It is not materialising yet. I'm not sure I've got much more to say on this subject. In fact, we turn negative. The market, I think, is struggling to find a sense of direction. The estimate is, though, that we are going to see things pushing a little bit higher. Maybe up by 0.6%. Europe is basically closed today. I don't think we're really getting very much sense of direction out of the FTSE 100.
Not as much optimism as perhaps the futures were suggesting. And are the futures really reacting to positivity in the UK, which I feel like is a rarity, or are they following?
It's sunny. Just go with the weather. I think that's
it's sunny
all
outside,
the positivity.
So it's sunny in the markets.
Yeah, people are going to go shopping. Maybe that's a boost for the economy. I can at least point that out.
Is Guy Johnson being bearish or being bullish? That's
about the weather.
It's unrecognizable. I don't even know what to do with it. Let's talk about what's actually moving the FTSE 100 when it comes to the major players. From index contribution perspective, I'm seeing banks from the get-go here. HSBC seems to be one of your biggest contributors this morning. Alongside Rolls-Royce, we did have that number, or I should say the trading update come out earlier as well, with a hodgepodge of metals doing well. And that's my market analysis.
That's a technical term.
Yeah.
Rolls-Royce is doing pretty well, isn't it? 2.6% higher, which on a day where the FTSE is pretty flat isn't bad. And they do seem to be saying that the tariffs are manageable. And if companies come forward with that kind of line, that might be the kind of thing that soothes some nerves, at least in the short term, when it comes to businesses such as Rolls-Royce.
Absolutely. Let's talk a little bit about what is happening in the equity markets, though, around the world, particularly the transatlantic trade. So one of the things that we've been watching very carefully has been the overlay that you see with the foreign exchange story. So let me just give you some numbers. If you are a US investor, so far this year in the DAX, which is closed today, you've made 23%. You've made 25% in the IBEX. Domestic investors have made kind of, let's call them mid-teens in terms of the numbers that we are seeing. The foreign exchange story is having a huge effect on portfolio managers' performance so far this year. That was a subject that we addressed yesterday with Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. This was his take.
I don't think you can overstate the importance of this dollar shift. And you're beginning to see more of a sense that something structural is beginning to change here. For a long time, US investors had no real incentive to put money outside of the US, because if they did so, they'd lose money on the currency. But there was also not much growth to follow. Most of the growth was being generated in the US in mega cap tech. That's shifting.
Peter Oppenheimer speaking yesterday. If you're a US investor, you've made 25% year to date in the IBEX. That's a sensational number. These are the kinds of numbers that have portfolio managers salivating. Can it continue? We've just been hearing Ven talking about the fact that maybe this dollar trade has gone too far and starts to reverse. That will have a big effect in some of these performances.
It absolutely does. You mentioned earlier as well that it's a sunny day in the markets as well. It's a sunny day in London. So what do? We bring in our Uber bear, Sebastian Radler, head of European equity strategy over at Bank of America Global Research, joins us around the table. We planned this. We completely planned this. It's all by design. But talk to us about the currency component here. How do you factor that into your thinking?
Well, it's clearly you said European equities have performed very, very strongly, but now they get a currency headwind that is worth, given the appreciation of the euro that we've seen so far, around 6% off the index. It's around 5 to 6% off earnings. And in fact, over the last 3 weeks...
So you see it's a headwind?
It's a headwind. Yeah, of course. Yeah. If you have a depreciation of the currency, your foreign earnings become more valuable. Now you see earnings downgrades in Europe. You've seen 3 straight weeks of earnings downgrades because you're operating with a less competitive currency.
But sorry to jump in, but if you're a US investor, you're making big gains here. I guess this is going to suck extra capital though in. I appreciate that companies aren't going to be performing as well. Yeah. But from an investment case sitting in the United States, Europe looks more attractive. So do we start to see some of the reversal of the recent run of money into the States, out of the United States and into Europe?
No, but of course, we've seen that already. So you've seen the appreciation of the euro. You've seen strong outperformance. Europe has already outperformed by 15%. So if you want to have further outperformance for Europe, you either have to see basically a strong acceleration in domestic growth momentum, or you have to see your earnings going up. But the stronger your currency becomes, the less competitive your businesses are, and that's effectively how the market is rebalancing. So from a US perspective, the fact that the euro has appreciated has generated strong returns for your European holdings in US dollar terms. But if now the earnings are being downgraded and you potentially no longer get that kind of currency effect, that is a backward-looking story. So the question is, what happens next? What happens to growth momentum? What happens to your earnings? And the big story, of course, of growth momentum is we haven't seen the fallout yet from all the tariffs that we've imposed. We're sitting here holding our breath and see what is that going to do to the global economy. Global growth likely is going to slow, and European companies are now laboring under a more expensive currency. Doesn't sound very attractive to me.
Except that has been the narrative for, to your point, that's driven the fund flows across the Atlantic for the past 3 months. So my question to you now is, what economy in the world is most well-positioned to absorb that volatility? Isn't that ultimately the bull case that investors are making for the United States?
So I think the question is I completely agree with you. Who weathers the shock best? And I agree, it's likely going to be Europe, because the US is having a trade war against the rest of the world, so they're up against an economic entity that's 4 times their size. China, the second biggest bloc, they get most of the tariff hit. They're effectively being embargoed by the US. Europe is relatively more insulated because they get less tariffs, and they effectively only have a trade war with the US. So on a relative basis, you're looking better, but you have already outperformed by 15%. So from our perspective, most of the relative improvement in growth momentum is already in the price.
So where in Europe then, Sebastian, if that's the backdrop, and you continue to sound quite negative on Europe from here then, where is going to be worst hit and where is going to insulate you?
Absolutely. And I want to be very clear, because there are two conversations that are easily mixed. The question is, on the one hand is the relative performance, and on the other hand is the absolute performance. So we are negative on all equities because we think there's now a growth hit coming. And I was just in the US for a week, and we had like 30 meetings, and everybody was holding their breath because you've seen the scary headlines, but you haven't seen the scary macro data yet. And so everybody's now seeing what's the magnitude of that impact. We think ultimately will result in the global PMI declining by 4 points. And what is so exciting about this, we've been sitting here with you waiting for some weakening in the global cycle for 3 years. And there were all these kind of scares, tightening in 2022, SVB collapsing in 23, the wobbles in the labor market in 24. It has come to nothing. The global economy has held up. So this likely is going to be the first real slowdown in 3 years and is not yet discounted in the market. So in absolute terms, we're negative. In relative terms, we're neutral on Europe versus the rest of the world and versus the US. And then what is attractive are the defensives that haven't yet performed. So that the staples, pharma is super interesting. It's a defensive that has underperformed in a risk-off environment. There are special factors which we can discuss. These are defensives that have further to run, and we're very negative on the financials. If you get more growth downside, wider risk premia, lower bond yields, financials look very vulnerable at an 8-year high relative to the market.
You see, that's interesting, because we are sitting here towards the end of a week where we've had quite positive reporting out of financials, and a lot of them have been flattered by volatility that's driven trading revenues in the first quarter, but they've seemed quite insulated from the global growth narrative. But you think that can't continue?
And I think that's the narrative for now, that people are saying, look, the earnings are still strong, valuations are very attractive, balance sheets are very clean. From my perspective, the key feature of the risk-off environment in April and March has been markets have pulled lower, but bond yields have not responded, especially in the US. Bond yields have stayed high. That has protected the financials. And ultimately, the biggest question that we were discussing in the US is, will rates fail to provide a hedge in a risk-off environment? And I'm saying that might be the case for as long as the macro data is still holding up, which is the case now. Once the macro data weakens, especially in the labor market, central banks will turn more dovish, bond yields are going to decline, and financials will look a lot less attractive than they do now.
If the euro keeps appreciating, say we go to 120, So we go to 125. Are we going to be in a situation where the European economy staggers and stalls, and that's bad for European investors, but for US investors, the currency will be a big enough compensation to take out the risk that we are seeing domestically as a result of that stronger euro? Could we find ourselves in a situation where a lot of the big gains we've seen so far this year unwind, but US investors still make money? I'm just curious, all those conversations that you've had with the US investors, what are they thinking about the European market looks like for the rest of this year?
So as I said, we are neutral, but we found a lot of optimism on the relative trade. And I would say the prevailing sentiment that we found in New York is people were enormously bearish on US assets. So the idea of the rise of the US-specific risk premium, which we've seen in the drop in the dollar, the underperformance of treasuries, the underperformance of US stocks, the relative underperformance of US credit, that was a very dominant theme that investors were saying, look, foreigners have been piling into dollar assets for years. Now they've been given very strong reasons not to do so any longer. And so there was a lot of bearishness on US assets. And what we are effectively saying, I'm very happy whenever there's a strong consensus to take the other leg of this. The dollar is already trading at a very large discount relative to its fair value implied by rate differentials because you've done some very unwise policies. If you stop doing that, that discount could very easily stabilize. For treasuries, as I said, they will easily perform once you see the cracks in the labor market. And on the relative performance of European versus US equities in local currency terms, there's a lot of good news priced already into Europe. I agree with you. If they perform in line and the euro appreciates a little bit, then maybe they outperform from a dollar investor perspective. But given how much the dollar has already dropped, I would be very surprised if there's a lot more juice in that particular dynamic.
So let's talk about equities as an asset class as a whole, as opposed to kind of the regional division of it. There's an argument here that equities will continue to rally because there's still excess liquidity in the system, and that's a function of the kind of the post-COVID stimulus, but also American stimulus checks and savings that haven't fully hit the economy and the markets from that perspective. We haven't seen cracks yet, to your point, in the macro data, but also in these markets. Nothing has failed to function yet. Is liquidity enough to keep equities rallying?
Yeah. So I think that's really where the real battle of ideas starts. What is the best framework for thinking about the performance of equities? And whenever we do this exercise, we find the number one driver is global growth momentum. And that is why markets have been strong for 3 years, because we always expected growth momentum to weaken, and it never did. Our economists now in their projections see around 6 points downside for the global PMI. That's roughly global growth on a quarter-on-quarter annualized basis, grinding to zero in the middle of the year. If growth slows, then earnings will be downgraded, and we're starting to see the first signs of that. And it's just never happened that you had a sharp growth slowdown without equities responding. And you say, so the main macro data hasn't cracked. So domestic demand in the US was still strong in Q1. We saw it yesterday. PMIs are still holding up. But look at consumer confidence. It's already consistent with us seeing negative payrolls over the coming months. Look at CapEx intentions. They have collapsed. Look at container traffic out of China into the US. It's down 50 to 60%. The first signs at the very front end of the data curve is starting to show there is a shock coming, and markets are saying, well, we haven't seen it yet, so we're not pricing at risk premia low. Once growth starts to crack in line with these early indications, there's a lot more widening of risk premia to come.
Can I ask you about investments and European companies investing, for example, in the United States? Politically, they might be motivated to come out with lines saying that they're going to invest over in the US, but there's a lot of volatility in policy in the United States. They might not know what they're investing into. We might see a global growth slowdown, as you suggest. How much do you attach to these commitments from European companies? Do you see investment holding up?
Yeah. So I would say for the performance in the we were basically interested in what happens over the next 6 to 9 months. It's not very relevant. It's not going to change the needle. And then if you ask, will the US administration, effectively, are they playing 4D chess? Will they be successful in bringing the companies in? All we're seeing for now on the domestic front is CapEx intentions collapsing because companies are facing very high uncertainty. You say, broadly, the investment climate in the US seems to be deteriorating for now. And so, therefore, we see very little indications that that master plan is effectively playing out successfully.
Great to see you. Always a pleasure. It's nice to get a take on what US investors are feeling as well from a European perspective. Sebastian, nice to see you. Sebastian Rehler, European Equity Strategy Head, Bank of America Global Research. While we've been talking, there's been a few little interesting developments when it comes to what has been going on with the BOJ, which I think is probably worth paying attention to. The line crossed a little while ago, 8:05. Price goal timing delay doesn't mean delay in hikes. I'm just trying to understand exactly what this means, and just trying to get a kind of read on what is happening with the with dollar yen, just to see if there's been any reaction in that. We're still at session highs, so the market is still taking this dovishly. That sounds slightly more hawkish than maybe...
Yeah, I could imagine another time where him saying, it's okay, we're going to stick to the timing of the hikes, regardless of all these other things we're saying about price goals being further out and growth being downgraded. You could see a time when that would have boosted the yen. It's just, this is a market that has convinced itself earlier on today that the BOJ was dovish and seems to have stuck with that view despite that headline. And then it went red and it still didn't do much to move the yen.
It's a credibility story at the end of the day, right? That Governor Ueda is saying, look, we can still be hawkish, we can still raise rates, we can still rebuild that purchasing power for the Japanese yen for consumers. But at the end of the day, if we are making real changes to the growth outlook, there's no believability. I'm having Chair Powell deja vu, honestly.
So if you think about this from a trading point of view, it is logical. Basically, what we've created is uncertainty here. So that I think is what is being priced in the market to the market this morning. He's creating a little bit of ambiguity. We don't really know what the narrative looks like. Maybe this sounds a little bit more hawkish, but the broader tone, to your point, is one of greater uncertainty in terms of the outlook from the BOJ. Are we not going to see rate hikes coming through? I think at the margin, therefore, you've just got to take a little bit out of the trade, and that's exactly what the market is doing this morning.
Yeah, if you were a certain level, at a certain level of certainty beforehand on your rate hike path, then if uncertainty has increased broadly, then maybe you are a little less certain about your rate hikes. But anyway, we'll see. The yen may be turning slightly now, but really not by much, down by 1% against the US dollar. Coming up, rockets, electric cars, and now a new city. Elon Musk's plans in Texas are the subject of today's big take story. We'll cover that and other news flow surrounding Elon Musk. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome back to the opening trade. We are 18 minutes into a much truncated European session in the sense of the number of participants at play here. We only have London for you, basically. Many of the other markets in Europe are closed because it is May Day. We don't get our holiday until next Monday. And with that said, the FTSE isn't giving us very much. The FTSE is entirely flat. Rolls-Royce is in focus, of course, and that is on the upside, up by 3%. Shell and BP, actually, the biggest fallers from a points perspective, and that reflects the weakness we are seeing in the oil price. That was something of a trend of yesterday as well, that weakness of the oil price. So 60, 66 on Brent, now down at 57 on WTI.
So Airbus is not trading today. So we don't have a reaction to what it told us in terms of its Q1 numbers. What it did tell us, what Guillaume Faury, the CEO, did tell us yesterday, basically was that Airbus will not cover the cost of tariffs on planes imported by US airlines. In theory, this is going to set up a clash with the carriers. There is some very creative things going on, and this is a story that we've watched in the past as well. Guillaume Faury is saying that customers are basically it is not, Airbus is not going to pay the tariffs, that customers are going to have to do it. He's saying it's basically on them. I'm not sure this is... So Delta, so Ed Bastian, creative guy, runs Delta. What they do is they fly their aircraft from Toulouse, the delivery centre we just saw there. They fly them to Asia, and then they fly them to the United States.
Yes.
And by flying them to Asia, they become second-hand aeroplanes.
But President Trump will see that. These are big things. It's hard to hide an aircraft. They have caution. I'm just saying that the administration has said, don't try and get creative to get around these tariffs.
I appreciate that, but there is probably some degree of... You need this to happen. There is also a certain pragmatism beginning to creep into the debate as well. So it's going to be, they tried this in the past and it worked. Will it happen again? I think will be something that we will watch very, very carefully. So as a result of which, basically, Faury stuck to guidance for Airbus, which is interesting, but he basically said, I'm excluding tariffs from this. Which, it's like the Volkswagen guidance. I just wonder how useful this really is. Basically, basically what he's saying is we don't know. We don't know what effect this is going to have. He did say it adds to complexity. They're still facing all kinds of supply chain issues as well. They were facing supply chain issues before. That's only going to get worse going forward from here. So there's huge amounts of uncertainty.
I believe we were still dealing with the supply chain issues that were
come from COVID.
From COVID and the pandemic. I mean, that's quite incredible, isn't it? For many sectors, they were back to normal, but for the aviation sector, it seemed difficult to achieve.
I think certain amount of it's COVID, certain amount of it's just engineering issues. The engine manufacturers, particularly for the narrow-body aircraft at Airbus, have had some fairly big issues. CFM and Pratt have both had big issues. So they've been building what they call gliders because they don't have the engines they necessarily need, and they've been pushing them out to customers as well.
Let's take a short trip from Toulouse to Spain, over the border, over the Pyrenees. Chrissy, we had news out of Spanish banking.
We did. We got the approval that BBVA was waiting for when it comes to their unsolicited offer, which is a delicate way of saying hostile takeover for Banco Sabadell. This is a 13 billion euro deal. This is enormous in the kind of background of the banking consolidation we're seeing around Europe. The reason I think this is so important, and this has been a back and forth for about a year now, so a lot of pushback from the Spanish government. We're still waiting to get the full sign-off from the Spanish government, the regulatory authority giving the green light, though. So we're still a little bit about 45, 60 days away from getting kind of the full beginning of this merger. But one of the key remedies of this kind of approval was that some of the bank closures that BBVA wanted to do, is specifically in Catalonia, which is where Banco Sabadell primarily operates, that's where they have to limit some of that. It brings up the question of how much kind of cost savings, which was part of the initial pitch, actually comes to fruition. This is also a company, by the way, because of this domestic consolidation, that if it passes through, there's a question here of whether the sentiment out of Spain can then affect the sentiment across Europe and open the gates to a wave of kind of deal approvals. We saw this with Unicredit and Banco BPM, the golden power out of Italy. But if this comes through, and again, we are still waiting for the others, this would be the largest continental European banking deal since Unicredit's acquisition of HVB. That's a big deal.
But it's a domestic deal.
Sure.
The whole idea of Europe at the moment is that we want to do cross-border deals. Do we want to get a bigger banking union? That we want to get commonality around Europe in terms of the banks and the rules. This speaks against that, not for that.
But if you can't even get a domestic deal, how can you even talk about an intercontinental deal?
But it looks like we are going to get a domestic deal. Isn't this only going to encourage further domestic deals?
Potential. I mean, that is the concern of the Spanish government. That's the critique here, that if you have more consolidation at the end of the day, then they have more control over the consumer lending rates. It's actually ending up painful for the consumer. But this is a left-leaning government that's having that view.
Let's move on to the auto sector, because we have had some news flow flow and some interesting dynamics around Tesla. Let's go there next. Tesla's chair has strongly denied a newspaper report the board was looking to replace CEO Elon Musk, saying directors are, quote, highly confident in his ability. Musk is also the focus of today's Bloomberg Big Take story. So good job we've got Craig Drudell with us, our global autos editor, to delve into all of this. So we saw this story, Craig, overnight from other media, not our reporting, but suggesting that the board was looking at other candidates for Elon Musk. And then we got a really strong denial from Tesla's management saying that that's not true. Where does that leave the management of Tesla, do we think?
I think there's obviously this still raises a lot of questions. I think the Wall Street Journal's report on this was pretty carefully worded in that they acknowledge it was unclear whether this search was ongoing. They worded it in a way to allude to the idea that search firms had been contacted. The board and Musk are saying that they denied this to the Journal before the story was published, and that wasn't included in the story, and are really sort of criticizing it as a result of that. I do think, though, when we sort of take a step back and think about where this company is and just how challenged it is because of what Musk has been doing to the company, you have this real bind where if you take him out of the picture, what does that do to the value of the company, given there's such a huge premium on this stock as a result of his affiliation, and yet it doesn't seem that he's fully engaged. I think even he acknowledged that last week when he talked about my time with Doge is going to significantly reduce, and I'm going to allocate more time to Tesla.
Starbase, Texas. Sounds like, I have to say, it sounds quite cool. Does it come with a big Musk statue? Just talk me through the big take this morning.
You can see, actually, indeed, there is a statue of Musk's face. I'm reminded, a few years back, Musk, on one of his many appearances on Joe Rogan's podcast, he talked about how he was going to sell all of his homes because he referred to them as attack vectors, that, people were going to be critical of him accumulating all this wealth and having these many homes. Apparently, he's less concerned about that now because he now wants to have his own city, his own company town, which is sort of feels like from another time. This is a small village on the very southern tip of Texas called Boca Chica. It's already seen this incredible transformation because SpaceX has just completely transformed it. And what he wants is to be able to launch rocket after rocket in short succession, not really have to answer to anybody in that process. This won't necessarily, remove any regulation or any people telling him what to do, but it will, make things, I think, grease the skids for him.
Craig Drudell, Bloomberg's global auditor, walking us through some of the car stories in the latest 24 hours. Coming up, we're going to dive into the latest out of the BOJ. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Welcome back to the opening trade, 8:30 here in London. And London is pretty much all we've got in terms of the European equity markets this morning. And that's pretty flat. The FTSE 100 is flat. We do have plenty of news flow coming to us, though, from Tokyo. The Japanese markets are open, and Governor Ueda at the BOJ is still busy giving his press conference. Must be coming to a close now. It's been an hour. We did get a red headline. Didn't seem to change the direction of the yen too much, maybe at the margin. But the BOJ's Ueda did say that the price goal timing delay doesn't mean a delay in hikes. So this goes along with the fairly dovish messaging we've had from the BOJ, bringing down their growth forecasts and talking about getting to their price goals a little bit later. So taking out some of the urgency around the hike conversation, you would have thought. But then the other part of that headline saying that doesn't mean that there is going to therefore be a delay in hikes. Well, let's get an expert view on what's going on at the BOJ. Yusuke Miyari joins us, G10 FX strategist from Nomura, and can give us his perspective. Yusuke, very nice to have you with us in studio. So we've seen the yen tracking lower almost continuously since the BOJ statement earlier on, kind of ignoring some of the slightly more hawkish lines coming out of Ueda, maybe. Not that hawkish, perhaps. But what do you take away from the BOJ in its entirety today? Are we still talking about a BOJ that is going to hike from here?
Well, in short, today, Governor Ueda was dovish, but still the path of the rate hike is still to the upside, and BOJ is still maintaining its rate hiking bias. But I think the key point today was that the BOJ has somewhat lost confidence in terms of like when it's going to hike, as well as how high can it's going to hike. So back in March, BOJ was more focused on domestic inflation situation, like food prices, other services inflation. But now it has more importance, placing more importance on international trade policies.
And they're talking about all of the uncertainties that exist in the global economy. And then close to home for Japan, huge uncertainty around the trading relationship with the US, because that trade negotiation is going to restart today. The BOJ can't have much certainty about rate hikes, can they, given all of that?
No, to be honest, Japanese government is still trying to understand what the U.S. Trump administration wants from Japan, and Japan is trying to make some concessions at the trade negotiation deal today. But as you said, as we don't know what the end game will be, BOJ cannot be even more confident before we get some kind of a deal. Governor Ueda has tried to balance his comments by saying that BOJ can hike even though Japan's inflation doesn't reach 2% yet, but still he's less confident than he was in March.
In terms of, so if I take Trump out and tariffs out of the picture, would there have been a BOJ hike this month? Would there have been a BOJ hike next month? Is the underlying disposition of the BOJ at this point to hike? Does it in its bones want to hike at this point?
So if you focus on domestic factors, then it wasn't this time's meeting, but like next meeting or meeting in July was definitely a possibility for the BOJ to hike. Because if you see the services inflation in Japan, especially rent inflation in Tokyo, this has started to rise. And this was so low over the past 30 years or so, but it has started to rise. So price setting mechanism is changing.
Does that translate into... The one thing he's flagging this morning is we're not seeing a big translation into service sector inflation at this point.
Well, I think he's trying to balance the situation. So he's more talking about the outlook route than like what's currently going on. And he's seeing that food inflation will eventually go lower. So there will be a bumpy road in terms of like inflation going to 2%. But he still sees that 2% is happening, and that's a goal.
When you talk about kind of the outside effects that affect the yen specifically, it used to be oil prices. There was such an easy read-through into kind of the import prices that Japan was coming from or was dealing with. Is there a change in kind of what that catalyst or that key driver is in terms of external factors? If not oil, what is it?
Well, it's dollar in general, maybe I would say. So global capital these days are still trying to find where to park their money. Over the past 10 years or even more than 10 years, people were kind of like happy, satisfied with parking their money in the U.S., but now they're thinking about like where to put if this de-dollarization narrative continues to go on. So, you know, oil price is still one factor to consider dollar yen, as well as the BOJ's policy rate forecast, because, you know, BOJ clearly mentioned that oil price lower is one of the factors that lowered their inflation forecast. But other than oil prices, I think what ultimately drives the dollar yen at this point is where the dollar's going.
What is the relative trade, though, when it comes to, we're talking about trade flows, which Anna had mentioned at the beginning, that's part of the fiscal conversation. What is the relative trade between the South Korean won, the Chinese yuan, and the Japanese yen when all three countries are engaged in the United States with trade talks right now?
Well, I would say in terms of like currency, yen is still working as a safe haven currency, and is, you know, along with South Korea, it is still leading in terms of the trade talks with the U.S. So, you know, I think the good example was in 2018 when dollar CNA, dollar CNY went up, but dollar yen eventually went down. And that was when the Fed was, in 2019, the Fed was cutting. That caused the dollar yen to go lower. So I think yen still works as a safe haven currency, and that is some kind of a difference between Korean won and Chinese yuan.
Okay, so the yen as a haven. Talk to me about where, and you touched on this a moment ago about the de-dollarization conversation. What you said in your notes ahead of our chat today that you don't see much Japanese foreign asset selling. Talk us through some of the detail there, because as soon as the dollar dropped quite so much and treasuries looked quite so challenged, a lot of people were saying, you know, will Japan start selling? Will China start selling their holdings of treasuries? What are you seeing?
So in terms of the public data, we aren't, as you said, we aren't seeing any like Japanese investors like massively net selling U.S. treasuries or like foreign assets. I think Japanese investors are still struggling to understand where the currency would go. I think dollar yen at 140 was a key level for Japanese investors. It was about to reach, but when it touches 140, it just rebounds. If it breaches that level, I think Japanese lifers and other investors will start putting on FX hedges. But now that dollar yen is back to 145, if you have a higher return outside Japan, and if the currency's dollar yen is going up, then why invest in Japan? Why not invest in like outside assets? So I think that's kind of like the thinking is happening.
What is your perception from the conversations you have with people in Tokyo about when they think a trade deal with the United States will come? Like, what kind of timeline are we thinking about? You've got various officials in the US talking about or sounding like they think these deals are coming soon. Is that the perception in Tokyo, do you think?
Well, it's kind of tricky. I mean, it could come before the 90-day reprieve, but at the same time, we need to consider about the election in Japan. We have a upper house election in July, and we don't know who's the next government, who's the leader of the Japanese government will be based on, you know, depending on that election situation. So Japan may not want to, like, you know, fully advance its trade negotiation before what's going to happen in the future.
What is the perception of what America wants? So what does a trade deal look like?
Well, what Trump president himself wants is to just reduce the trade deficit between Japan, right? But can it really achieve that goal? It's pretty impossible in this like globalization situation. So I think he wants some kind of a deal that, you know, Japan and U.S. are having like a win-win relationship. So
what does that look like?
Well, one that the market is speculating is about the currency, right? So weaker dollar, stronger yen, or like higher yen rates. That could be one option, but it looks like it's not happening immediately based on the Ministry of Finance comments.
Yes, yeah. What role is the yen going to play in this conversation? Because, yeah, you point out that maybe the trade deal might look like more agricultural imports into Japan from the US, more LNG imports from the US into Japan, maybe some US vehicles. I mean, that's everything I read about that just gets more and more complicated. But what about the role that the yen plays then? Is it still quite difficult to assess?
Well, it's difficult to assess for sure, not just about yen, but like any other currencies. But I think yen, as we discussed here, is likely to work as a safe haven currency.
Yeah, I just mean because the Trump administration has been quite vocal on the weakness of the currency in recent years. And so you imagine that if President Trump is in the room, and he seemed to be for some of these other trade conversations, if he's in the room, surely he will want that to be part of the conversation.
Exactly. But so that's why everyone was like focusing on the BOJ today, but it looks like the governor is dovish. So, you know, even though that kind of the discussion is ongoing in the White House.
This is the really tricky thing. In some ways, if you want a deal, you need a stronger currency. But the governor's not pointing us in that direction. Is the governor is this a problem for getting a deal done? Is what has just happened with the BOJ going to make it even harder to get a deal done with America?
Well, BOJ is a very tricky situation. BOJ's mandate is not to control the currency; it's tries to maintain the price stability, right? So, if the BOJ does it too much, then it could maybe appreciate the currency, but it could deteriorate the economy and prices. So, I think the BOJ trying to balance things and be flexible, can be nimble. So that kind of balanced approach was done today.
Okay. Maybe trying to stay out of things a little bit as well, but maybe not exactly having the effect that was maybe desired by certain others. Yusi Miyari, thank you very much indeed. G10 FX Strategist joining us from Nomura. What are we going to be talking about next? The day is not done. In fact, it's just getting going. Europe's largely asleep, still enjoying the holiday today. Apple and Amazon are going to be reporting results later today. The tech giants responding, of course, to Trump's tariff turbulence. That's all coming up next. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board. I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
This is the opening trade. We only have London trade for you this morning here in Europe. We are flat, basically, on this market. The rest of Europe is closed for a bank holiday. It is the 1st of May. Labor Day in many places. We take ours on Monday, so that's why we're all here. Rolls-Royce is one of the better performing stocks this morning, up by 2.4%. And from a points perspective, that's adding something to the FTSE 100, along with HSBC having another decent day. Shell, BP, those are points-wise drags on the FTSE 100. We see the oil price a little under pressure, now down by more than 1% actually on WTI. So quickly, that's, we've got the London market and we will have US trading later on.
We will have US trading. So
we had Japan.
And we had Japan. Europe is taking a siesta, if we will, today, and I believe tomorrow as well. But don't worry, we've got plenty of US data, as Anna was pointing out, to keep us company. At about 1:30 p.m. UK time, those US jobless claims are going to be hitting the wire. 90 minutes later, ISM manufacturing data coming out of the States as well. But I think the highlight might just be Amazon and Apple. Do they send a different tone than what we got out of Microsoft and Meta? Charlie Wells joins us around the table with all the answers, I imagine. Walk us through it. Or is all the good stuff in the rearview mirror now?
I mean, look, Apple's going to have a difficult day, I think, because there have been a lot of questions about AI. I think we've been talking a lot about trade, but remember, Apple has been struggling with AI. They've had a rejigger inside the company that we've been reporting on. But I also just want to bring up this fact that, Siri was released in 2010. That was 15 years ago. If you have a 15-year-old who can't really talk very well, doesn't really listen, you've got trouble on your hands, and Apple has trouble on their hands.
What's that like, Guy?
Teenage boys, I can say that.
We're quite qualified to talk about that around this desk.
I'm not sure I can blame Siri. I think I can just blame being a teenager for the above. Though it's interesting when teenagers try and talk to AI, that AI slightly struggles to understand them, which I think is fascinating.
You got to get on board with
the slang. They need retraining. Well, precisely. The language is completely different and seems to change on a daily basis.
Yeah.
Okay, let's talk about Amazon. Amazon has a retail story that I think is going to be fascinating to watch out for, because you are going to see a tariff effect. Clearly, we saw all the hullabaloo about kind of whether or not we're going to see tariffs being being put on the prices. What are we going to learn today, and which bit of the business are we going to focus on? Because cloud was good from Microsoft yesterday.
Yeah.
Is it going to be good for Amazon? But do I focus on the retail side?
Well, yeah, I think, Guy, you're getting at this really important point. That's like, yeah, we've been talking about trade, but think about tech, too. Don't forget that's been under pressure. And there are some expectations that cloud growth at Amazon, which is so crucial for their profit, that could slow down. And remember, this is a space cloud. You think it's so futuristic. There's so many opportunities there. It's a maturing market. There's more competitors. We just heard about Microsoft's growth. I mean, this is competitive. This eats into what Amazon is trying to do. And so I think, some of that slowdown could have a negative kind of narrative shift for them.
Can I just say that one thing I think we have missed overnight, actually, is the Qualcomm numbers, which in some ways were quite good, but the stock got bashed on the tariff news, which I think takes us nicely into what we are going to learn tonight. Yesterday, in some ways, you could argue, was the good news from tech. We're going to potentially get some bad news, and I think Qualcomm maybe is a kind of lead indicator on that. Val's here as well to talk us through this. So we've had the good news, and everybody's very happy about the good news. Do we now get the bad news? And is that kind of the next part of this trade?
Yeah, I think that's what investors are asking. This morning, are stocks going to continue this 7-day streak? Are we going to make it 8, perhaps 9? But I think there is risks ahead, as you guys were mentioning. Both these tech earnings tonight, these names have heavy reliance on China. Both Apple and Amazon, supply chain very intertwined with China. Will we maybe walk away with this as seeing more of a warning about tariffs actually hurting these businesses, about struggling, to change their supply chain in the manner that Trump and the speed that Trump wants them to? Are we going to see kind of that negative around that? Remember, we also have ISM manufacturing today expected to fall farther into contraction. These two things combined, I think, might resurface some worries on tariffs amidst this equity market bullish.
Right, so we're waiting for the tech earnings, and as we said, that pivots to a slightly different angle on tech overnight or during today's session. But then thinking about the overall sentiment around trade, Val, this is interesting because I think the market seems a little confused what to make of some of the latest China lines. I mean, just earlier this week, we were hearing from Scott Bessent, who did say the US has put aside China conversations. We're focusing on India and all these other ones, and he name-checked India, suggesting that one could come soon, and we know that Japan is ongoing, of course. Then we get from CCTV in China some statements that the US has reached out to China, and you could say, oh, is that the US blinking? Are we going to see some further turnaround in US trade policy here? But then Jameson Greer, trade representative, saying there's no official talks yet with China. I don't know, all of this doesn't necessarily add to our clarity as to just how quickly we're going to get the two largest economies in the world around a table talking seriously about trade.
Yeah, exactly. But I do think maybe there is a speculation that the Trump administration wants to get all the other countries dealt with, because in some way maybe they want to use those negotiations with other countries in a way to isolate China, and perhaps that's their focus right now. We want to get this done with Japan, we want to get it done with South Korea, get it done with India, so that maybe we can convince them. Maybe that's something they want from these negotiations in order to isolate China alone. So maybe that's the speculation as why they don't want to move too fast. They are not in a rush with these China negotiations because they want to get their allies on their side.
Well, Charlie, marry that China sentiment with what we might get out of the tech space. And you kind of talked about this earlier as well at the wall. Microsoft does have exposure to China. Apple famously has exposure to China. So does Amazon. Is there a China discount for some of these companies?
I would say there's a China disconnect, in that the China story needs more nuance right now. So you think about Amazon reporting later today, it's not just stuff coming out of China that's subject to a lot of uncertainty and turbulence. It's services, right? Amazon has these Chinese retailers who rely on their logistics services, who rely on that high-margin advertising. That's part of the China narrative that needs a reconstruction. And I think if you want to think about Apple, look, there have been reports that they're trying to move a lot of their iPhone production to India, and that's great, right? You want to diversify the supply chain. But remember back in Trump 1.0 when a lot of companies, not just in tech, but across the board, moved to Vietnam, and then they were suddenly shocked about these Vietnam tariffs. So I think just thinking that kind of diversifying out of China is going to be a safe bet, I think that needs a little bit of tires kicked.
Val, in terms of the optimism around all of this, we have seen a rally.
Dent my optimism.
I'm desperately trying to dent your optimism. We're going into May. I have kind of, what are people saying about the seasonality? Normally at this time of the year, you are starting to maybe fade some of the moves that we've seen. Is there a belief that this is just a tactical short-term rally? That this rally that we've seen over the last few days doesn't really signal anything about underlying sentiment? Do I need to separate out positioning at this point from actual kind of views on where ultimately we are going? Is this just a positioning rally?
Well, there is that famous phrase of sell in May and go away, but I would argue May is going to be a pivotal month for where we could possibly see this air pocket of hard data that the U.S. economy might run into. So I do think that maybe seasonalities, if we focus a bit on that, that's really missing the point, that we could be at risk of seeing, the hard data begin to crumble in the next few weeks. Now, I'm not in the case that we are going to see that. I think it might actually be later in the summer, maybe not until June, until we start seeing some real weakening of the labor market. If it was going to come there, it would probably come later. I think that the data yesterday that we saw, the GDP data, the inventories have been buffered. People have front-run these tariffs. It does seem like these corporates are sitting on a lot of inventory that they can weed their way through and maybe push that supply shock afterwards. But all in all, the next few weeks, could be pivotal for the U.S. So in some ways, I think looking at seasonality is kind of missing the point.
Cool.
Absolutely, one that we're going to keep an eye on. I think the sell in May thing is interesting because it's only day one. People sell in May at the end of May after May's had a good month.
Well, April was really long, so we're just bracing for that.
This is true. Charlie Wells, Valerie Teitel walking us through some of the key drivers of this market this morning. But I think, Anna, we have to go back to the geopolitics here, and that, of course, brings us to Ukraine.
Yeah, absolutely. Let's go back to that story because this is something we've watched develop overnight and still leaves the path a little uncertain from here. So let's look ahead. The US and Ukraine have signed a deal over access to the nation's mineral resources. What does this mean for broader peace efforts, though, as they remain elusive? Bloomberg's Greg Sullivan joins us. Let's do some detail on the deal then, Greg. What do we know about what has been signed?
Well, the details of this deal have changed as these contentious negotiations have played out. You'll remember that President Volodymyr Zelensky originally went to Washington to sign the deal, and that was when that disastrous White House encounter occurred. So now we have a deal that has been signed, and it basically gives the U.S. priority access to investment projects in Ukraine in the area of natural resources. We're talking about oil and gas development, potentially minerals like aluminum and graphite, and basically the proceeds from these licenses, the profits would go into a jointly managed reconstruction fund, and the U.S. would have priority access to those profits. Now, the U.S. says that That is because they will pay for future aid to Ukraine. It's worth noting that one thing that was dropped from this agreement was the U.S. insistence that Ukraine pay for past aid that has already been delivered. Another thing that is not in this deal are security guarantees for Ukraine should any final peace deal be reached. And that's been a crucial and key issue in these ongoing talks. Another big question that remains, what kind of military assistance will the U.S. be willing to provide Ukraine going forward? The weapons and ammunition they've come to rely on, the intelligence sharing, that's also not clear coming out of this deal.
That all sounds really important to me. All the things you just laid out sound pretty critical to getting a deal across the line when it comes to a ceasefire. How big is the overlap between what has just been signed and a potential set of ceasefire talks? What is how much of an overlap on the Venn diagram do we see between these two ongoing parallel lines that we are watching so carefully when it comes to ultimately a peace deal being signed in Ukraine?
Well, on the one hand, this definitely allows Kyiv to keep President Donald Trump engaged. There have been real fears that he could pull back. We've heard from senior administration officials that they're ready to walk away. We also know that U.S. proposals have been heavily weighted towards Moscow, favorable towards the Kremlin's position. And in a lot of ways, this is an effort by Ukraine to keep the U.S. and President Donald Trump on their side and make sure that any final deal does not get weighted too heavily towards Moscow. But on the other hand, even with Special Envoy Steve Witkoff having just made his 4th trip to meet with Putin in Moscow last week, there's still no signs of a deal coming out. And in many ways, Russia has actually hardened their position in these negotiations. So the talks do not appear to be making much progress at the moment, but this should provide Kyiv with some assurances that they've at least will be able to keep Donald Trump engaged in the process, given this new deal that he's signed with Ukraine.
Okay, Greg, we're going to leave it there. Great stuff. Thank you very much indeed, Greg Sullivan, updating us on the latest surrounding the deal that has been signed on resources in Ukraine. We now wait and watch and see what happens exactly when it comes to a peace deal. And you wonder whether European equities will get a big boost off that. I was raising that point earlier, because we don't know yet today whether there is some sort of premium that gets attached as a result of this. I would imagine when we do get a deal signed, if we get a deal signed, hopefully we will get a deal signed, that there would be an effect on European equities.
Yes. And
European assets broadly.
And it would be interesting to untangle, expectations for defence as a result of that, because the defence spending is a wider story now than just spending on Ukraine's defence. It's much wider. It reflects the Trump administration's policy towards Europe. So we'll watch to see what happens on that front. So we're not going to get any movement on that today, not from European perspective, European equity markets. We are getting data as the United States. Val nodded to this a little earlier, but worth saying again, we get that ISM manufacturing, which had the prices paid element, which has been ticking up in recent months, hasn't it?
The digestibility of some of these kind of inflationary impulses that you've seen from consumers, but also from corporates in the United States, is the core of the bull case for the U.S. Basically, the folks that are not in Sebastian Radler's camp, they're saying that the people who can weather this are ultimately based in the United States. At least that's one bull case that you're hearing. Plenty of people are saying that about Europe as well. Yep. Do we see that those cracks start to show up in the data? And I think some of the data points today may be early signs of that. That
wraps things up for this show. Enjoy May Day. If you are taking the day off, if you are trading the FTSE 100, it's not doing very much. Maybe you look to the US for a little bit more excitement later on in the session. That wraps up the opening trade. The Pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. U.S. futures rally fueled by better-than-expected big tech earnings as Microsoft and Meta brush off tariff concerns. Well, Tesla denies the report that it was looking for a new chief executive, with the board insisting that it's highly confident in Elon Musk. Plus, days after that Vatican meeting between the U.S. and Ukrainian presidents, well, the two countries signed a deal giving Washington privileged access to Ukraine's natural resources. Now, first thing is first, just a quick reminder that actually most equities across the board are closed in Europe because of a holiday. So let's go to what's happening in the U.S. S&P futures gaining 1%. NASDAQ futures also gaining some 1.8%. We look at euro dollar. There's a bit of movement on yen, and then we go straight to pre-market. I'm looking at the FTSE, which is open. The FTSE actually looks like it's going to continue its winning streak, but not for much longer. We also have quite a lot of earnings that we have to get through. Meta, you can see 6% higher. We'll have a full roundup of some of the tech news, but there was a lot of concern going into them that they'd be hit by tariffs quite hard. A lot of them seems in a better position than we thought just a couple of days ago. Microsoft and Qualcomm also pre-market. Again, today is definitely a tech week, which is why maybe we're seeing a bit of a boost to NASDAQ futures. Microsoft getting some 7.4%. And then let's also get to Qualcomm. Our Charlie Wells will then have a fantastic roundup of some of the things that we're covering. Qualcomm down 5.3%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, earnings beats helped boost Meta and Microsoft. Speaking on an earnings call, the Meta chief executive, Mark Zuckerberg, told investors he's optimistic despite the tariff-induced uncertainty.
We've had a strong start to the year. Our community keeps growing with more than 3.4 billion people now using at least one of our apps each day. Our business is also performing very well. And I think we're well positioned to navigate the macroeconomic uncertainty.
Well, Bloomberg's Charlie Wells is here with an update. So, Charlie, good morning. What bolstered Meta and Microsoft?
Good morning, Francine. So when you break it down, this is about a constructive story that both of these firms were able to tell about AI. So let's start with Meta. So much of the revenue of this company, 98%, comes from advertising. And this is a firm that saw ad growth. And they were able to show how AI is helping the company target and personalize a lot of these ads. So a constructive story that a lot of analysts have been waiting to hear on this AI narrative. If you take a look at Microsoft, very different company, but they were also able to tell a similar story on AI. They saw cloud growth. If you look at that Azure cloud unit, it grew 33% in the quarter. That's a great story, but investors liked even more the fact that the company could say that 16 percentage points of that growth came from AI. Another piece of this story is CapEx. A lot of spending on AI CapEx. That's been a concern in the tech space right now, but Microsoft was able to show that CapEx was trending down in the quarter.
Charlie, you've also seen or heard quite a lot about possible succession at Tesla. What do we know?
We certainly have. So the chair of the board of Tesla has pushed back on a Wall Street Journal report that members of the board had contacted executive search firms to look for a successor to Elon Musk. Succession at Tesla has been hot in the news, with Musk himself saying he will be pulling back from work in the Trump administration to focus more on Tesla. But the board chair said that these rumors were false and that the company has full faith and confidence in Musk.
Charlie, thanks so much. Charlie Wells there with the very latest on some of the tech news. Now we're joined by Seema Shah, Chief Global Strategist at Principal Management, Asset Management, and Jimmy Muchachetre, a Senior Equity Analyst at Investec. So thank you both for joining us. There's a lot to talk about. We're full earnings swing, and there's a lot on tariffs. Seema, when you look at some of the tech earnings, it could have been much worse on tariffs. Is it because it's a little bit too soon, or do we just push it back to, to the fact that tech is easier to navigate than others?
So I think there's a bit of both. I mean, the ones that have actually already released their earnings are the ones which are probably the ones which are less susceptible or vulnerable to the tariffs. You have to keep that in mind. But certainly, it's also pretty early days, just as we're seeing in the hard data, as we've seen across the entire board for earnings. It's still really early for you to see a kind of a clear impact of any economic concerns or political concerns. Now, having said that, though, there is still a really important secular discussion which has been underway. It hasn't really been tested. What's been interesting in the last couple of weeks is that after such a significant re-rating in the tech stocks, there was already growing interest in saying, well, look, we still believe in the long-term discussion. And of course, the earnings releases that we've seen is going to add, reinforce some of that slightly more positive narrative.
Jimmy, what do you see in equities? Again, we're kind of like maybe halfway through, maybe 3/4 of the way through of earnings, and there's been real hits and misses.
Yeah, I think that's the best way of describing it. It has been a mixed reporting season thus far. I mean, it's interesting. When we came into the earnings season, we were saying the number one thing to look out for is guidance. And we've had a wide range of guidance from companies. Some companies have pulled guidance, General Motors, UPS, Coca-Cola, etc. Others have maintained guidance, and some others have even raised guidance. But what we've seen is that many companies are incorporating the impact of tariffs based on what we know today, with the caveat that things might change, and we know that they could change at any point in time.
Yeah, and Stephen, I mean, this goes also through the data that we're expecting this week. I guess if you look at global, market perspective, we may have to wait a little bit longer to have the tariff impact, where there's still a big question mark, actually filter through the real economy.
Yeah, absolutely. I mean, the hard data has obviously been pretty strong, and the soft data is telling us that there's some weakness coming. I think what's interesting, though, is that there's a lot of uncertainty, which of course is weighing on people, on companies' plans, and you can see that with they may be freezing hiring, but they're not going the whole length to actually moving to firing. It's because they don't know what still stands. The risk is that the longer this uncertainty extends for, then you actually accelerate the impact. Now, from our perspective, we are thinking that actually the hard data doesn't weaken maybe until you're late into Q3. There is that growing feeling. So it could be some time before we actually see some clear evidence of what tariffs are really doing to the real economy.
Okay, this is Donald Trump actually speaking on GDP.
Core GDP, and this is, you probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump, because we came in on January, this is the quarterly numbers. Let's give us a pass on the first month. We were sort of getting a little bit used to things.
I mean, talking about core GDP sounds like a Bloomberg professional. I mean, but the U.S. recession odds have spiked, Seema.
They have spiked, and it's interesting that he talked about the Biden economy. Actually, he's got a pass on that, because it was all about the pull forward of importing tariffs, which actually pushed down the GDP, and actually consumer spending was fairly strong. But absolutely, recession odds have spiked. From our baseline perspective, we think that the U.S. economy could skirt recession. The reason we think that is because balance sheets across households, corporates have been very strong. And the hard data has been telling us that actually in Q1, fundamentally, the U.S. is pretty strong. But everything depends on policy. If it's a recession, it's going to be a policy-led recession, nothing beyond that.
Yeah, and this you can also see, Jimmy, in a lot of the guidance from companies. I guess if there's not a step back in tariffs, then they're going to have a lot of struggles in terms of guidance, but also keeping margins, and you've seen a hit in CapEx.
Yes, 100%. I think what you've seen is, as Sima has just said, if you look at the latest Atlanta GDP now, estimate is 2.4% as of yesterday. So it's not going to be an impact in the near term. But what we are seeing is that companies that are really strong in terms of pricing power, intangible assets, they are able to ride through the tariffs much better. So it'll be interesting to hear tonight when the more hardware-related names, such as Apple and Amazon report what they say, because Microsoft, Google, and Meta, they don't sell much in terms of hardware.
Jimmy, what's been priced in actually in the markets? Because there's been huge moves, but they're pretty much flatlining. And I don't know whether that's on hope that tariffs will be taken out, or whether there's just hope on AI and that revolution, or what are they thinking?
I think it's a little bit of both. I think a lot has been priced in. That's why we've seen huge moves to the downside and huge moves back up. But what we are seeing is that the shock factor is lessening over time, right? So if we have announcement of even more tariffs on China, that's going to have a much lesser impact on the market as we go forward. But the earnings season has been good in terms of calming down some of the markets and saying companies are putting in place strategies to deal with the tariff impact. So the companies I cover, for example, a lot of them have said, we think the tariff impact at current 10% is going to be X million or billion, but we are doing these cost containment programs, we're shifting manufacturing here, we're doing some things to kind of flex our cost structure to be able to absorb that impact. And the best ones have been able to increase prices, the Hermeses of this world, the Louis Vuittons of this world.
So, Sima, across some of the equity markets, is the U.S. the most challenged, full stop?
Yes, I think it is potentially the most challenged. We're still yet to hear about growth-friendly measures coming through, whereas, of course, in Europe, we've already heard the good news. So, in a way, there's still some upside to come for the U.S., but particularly from an economic perspective, when we're looking across the numbers, with the exception of Mexico and Canada, the U.S. is the one that it could have a very, very significant economic growth hit. But it all depends on the trade negotiations with China. Europe, India, they help at the margin, but the really important one is going to be what they do with China.
Yeah, and Jimmy, again, to that point, you're kind of breaking it down sector-wise, right? So it's the ones that have pricing power, the ones that don't. Who are you most worried about sector-wise at the moment?
Oh, the ones that are exporters, those are the big ones that will be impacted by trade tariffs. And the ones with the lowest gross margins, So retailers will be very, very impacted, for example. But, this is, speaking to what Sima has just been saying, the U.S. is what's called the VUCA economy. So a lot of volatility, uncertainty, complexity, and ambiguity. And everyone is kind of in a pause right now during that 90-day period to see what deals happen. Yesterday we had reports that the European Union is approaching the U.S. with some remedies, and maybe that will get the ball rolling. But certainly in terms of many companies, they are in this pause period where they want to see where the ball is going to fall before they make any decisions that they can't reverse.
What do I do with healthcare? And then we'll talk about the Fed.
Yeah, healthcare is a beneficiary of that VUCA economy. It's a place where companies can hide. In fact, if you look at the reporting season so far, top of the pops is healthcare in terms of earnings growth. And in terms of guidance, we've had, again, a mixture. Some companies have cut guidance, some have adjusted guidance, and some have even increased guidance. But you look at Novartis, AstraZeneca earlier on this week, very, very strong guidance being given there. Boston Scientific, Intuitive Surgical. So the companies where they've got a lot of innovation coming through, they continue to retain that pricing power, which helps them push through this period.
And Sima, so if the consumer in the U.S. actually starts getting hit like third quarter, around maybe the end of the third quarter, does the Fed wait until then to start cutting interest rates?
I think, unfortunately, they do. They're in a tough spot at the moment. So just as we're all struggling with all the uncertainty of not knowing exactly what the next headline is going to be, that's the same for the Fed. And at a time when the hard data is still fairly strong, and you have inflation above target, there's such potential for a policy misstep that they have to tread really carefully. So I think that they need to see the data start to weakening. Obviously, tomorrow's payroll report is going to be particularly important. It's a random number generator sometimes, but hopefully will give us some inkling. From our perspective, we had been initially expecting the Fed to start cutting rates in June. But the strength of the economic data probably means that you're looking into Q3. And then, of course, the later that they leave it, the chances are that they'll have to do more aggressive moves. So I think a lot of stuff is still in flux. 4 cuts, it's possible. But it really now depends on what timing is, and the market is going to respond to that too.
Yeah, and what do you do with fixed income? Again, it's been behaving, differently, I would say, maybe in the last 5 to 6 weeks.
Very, very differently. I mean, so much volatility, and the narrative keeps shifting. From our perspective, short duration fixed income is probably your safest area to be sitting. We are expecting the Fed to cut rates, so there will be some, at worst, it's going to be pinned where it is. And not much upward movement. The long end is really where the concerns, I think, are likely to persist. Concerns around the debt numbers, the discussion around Fed independence has gone for now, but I can expect that if next week the Fed doesn't cut, as we expect, there could be an opening for some more criticism. And that volatility, I think, is still going to play out on that long end.
Yeah, and Jimmy, I guess there's just a lot of consideration, right, for investors to take in line. Right now, I don't know whether you worry about liquidity or some of just the market functioning and what clients should be doing right now.
Yeah, I mean, in terms of the market functioning, I think the market has functioned really well during all this period of volatility. We haven't had any stop calls and any dislocations coming to the fore. But in terms of what investors can do and what we are doing, our watchword right now is risk management, right? And that comes in many different shapes and forms. But generally speaking, holding strategic cash reserves, not as much as the famed emerging market investor Mark Mobius at 95% in cash, but holding some strategic cash reserve to be able to take advantage of some of those big market moves down, but also being more diversified, whether across sector, geography, or even within companies as well, but also looking at other asset classes. So, we are using our full toolkit to be able to make sure that our investors are protected during this time.
So how again, the difficulty is recalibrating a portfolio with all of the uncertainty. It's not even risks, it's it could really go either way.
It could, and I think the key is that you still need to remain invested, because as we saw, the market can turn on a dime, and you don't want to be caught sitting on the sidelines when the market turns. So it's taking a prudent approach, and we think that this kind of market is where active management really comes to the fore, and that's what we're doing.
Yeah, I mean, I would completely agree. And, you just have to think, all the headlines aside, the market, S&P 500, is only down marginally in the month of April. So, things have been moving quite significantly. So having left the market maybe on Liberation Day would have been a huge mistake. Having said that, the US market, as we said, is particularly vulnerable. You're seeing other countries around the world really thinking about what their economic defenses are. So there is potential to see further upjumps, and we've liked India for a while, and it's great news that they're probably apparently at the top of the list for a trade deal. So looking at other countries outside, we are becoming more optimistic about Europe from a longer-term perspective, certainly even if the short term is still somewhat challenged. And then, to Jimmy's point, having that diversification not just across regions, but across asset classes. There are segments of fixed income, make sure you're up in quality to be the focus given the economic risks. And real assets. I mean, we haven't spoken about inflation, but that doesn't seem like it's a fear that's going to be disappearing anytime soon, at least in the US. Yeah. So, infrastructure, of course, gold, real estate, there are elements of this market that can continue to perform pretty well, even in this kind of backdrop.
Should we worry about stagflation?
We've worried a lot about stagflation. Yeah. I don't think we've really seen it come to the fore. I think many companies are quite resilient and are able to make money whatever the environment is. So, we will get short-term volatility, but over the long term, they will be able to adjust and, continue to play to the environment. One of the things we see is many companies operate, in a decentralized manner, which means that, they're kind of dealing with local and regional problems, which means that they are actually much more agile. And so inflation, it's generally a bad thing. If you look at industrials, which is another sector I cover, inflation is a good thing because it means they can push prices up for their customers and justify it. But when the inflation comes down, they'll just be quiet and just leave those prices there. So, it's something that we think the strongest companies will be able to deal with better and will emerge even stronger.
Okay, thank you both for joining us. Seema Shah, Chief Global Strategist at Principal Asset Management, and Jimmy Mutuchetra, a Senior Equity Analyst at Investec. Now, coming up, after fraught negotiations, the U.S. and Ukraine signed a minerals deal. So we'll have the details next, and this is Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. and Ukraine have signed a deal over access to the nation's natural resources. Kyiv hopes the agreement will secure President Trump's support in ceasefire talks with Russia. Well, let's bring in our EMEA news director, Ross Matheson. Ross, this feels like a big deal, but it also feels a continuation of what we've lived through so far. So what are the details of the deal, and where does this actually leave peace talks with Russia?
Well, it is a slightly revised version of what we've been talking about for some weeks, and this is a special reconstruction investment fund that's jointly managed by Ukraine and the US, but where the US gets basically first claim on any profits that go into this fund, and ostensibly that's to repay the US for any future military contributions that they make to Ukraine. And these will be licenses issued for new projects around critical minerals, oil and gas. Of course, there's a lot we don't know exactly about the resources that Ukraine has, and certainly how proven they are and how accessible they are, but it gives the US an economic stake in Ukraine. And the US would argue that that's a sort of security guarantee of sorts because it involves the US in Ukraine's future, but it's not a hard military guarantee. There's nothing in this that requires the US to come to Ukraine's assistance down the track militarily, and it's very unclear exactly what future US military assistance for Ukraine may look like, if at all. And as you say, while this gives Donald Trump, the US president, something to say he's got in his pocket now as a deal, it doesn't necessarily mean that we're much closer to a ceasefire between Russia and Ukraine. We can see that those talks are quite bogged down in a way, and Russia to some extent is digging in, saying these are our red lines and we're going to stick to them, and being, you know, quite maximalist in their push there. And so this does hopefully bring Ukraine and the US back together after a fraught few months in that relationship. The question is, can you leapfrog off this towards a proper ceasefire, and where are those talks going?
And meanwhile, Ross, Donald Trump also appears to acknowledge the riskiness of his tariff plan. Is that a turning point, or is just, you know, a Trump undeterred but with a bit of realism?
Well, it does seem to be that he recognises there's a bit of a perception issue around his tariffs. Of course, he came in promising the American people he would bring manufacturing back to the US, jobs back to the US. He would make the US economy strong and vibrant again. And, you know, this is the key part of his message to the American people. What seems to have gone a little bit awry for him, of course, is with all this policy changing around tariffs at the last minute, a lack of clarity about implementation, what they actually mean, and the impact on the US consumer, on US companies. That's showing up in sentiment concern in the US economy and in data and in the market. And a sense from Donald Trump that he realizes, first and foremost, perhaps as a CEO type president, he's got to sell his tariffs a bit more to the American people. So the message is, sit tight, it could be a bit bumpy for a bit, but this will in the long term, at least the way that he sees it, fit his goal of making the US economy stronger. So he does seem to recognize that there's been a bit of whiplash for US voters, for the ordinary American in all of this, but he still seems to be determined to push ahead with his tariff policy regardless. And, you know, we're looking to see, does he actually get any trade deals out of this?
Ros, thank you so much. Our EMEA News Director there, Rosalind Matheson. Now, Bloomberg also understands that the EU is planning to share a paper with the U.S. next week to kickstart trade negotiations. Well, Kevin Whitelaw, our Brussels Bureau Chief, joins us. Now, Kevin, first of all, so good to see you in London. Yeah. There's also talk, of course, about a London-European rapprochement, but what actually could be in this proposal between the EU and the U.S.?
Well, you know, the EU has spent a couple of weeks trying to figure out what exactly Trump is even looking for as they try to figure out a way to avoid these tariffs. And so they've come up with what they think is a package of both tariff and non-tariff related proposals that are aimed at easing whatever sort of barriers that may exist between the U.S. and the EU on trade. It's a slightly moving package. We're still trying to figure out the exact shape of it. But the idea is to make an offer. It would include LNG purchases. It would include a handful of other incentives that would be aimed at saying, hey, let's do all these things and let's avoid the worst of this trade war. It's not at all clear that this is what Trump is going to accept, and it's not at all clear it's going to be enough for him. And so at the same time, they're also, you know, preparing and keeping in place these various retaliatory measures that they have. And so there's this 90-day pause we're in the middle of for a set of retaliatory tariffs. There's other steps that the EU can take as they try to, you know, react to it if it doesn't go away. So they're trying to do this two-track approach, hoping that there's going to be a deal, but getting ready if there isn't. And I say that I think we're getting the sense in private that there's increasing concern that the U.S. may be not really interested in making a deal that's going to get rid of the bulk of these tariffs.
Okay, interesting. At the same time, and we heard, I think, the first real speech or interview of Kamala Harris. And what's interesting, we were hearing also Donald Trump earlier talking about core GDP. I mean, he's trying to blame even the market turmoil on the Biden administration, and Kamala Harris is pushing back.
That's right. I mean, you know, she called it a man-made economic crisis, and obviously, you know, a lot of this is about the tariff plan. And so she did lay out that case. We hadn't heard from her for a while, so this was sort of her reemergence on the stage. But somewhat interestingly, she did it in California, not in the East Coast. So she did a pretty late night for the East Coast audience. But there is this talk about her possibly positioning herself for a run for governor in California. And so this seems to be an effort to begin to build out that case.
Kevin, for me, this is the most interesting question because, you know, in corridors of power, basically everyone says, where's the opposition? Where are the Democrats to Donald Trump? I mean, could she be it, or does it have to be someone else?
I mean, I think we're going to see. It's too early to know exactly where it's going to emerge and who's going to emerge, but she's obviously beginning to position herself as part of that, making a case and deciding to go and do it in a way that was at least coherent, but maybe not quite as high profile as you know, she could have possibly chosen. And what was it focused on more California because of her ambitions there, or is she just beginning to sort of road test this message as she tries to figure out how the Democrats can begin to find ways to build the case that they have something positive to offer instead of where Trump is.
Kevin, thank you so much. Kevin Whitelaw there, our Brussels Bureau Chief. Coming up, we talk Tesla and the Chief Executive. This is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss The Close, live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, big tech stocks jump on better-than-expected earnings as Microsoft and Meta brush off tariff concerns. Well, Tesla denies a report that it was looking for a new chief executive, with the board insisting that it's highly confident in Elon Musk. Plus, days after that Vatican meeting between the U.S. and Ukrainian presidents, the two countries sign a deal giving Washington privileged access to Ukraine's natural resources. So the NVIDIA chief executive, Jensen Huang, said he'd like the Trump administration to change regulation for exporting artificial intelligence technology from the U.S. to the rest of the world. Well, he spoke to Bloomberg's Anne-Marie Hordern and other reporters on the sidelines of the Hill and Valley Forum, a gathering of tech leaders and U.S. legislators.
In order to produce $500 billion worth of AI infrastructure requires enormous amounts of investment from a lot of different partners. And so we've brought on shore many partners to help us do that. And we're going to have to build our own factories in order to do that.
What's your message and conversation going to be like today with the president when it comes to tariffs?
I'm going to count on the fact that the administration has a good plan. And from our perspective, we would like to have policies that support and help accelerate the development of artificial intelligence in this new industry.
Do you think they're going to have an edit of the diffusion rule that was under the Biden administration, basically placing all these different countries in different buckets?
Well, I'm not sure what the new diffusion rule is going to be, but whatever it happens to be, it really has to recognize that the world has changed fundamentally since the previous diffusion rule was released. We need to accelerate the diffusion of American AI technology around the world. And so the policies and the encouragement from the administration, it really needs to be behind that.
That was the NVIDIA chief executive, Jensen Huang, speaking in Washington yesterday. Now, Tesla's chair is pushing back against a report that the board is looking to replace the chief executive, Elon Musk, saying directors are highly confident in his ability. Well, joining us now is Craig Trudell, Bloomberg's global autos editor. Craig, so a pretty strong denial from Tesla, but you also wonder whether that's why he maybe left, the government advisory role a little bit earlier.
Robin Denholm, the chair, coming out and calling this absolutely false. But I do think, if you read the journal story closely, they acknowledge that, they don't have information about the current state of affairs in terms of whether a search is ongoing. But this notion that, about a month ago, according to the journal, they reached out to search firms, is pretty remarkable. I think it may not be surprising at any other company that happens to have its CEO spend 6-7 days a week in Washington and in Florida with the president of the United States and not with the company. But for Tesla, they have given Musk this incredibly long leash for years now and allowed him to be a part-time CEO. And yet, been able to really, of course, succeed in building this highly valuable company, even despite the fact that he is stretched thin and across so many, enterprises. And so for the board to initiate this process, I think speaks to just how much concern there is about how much time he's been spending, in his government position, and what the sort of unintended effects of all that work are for Tesla and its position trying to sell cars to people.
Craig, so I love, first of all, the headline. I'm going to give like a bit of a teaser to viewers, but the headline of today's big take is basically rockets, Teslas, and a giant head. What's the focus of it?
Yeah, the giant head alludes to this massive statue of Elon Musk's face. And, if there's anything that we've learned over the last year, it's that he has some thoughts about the way the world should run. We will now sort of, get a taste of maybe of that in action in a tiny village called Boca Chica, Texas. It's this, area on the very southern tip of the state along the Gulf. SpaceX will turn this, place into Starbase officially, and have a few people close to the company running the local government. And we know that Musk is a pretty impatient guy, wants to just launch one rocket after another, and in incorporating this place as Starbase and installing people who are close to the company, one would think that he'll have an easier time doing that than he even has up to this point.
Okay, thank you so much, Craig. As always, with, of course, Craig and his team, some great stories on autos. Our very own Craig Trudell in charge of all of our auto coverage globally. Now, Microsoft and Meta shares surging in pre-market trading after the tech giants reported better than expected earnings. Now, Microsoft's results suggesting customer demand for its cloud services has held steady despite economic turbulence. Now, on the earnings call, the chief executive, Satya Nadella, spoke about the company's outlook.
We just want to make sure we're accounting for the latest and greatest sort of information we have on all of that. And that's what you see reflected. And I feel very, very good about the pace.
Well, joining us now is Stephen Yu, Chief Investment Officer at Blue Whale Growth Fund, and Bloomberg tech reporter Mark Bergen. So, Mark, thank you for joining us. Bring a bit of a cool attitude to the poll set. Stephen, I mean, look, you basically decided to sell a lot of your shares in Meta and Microsoft, and investors were like holding on to their desks saying, what's Stephen doing? I mean, what's the rationale behind it?
So on a very high level, we are a true believer in AI, how AI is going to change the world in terms of on an enterprise level, on a personal level basis. But where we are today is we would much prefer to be on the receiving end of any AI spending, so the likes of AI infrastructure company like NVIDIA or Broadcom or some others. And I think there's always a question mark which will still remain in the next coming quarters or years, that which company is going to win on the back of all the AI spending.
Yeah, so first of all, and also Mark, like bring us up to date with what, we've had Meta, we have Microsoft. Microsoft shares are actually surging on this strong quarterly cloud growth. Again, I wonder whether there was also a bit of pricing in of tariff worries. So now it's a little bit of a backlash in saying, okay, we're fine for the moment.
I suppose so. I mean, I think this is illustrative of the fact that we call them big tech, but they're actually very different companies. And in many ways, like Google, Microsoft, Facebook, Meta spent years trying to emulate Apple. They're probably grateful now that they're not so reliant on a hardware business, where software and services are not going to be as impacted as we're seeing with the Qualcomm earnings. Clearly, like that is having an impact, and then we'll see Apple later. I think, this is obviously there's a bit of a customer lag. It's still remarkable for me to read in our story that Meta's business is 98% advertising. So they're still, despite all the money they put into the metaverse, all the money they put into AI, they're still an advertising company. And so far, and we've seen this also from the big ad firms, there hasn't been as much of a tariff hit on ad spending, but that might come.
Yeah, is there a risk, seeing that they'll be broken up at all? I mean, could you see value in that, or do you just want to find, better stocks with better, longer run possibilities?
In terms of if some of these big tech companies being broken up, it's probably quite beneficial to shareholders in time. I think, like, for example, if you look at like Meta, WhatsApp business, I think there's a lot of potential for that to embrace AI and develop some sort of AI assistant for us. But of course, the journey for them to be broken up, I think it could be quite messy. So you might not want to be part of that journey from an investor perspective.
What did you take from the earnings in the last 2 days? Has anything changed, actually, in your longer-term view?
In terms of our forward-looking view, I would suggest that there's no changes, just because I think on Microsoft, obviously, very strong set of results, but at the same time, the margin profile is unlikely to be expanding in the next couple of years compared to the last couple. And I think to Mark's point about Meta's business is still, majority of that is coming from digital advertising. And I think the likelihood today going forward, depending on what Trump is going to do in the next 90 days, is that we are probably going to see a global slowdown in terms of much more uncertainties in terms of spending. And of course, everything is interconnected in a way that the conversion rate from advertiser perspective could be impacted. So, and then when you marry that with the AI benefit that maybe Meta is going to generate, it's probably going to take some years or quarters to come to offset the headwind on the top line.
Mark, what's Qualcomm's way forward?
Reverse the tariffs? I don't know.
I mean, is there any line of revenue? I mean, I guess, the concern if you're a company like Qualcomm is that, of course, you have no visibility about tariffs, but also there's not really another line of stream that you can go to.
Yeah, I mean, I think my understanding of data centers is that they've been investing in that a lot, and that's something that clearly where we're seeing this big boom. We see this from Amazon, Microsoft, Google. These big spenders consistently said, we're not getting enough demand, or rather, sorry, we're not building enough to meet our demand. We've had some reporting that suggests that maybe that's not the case, that Microsoft is actually kind of tapping the brakes a little bit on data centers, although they said clearly yesterday that that's not the case. So I think that's an opportunity, certainly, that a lot of, not just Qualcomm, but all the semiconductor companies are looking into right now.
Stephen, so if you have optimism towards AI, you want to be on the receiving end of any spending, you must love NVIDIA.
That's right.
It's like your stock.
Yeah, so what happened with NVIDIA was late last year we were reducing our position just on the back of valuation, and they've done very well for us over the last 3 years already. But recently, on the back of DeepSeek and also a bit of uncertainty caused by Trump, we have been increasing our position back. So it's now very close to 10% holding in the fund, which is the maximum that we're allowed to hold.
Yeah, but it seems priced to perfection, or how much more room does it have to grow?
Yeah, it's one of those things, isn't it? If you look at the shorter-term PE ratio, that is probably, like, you can consider NVIDIA as a value stock. Is trading at just in the low end of 20 times PE ratio. But that is probably not the right measure, just because it all depends on how much you believe AI is going to change the world in the next couple of years, right? It's not about how much free cash flow NVIDIA is going to deliver in the next 18 months or so, which is going to be a huge number. But it's about what the sustainability of AI, which we think agentic AI is going to come into play. That's going to play a strong role. And hopefully the enterprises are going to come in to offset some of the spending by the big tech as well. Just because, like, if you think about the enterprises have not yet come up with something significant, which I think they're going to do so in the next couple of years.
Who can really compete in that space? And actually, are there any, smaller known European companies that at the moment are make or break that could fill in those shoes?
At the moment, we don't actually have probably concluded on this matter yet, but what is very interesting from our perspective is DeepSeek announcement a couple of months ago that we think the likelihood of us seeing more startups coming into play with, using just maybe a couple of millions to train some sort of models to get a market fit product before they can raise billions. I think that's going to be exciting. And the way that we understand it is it could be a repeat of the Apple iPhone journey. When it was launched back in 2008, we probably had 100 apps just about, and now we have millions. And then you can expect that AI is all about data, all about trainings of data coming up with use cases, and hence, like, you could expect millions, if not hundreds of thousands of AI applications with very low cost of training. So hence, I think at the moment it's not been worked out yet who's actually going to come up with something very sensible or game-changing.
So watch this space. Mark, what do we know about the Trump administration's relationship with the Magnificent Seven? Again, some of them we thought were very cozy. They slammed Amazon for these talks on tariffs. Do they take no prisoners? Like, what do we actually know?
What do we actually know about the Trump administration? Is always a difficult question. Depends on the day. I mean, clearly, like they've invested a lot. You know, Mark Zuckerberg bought a house in Washington D.C. Like we got a report about Meta's increased spending. You know, his relationship with Google has been sort of hot and cold. And obviously, they're going. Both Google and Apple are under increased antitrust scrutiny. I mean, my sense from the reporting though is that clearly, like the administration's goals here is like they want, you know, in Apple's case, they want things to be built in the U.S., right? The sort of robots manufacturing iPhones here in the U.S. and that vision. And I think, you know, in certain, the companies have, it's very different than they've learned over the past administration and now his first 100 days, how to curry favor, how to work and kind of work around Trump and his administration. But, you know, it seems like it's consistently unpredictable and kind of follows the political winds.
And Stephen, overall, I mean, you don't have only, you know, AI-related stocks. You have quite a lot of luxury stocks. I mean, when you look at the tariffs and the turmoil that we lived through in the last 100 days, where do you want to be positioned? Where are you allocating capital to?
Yeah, it's actually quite a tricky situation today, just because if you think about we're going to see a global slowdown or maybe a mini U.S. recession, a lot of things are going to be impacted. It's just a question about the relative magnitude of that impact, right? So what we have done over the last couple of weeks or so is we have been taking some position down, so including selling down Meta, reducing our luxury exposure, and we recently exited Nintendo, which they launched this Switch 2, very exciting, but then it's going to cost consumer $450, which is not a small sum of money in light of uncertainties. But at the same time, I think there's certain opportunity sets like European defense and Leonardo that we owned, like for example, other stocks like Philip Morris or even like Lam Research and some others. I think they are actually proved to be quite resilient and have done very well for us.
See, what are we misunderstanding about AI the most? I know, you know, some people think it'll have a huge impact on the economy, given all these shifts, also in the new global order and what, you know, the Trump tariffs do if they stay in place. Are we forgetting or underestimating the impact of AI?
In terms of how it's going to change the world, I think that we are definitely underestimating, just because a lot of people have said to me, oh, I haven't actually seen much from AI yet. But I always want to remind those people, like, we have only been in that journey for 2 years, which is quite a short period of time. And hence, I think when you follow the use cases from a lot of AI application today, I think it's very promising in terms of direction travel. But of course, the journey is still ongoing in a way that you just need to be on top of what's going on. And at the same time, yeah, if you marry that with the tariff, with what China or Trump is doing to each other, it's all about the arms race between the two countries ultimately. So it's either it's going to be like whether America is going to maintain the superiority in AI and versus China, which is trying to work something out themselves with very limited capability.
Okay, thank you both, of course, for joining us. Stephen Yu, Chief Investment Officer at Blue Whale Growth Fund, and Bloomberg tech reporter Mark Bergen. Now, coming up, BBVA's proposed takeover of Banco Sabadell is one step closer to reality. We'll take a look at the details and the implications for Europe's banking sector next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Earnings season is here.
European earnings kick into high gear.
Beginning to gather a little bit of momentum.
Bloomberg is first to break the numbers.
Netflix, Hermes,
SAP as well.
ASML reporting a big mix.
With the smartest insights.
Is it possible for the earnings story to dominate?
Look at the resiliency behind the numbers.
Earnings may even flip into negative territory.
The volatility of earnings really matters now.
It's like a marathon of earnings.
Continuing coverage on Bloomberg. Context changes everything.
Well, Spain's antitrust agency has approved BBVA's bid to buy smaller rival Banco Sabadell, but with conditions. Kriti Gupta, anchor of Opening Trade, has been following this very closely and joined us now. So thank you so much for joining us. Antitrust agency base said, yep, go ahead. They did put some terms attached. How big a deal is this?
This is a big deal because so much of this deal was hinged on this idea of leaning into BBVA's specialty, which is digital banking and digitalization. That means a lot of bank closures or branch closures, specifically in a part of the country that is dealing with a lot of kind of political turmoil, and that is Catalonia, the very area that Banco Sabadell has the majority of its presence. And so these remedies that have come with kind of this conditional approval from the antitrust authority is on the condition that not all of these branch closures are actually going to happen, simply to save and kind of prevent any kind of cannibalism of the actual banking services for small and mid-cap companies, which is where Banco Sabadell really excels. But this is crucial as well because BBVA has an alternative motive for this, which is in addition to leading into their digitization, also having perhaps a little bit less exposure to Mexico, to LATAM, leaning more into Spain as well. And that's where they've gotten the green light.
Yeah, I mean, there's been quite a lot of criticism, or let's say some criticism about the deal because of some of the things that they asked. I guess it's more the kind of the framework of how they put this together.
Well, one of the big pieces of pushback, not just from the Bank of Spain, which had issued a very kind of controversial report as well, but from the Sanchez government itself, was the fact that if you have too much banking consolidation, can the bigger players then basically charge higher consumer lending rates, and could that ultimately be damaging to the economy? It's a similar line of thinking you've heard in the likes of Italy, in Germany, in other eras of banking consolidation as well. So these ideas of remedies that kind of don't eliminate the full extent of cost savings that you're seeing is a way to manage that kind of critique. Look, we're not in the full green yet. We've got one green light from the antitrust authority. We still have to hear from the Sanchez government. They've got about 45 days to weigh in, and then a final approval from the markets authority as well. So still kind of getting there, but warmer to the finish line than ever before.
Okay, Kriti, thanks so much. Kriti Gupta there with the very latest, of course, on BBVA. A reminder that Kriti's been speaking with the BBVA Chief Financial Officer, Luisa Gomez Bravo, as part of Bloomberg's Chief Future Officer series, and you can watch that now on YouTube. So it's been a big week, big week for European bank earnings. Lloyd's just the latest to report first quarter results. Pretty strong. Market volatility boosting earnings at UBS and Barclays. So plenty to discuss with Paul Davies from Bloomberg Opinion. Paul, I have like 1,000,001 questions, and that's just on earnings season. Overall, when you look at, trading, tariffs, volatility, like who's been doing well on the U.S. side, but also especially on the European side?
Well, I guess it's kind of a mixed picture for different banks in different areas. I mean, I guess the headline is overall the US banks were generally much more concerned about recession coming there than European and UK banks have been in their results. The rest of the world seems to be, to some degree, getting on with its economy, getting on with trade without the US. But I think a lot of what we saw in the first quarter was is old history, right? I mean, most of what came out of the White House happened in April, and we've seen a huge April, all kinds of crazy volatility. Banks did well in trading. What's really interesting in the Europeans is They've gained ground against their US rivals in the FIC, in the bond, and particularly sort of currency trading spaces, but they've continued to lose ground, everybody apart from BNP Paribas, in equities trading. And that's because, in part, JP Morgan and Morgan Stanley just had a cracking quarter, really took back a ton of share. But, you know, Barclays, SocGen even, which is going through its whole sort of turnaround plan, have just been sort of losing ground. BNP is the only one that's really gained ground in that whole area.
Talk to me about the investment banks. I mean, again, or the parts of the investment banks. If you look at, again, they're not all created equal because of the kind of exposure they have. UBS had a particularly tough time on this.
Yeah, so UBS, I mean, obviously it's a smaller business in some ways. It can be particularly lumpy. You know, they have a very strong bias towards private equity and particularly towards financing private equity deals. You know, the whole sort of investment banking first quarter was disappointing, but really not as bad as it could have been. Actually, you know, for a lot of the banks, the numbers are up compared to this time last year. But UBS saw a real drop in its revenue, and that's because there was just, like, you know, hardly any decent leverage finance business in the quarter.
What are you hearing, Paul? I mean, you have some great articles with, like, you know, different angles, which I always find enjoyable. But what are you hearing? Is it too soon to talk about firing or hiring, depending on whether tariffs stay and whether, you know, these big banks kind of like move around a bit?
I mean, I think it's probably too soon for now. I mean, especially in deal making, there was a hell of a lot of hiring over the last couple of years. I mean, especially in the US, among the sort of the boutique, the smaller investment banks, you know, in anticipation of a great revival in deal making. I mean, that could still happen. There's still an idea that there's a lot of pent-up demand, stuff to be done. I guess what really matters is what happens now with, you know, President Trump's kind of single-handed global tariff war, and whether that starts to settle down over the 90 days since, you know, whenever they announced the pause. But yeah, I mean, you know, in markets as well, you know, April has been, you know, an absolutely fantastic month. There's going to be huge numbers out of that, but everybody is saying that people were repositioning and now they're just kind of going to increasingly sit back. There's kind of a bit of fatigue, and so unless we get some clarity out of the US, everything in the market side is going to slow down a lot as well.
But and as you wrote, I guess, you know, the Trump market chaos did, you know, specifically benefit, for example, Barclays and Deutsche Bank just because of their fixed income trading.
Yeah, no, absolutely. I mean, and again in April, I think it was UBS yesterday. They said, you know, the peak days in April in sort of FX trading were 30% greater than what they saw in the worst of the volatility during the kind of the onset of the COVID crisis, which sort of tells you, you know, what was going on. I mean, you know, April was much orderly, I think, in general than the onset of COVID. You know, markets were functioning. They weren't kind of gapping and orders weren't failing all over the place. But you know, that's 1 month, and everybody's adjusted now. People have assimilated the chaos to some degree, and now they're going to sit back and just try and wait for some better signals.
So I love this rivalry that's like ongoing forever and ever between European banks and Wall Street. And the European banks are saying, well, you know, we could benefit at the margins, for example, from customers saying, well, I don't trust the U.S. so much. I'm a little bit worried. I have a big pension to make sure that it's managed. I'll go to European banks.
Yeah.
And then the U.S. telling you, oh, just wait until, you know, they start deregulating in the U.S. Then we're in charge.
Yeah, no, absolutely. And I mean, again, it's like, so this is a question I've been asking bankers consistently for the last probably 3 months or so already. You know, in Europe, are you seeing more mandates coming from your European clients? And they're all saying, we hope that's going to happen. It's like, so it's obviously it's not quite happening yet. You know, everybody thinks it's like there's going to be this wave of patriotism and they're going to come to their, or, you know, maybe just kind of safety and trust or something, I don't know, but come to their local banks. But it's not yet happening yet.
Okay, not yet, Paul. Thank you so much. Paul Davies there from Bloomberg Opinion. Now, don't miss our interview with the Robinhood Chief Executive, Vlad Tenev. That's on Open Interest, and that's at 3:30 p.m. London time. Up next, Bloomberg Brief with Danny Berger. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The first round of deals, President Trump touts talk progress, but says he's in no rush. China says the U.S. has reached out. The bull's out for tech. Meta and Microsoft jump as the giants defy slowdown concerns. Next up, Apple and Amazon. And a new relationship. As President Trump and Prime Minister Carney discuss their future, we'll speak to the President and CEO of the Canadian Chamber of Commerce. 7 consecutive days for gains of this equity market for the first time since Trump's election. We look very well on track to make that 8 days of gains. By the way, it's been the best 7 days since November of 2020. The rally continues in a big way this morning with strong earnings from Meta and Microsoft. The Nasdaq outperforms at more than 1.5%. Also optimism over Trump. Potential deals is the exact phrase he used on trade with various nations. S&P 500 futures up more than 1% this morning. When it comes to the bond market, we did see two-year gain yesterday. Yields lower. That continues again this morning. They're basically little change. Higher expectations for rate cuts after that GDP decrease. Moderate consumer spending, tame PCE figures. Your 10-year yield down by 1 basis point. We're trading just below 415 this morning. And the yen dropping versus the dollar. It's off some of the lows, but the BOJ leaving rates unchanged, pushing back on the timing for when it will reach its inflation target. Let's get a look at some stocks on the move in the pre-market this morning. With that is Bloomberg's Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start there in big tech. We're seeing some big news on the pre-market. Take a look at Microsoft, up over 8%, beats across the board, and also a bullish forecast when it came to their cloud business numbers. They also tapped the brakes on CapEx for the first time in 10 quarters. It seems like investors are liking that prudence. That stock is up over 8% in the pre-market. Let's move on to Meta. Another beat there for the social media giant. The worry about ad revenue pullback is not happening. It did not show any signs that advertisers are pulling back on ad spending. Meta up some 6% in pre-market. Finally, let's add Qualcomm on here. This is a stock that gave a tepid forecast yesterday. Qualcomm is the biggest chip maker when it comes to smartphones. They showed some concern on the smartphone industry as it's adjusting to tariffs. So Qualcomm on the downside, down 5.5% pre-market.
Valerie Teitel with a look at the tech movers this morning. We'll catch up with Valerie later this hour. Also coming up this hour, we're going to be speaking to Stephen Major of HSBC and Candace Lang of the Canadian Chamber of Commerce. Now, Stephen Major, Global Head of Fixed Income Research at HSBC, discussing the future of the bond market globally, writing, loyalty to the U.S. Treasury market was built through years of trust in the reserve currency and perceived safe haven status for bonds, underpinned by an independent central bank. If this status were to be put at risk, the UK could stand to benefit as an alternative safe haven. Pleased to say that Stephen joins us now. Steve, great to see you. And I know you wrote this in your research as part of why the UK yields have a higher premium compared to their European counterparts. But that first part, is that a serious discussion ongoing right now? A serious look for alternative havens beyond the Treasury market?
Yeah, well, the stock response is there's no alternative, Danny. But then if you take a bit of a look, you could maybe buy a basket of alternative bonds. And the context is quite important here, Danny, because the reflexive response to the idea that the UK yields are high sometimes goes back to Brexit, because there was a Brexit premium. But that's 9 years ago. That's been fading somewhat. It was about supply constraints. But if you think a few years forward, we could be transferring some of that risk over to the US, because if the labor market's not going to be growing like it was the last 4 or 5 years, some 15 million people came into the US, for example. So you had a supply boost in the US through a period when the UK was recovering from supply constraints. The other thing is the UK has had a few fiscal episodes in recent years, going back to 2022, and you could even say last year. Those fiscal episodes are reminders to the UK government to behave, and therefore you have fiscal responsibility as well, and you have an independent central bank. So I think that given some of the things that have been discussed in the last few weeks, people will be thinking, well, perhaps there are some alternatives. Now, the problem for the UK is it's so small as a market, but it's a good start anyway, Danny.
It kind of gets to this narrative also of, do foreign buyers of treasuries look more closely at their own domestic markets? Stephen, I know you've been pushing out to some degree about this idea that there's a foreign buyer strike of U.S. treasuries. Yeah. What does that narrative get wrong? What does it actually look like in terms of foreign flow into American treasuries?
Yeah, well, both the US and UK have a similar pattern in the rotation into domestic investing over the last 10 years. So again, the context is important, right? Something like 30% of the stock of US treasuries are held outside the US. So if there's some $8 trillion or so, half of it's in the official sector, half of it's in the private sector. Now, I dare say there will be some private sector investors that don't like what's happening and may have sold. But if I have to order the reasons for the sell-off at the beginning of April, it was more the vol shock that came from the tariffs and the reciprocal tariffs, and what that did to asset swap positions, basis trades, etc., and also the forced deleverage that was happening and liquidations in real money. That was the explanation for the jump in US yields. To point at overseas investors, I don't think that's correct, Danny.
If that is the case, does that mean some of the froth, some of the jumpy money has been taken out of the Treasury market and there's less concerns of fragility? Or are you still concerned that we could get episodes like we did in mid-April?
Look, I think 10-year Treasuries should sit in a 3 to 4% range. They're currently above 4. Prior to April the 2nd, they were heading below 4%. So I don't think it's unreasonable, given the fact that the Fed wants to get back onto an easing path later this year, that treasuries are in a 3-4 range, and 3.5 is our forecast for this year. I think you're right. Some of the froth may have been taken out, and we've had a very calm couple of weeks, as you were just pointing out. Treasury yields are grinding lower, and they are restoring some of that trust that I think is being challenged. I mean, the important thing here is that trust is an antecedent of loyalty, and you need loyalty in your bond market. So that's why it's important that governments keep that trust in their bond markets.
But we even heard from Scott Bessent earlier in the week talking about the unpredictability being a feature of Trump's negotiating tactic. You even had Stephen Mirren, according to the FT, talking to various bond market investors who said that they left more confused than when they entered that meeting. Steve, there still seems to be an element that we won't get exact clarity from the Trump administration. So is that trust really restored for the bond market?
I think people are starting to get their heads around this scenario approach. I mean, the Bank of Canada actually introduced a twin scenario forecast. So they had a severely adverse outcome from tariffs, full-on tariffs, and something a bit more like muddling through with some adjustments through time. But the important thing is they ended up with the same longer-run equilibrium rate. If you apply the same methodology to the US and other bond markets, it says to me that people are getting their heads around this. The idea that there is a severely adverse scenario that means that yields could fall a lot, and there's one whereby the yields fall anyway, but at a slower pace. For yields to go up, you've really got to de-anchor the market. So you need to lose that equilibrium. That's where the Fed independence and the reserve currency status is absolutely critical. And I don't think it would be right if the US authorities flirt with those two.
At least for now, Trump has definitely pulled back on that rhetoric despite his criticisms of Powell. Steve, we also got the refunding announcement from the Treasury yesterday. He had the same plan that, of course, that he had criticized under Janet Yellen, but there had been some expectation to be more aggressive in terms of buybacks, again, to help soothe bond markets. We didn't necessarily get that, Steve. Should we have?
Yeah, to be fair, the Treasury Secretary may have said certain things before he got into the seat, but the reality is there's a lot of debt. It has to be rolled over. They have to manage the maturity of this stock of debt, and so there's always the option of moving shorter if there was some stress, for example. Now the buybacks were introduced under the Yellen Treasury, but they were more about illiquids, and it wasn't a full program that I think that the Treasury might be working on. I don't know anything for sure, but imagine that they have a program that's there. It would mean that the Treasury could be the buyer of last resort rather than the Fed, which is interesting because, by definition, each future crisis we have will be different to the previous one, but people will try and model it on what they've seen in the past. But of course, the context is always very different. So the fact that you've got the Treasury and the Fed as potential buyers or interveners of last resort, I think that's quite soothing for the Treasury market.
And Steve, that is just a perfect thing to say in so many respects of what we're going through right now. It is always so wonderful to have you on. Thank you for joining us.
Thanks,
Stephen
Sally.
Major of HSBC. Let's get you some other top stories now that are trending on the terminal this morning. The Bank of Japan slashed its growth outlook and delayed the timing of getting back to its 2% inflation target. The central bank kept its rates unchanged at 0.5%. The yen continues to weaken against the dollar, while JGB yields are lower this morning.
There is more uncertainty than usual about whether the BOJ's forecast will materialize. It is necessary to closely monitor developments on the tariffs front, as we will see a significant rise in adverse effects on our economic and price outlook.
The European Union is planning to present a paper on new trade proposals to U.S. negotiators next week. According to Bloomberg sources, the paper will set out a package for lowering trade and non-tariff barriers, boosting European investments in the U.S., cooperating on global challenges like tackling China's steel overcapacity and purchasing more U.S. goods. Elsewhere, Airbus says it won't cover the cost of tariffs on its planes imported by U.S. airlines. That sets up a clash with some of its biggest customers who've been unwilling to shoulder the duties imposed by President Trump. It's just the latest indication of how the aviation industry is scrambling to adjust to new fees in the already complex aerospace supply chain. Coming up, President Trump sees no rush to strike trade deals despite the public perception of his tariff regimes. We'll have more on where we stand coming up next on your Bloomberg Brief.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Ripped off by everybody, but really by China. They were the king of ripping off the United States. Now they're not doing any business here because I don't want them to do business. So I set a high tariff. I don't want them to do business. Now, will we make a deal? There's a very good chance we're going to make a deal, but we're going to make it on our terms.
Mr.
President, it's got to be fair.
President Trump speaking in a telephone interview with former Fox host Bill O'Reilly yesterday. They covered tariffs, Ukraine, and Trump's first 100 days back in the White House. Joining us now is Roz Matheson, Bloomberg EMEA News Director. So, Roz, we have positive sounds coming from the Trump administration saying that there are potential deals, saying that he's optimistic something can be struck with China. You have the EU presenting a paper on possible trade negotiations. But Trump also saying in that interview that he is in no rush. So where do we actually stand?
Well, as you say, there's a lot of noise and there's a lot of talking. So the US is saying they're talking to a whole lot of countries and hoping to get some sort of initial trade deals soon. And those are probably framework understandings versus a full, box and dice trade deal. Does that come first with a country in Asia, India, Japan, or whoever? The EU obviously laying out a position here for possible negotiations, and the big one being China in all of this. But so far, we don't have a single trade deal out of the administration. We've got a pathway potentially to some, but even as Donald Trump says he's in no rush, other countries say the same. They say, yes, we want to talk to the US. Yes, we want to have these conversations and negotiations, but we're not going to rush to make a bad deal just to get a deal done. And that's a very clear message you're seeing also from some other countries around the world, because these trade deals are very complicated. They're very granular. You don't want to race to sign something that you later regret. So there's a lot of conversation, yet to be much that's tangible. And really the big question in all of this, at what point are the US and China at a high level going to talk formally, properly about trade, and what is the pathway there to a potential understanding?
Right, and China very specifically saying China doesn't need to talk to the U.S. until it takes meaningful measures. So it seems like they're waiting for the U.S. to make the first move. Roz, while we have you, we did have one deal yesterday, away from trade, but on Ukraine and their resources with the U.S. What sort of deal was reached?
Well, that's right. This is this resource deal that's been in train for some months and been very fraught, and negotiations have been very complicated. And there have been some changes to this deal to get it over the line. But basically, it is this joint investment reconstruction fund that we based around these future licenses around minerals, gas, oil, a lot of which is unproven, a lot of which we're not quite sure how much of it there is, where it is, how extractable it is. But this fund would pile that in together. The US would get preferential access to the profits from that fund, and that's ostensibly to repay the US for any future military aid that they give Ukraine. But it does give the US quite a lot of leverage over Ukraine economically. The US would argue that binds the countries together economically, and that's a form of security guarantee in a way for Ukraine against Russia, but it's not a military guarantee. And this deal is something that Donald Trump can certainly tout, but it doesn't mean we're necessarily much closer to a formal ceasefire between Russia and Ukraine. You can see the language from Russia particularly hardening of late and saying there's a lot to be discussed, a lot to be navigated in order to get to that proper ceasefire arrangement. So perhaps a bit of security from Ukraine out of this, but a long way to go.
Roz, really appreciate your time this morning. That is Bloomberg's Roz Matheson. Now let's turn to earnings. Today is the busiest day for the quarter for S&P 500 results. Apple and Amazon are on deck, but we've already heard from two other tech giants yesterday, Meta and Microsoft, posting strong numbers, shares at least up 6% to the pre-market. Meta CEO Mark Zuckerberg told investors that he's optimistic despite the tariff-induced uncertainty.
We've had a strong start to the year. Our community keeps growing with more than 3.4 billion people now using at least one of our apps each day. Our business is also performing very well, and I think we're well positioned to navigate the macroeconomic uncertainty.
Joining us now is Bloomberg's Charlie Wells. Charlie, a strong set of results.
A very strong set of results, and a lot of this has to do with tariff relief on some fronts for these software companies, but also a constructive story that they've both been able to tell about AI. So on that earnings call, it was really striking to hear Mark Zuckerberg talk about a lot of the opportunities that AI could present a lot of their customers to sort of personalize and make a lot of the ads more targeted that they present. Ad revenue is so important for Meta. It brings in 98% of their revenue. It was a little bit similar with Microsoft, where very different business units, but you saw significant growth in their Azure cloud business, 33% growth. They were able to indicate that 16 percentage points of that growth came from AI. So for both of these firms, there's that tariff relief, but also this narrative of AI actually being able to help them make money.
And also the capital expenditures that they all recommitted to. I think for Alphabet, it was $75 billion last week, Meta, $72 billion increase. And I wonder, Charlie, where does that set the bar for Apple and Amazon when they report earnings?
It sets it really high, Danny. I think, we're thinking about these two companies reporting yesterday. Then last week, we had Alphabet setting that high bar. And it could be a little bit more difficult for both of these companies, for Apple and Amazon, because they're not just software companies. They rely on retail on the Amazon front, and there's hardware on the Apple front. And again, there's that China risk that both of them will have to deal with. You've got production in Apple of iPhones. Apple trying to pivot out of China for a lot of these iPhone productions into India. Amazon concerned about a lot of these retailers, and it's not just retail for Amazon as well. Investors will be focusing on some of the services that a lot of these Chinese retailers use. They rely on Amazon logistics, on Amazon advertising. So look, there may be a positive tech story in the markets today, but it could shift a lot in just a few hours.
I was going to say, Charlie, how much is that Amazon call just going to be like? Have you been talking to the Trump administration? Are they angry at you? Did you pull back on tariffs because of what we heard from Trump's press secretary at the conference?
That's exactly right, Janet. There was talk this week about the pricing strategy, about maybe indicating, what fees were coming from those tariff hikes, and that seems to have, angered the Trump administration. But Amazon is in a unique position, right? Because they've got that heft. They've got that heft with the Trump administration, but also with China. So trying to make the situation, I think, the best they can. And if any company is going to be able to muscle in this difficult moment for a lot of retailers, it's probably going to be Amazon.
Yeah, Trump saying that he spoke with Jeff Bezos specifically after that moment. Charlie, thank you so much for joining us this morning. That is Bloomberg's Charlie Wells. Okay, coming up, we're going to take a look at what else is making headlines around the world, including a denial from Tesla that they're looking for a new CEO. We'll break down the story next in your Bloomberg Brief.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment. Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what is on the front pages this morning. Starting up, the New York Times leading with the U.S. and Ukraine reaching a deal for minerals, granting the U.S. privileged access to new investment projects to develop Ukraine's natural resources, including aluminum and graphite. It is unclear what the deal means for future U.S. military support for Ukraine. Next up, a Wall Street Journal report that the Tesla board about a month ago opened up a search to succeed Elon Musk as CEO, reaching out to several executive firms to work with him, saying that they got serious with his White House focus. The chair of Tesla, though, writing this on X, that this is absolutely false, and the CEO of Tesla is Elon Musk, and the board is highly confident in his ability to continue executing on the exciting growth plan ahead. Next up on the FT, reporting that China is signaling trade talks with the U.S. They're leading with that. The Chinese state media said that there would be no harm in discussions with the Trump administration. Citing unnamed sources, it noted that U.S. officials had proactively reached out to China through various channels. Coming up, beats all around. Big tech comes through with big results. We're going to look at those first quarter numbers from Meta and Microsoft next. Shares up 6% for Meta. For Microsoft, it's an 8% advanced. That's coming up next. This is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. The first round of deals, President Trump touts talk progress, but says he's in no rush. China says the U.S. has reached out. The bulls come out for tech. Meta and Microsoft jump as the giants defy slowdown concerns. Next up, Apple and Amazon. And a new relationship as President Trump and Prime Minister Carney discuss their future. We speak to the president and CEO of the Canadian Chamber of Commerce. It's been 7 consecutive days of gains for this equity market, the longest winning streak since Trump's election. We look to make it 8 days this morning, led higher by tech. NASDAQ up 1.7% for this future session after Meta and Microsoft earnings. Also getting a boost from hopes, as Trump put it, of potential deals, the first round of trade deals to come for this market. Will we get it? For the bond market, you've also mostly, for the most part, been looking for eight consecutive days of gains, including today. We move lower by nearly 2 basis points for your 10-year yield. We're at 4.14 for that. More cuts continue to get priced into this market in the front end after yesterday's economic data. 3.6% is where we stand. And the yen dropping versus the dollar. The BOJ leaving rates unchanged, pushing back on the timing for when it'll reach its inflation target. Let's look at some stocks to watch this morning. With that is Bloomberg's Valerie Teitel. Hey, Val.
Good morning, Danny. Let's check there with the check on the big tech names. Microsoft and Meta both powering higher in the pre-market after these earnings beats after the bell yesterday. Meta up 6.25%. Microsoft up 8%. This streak of equity market rally is set to continue with the strong gains in big tech. But let's keep an eye on the stocks that we have reporting this morning. One of them is a big one, Danny. It's in the healthcare space. Eli Lilly. It's been one of the key outperformers in the healthcare sector of late, mostly around their success in their oral GLP-1 pill. But we'll be watching the CEO's comments around these Trump promised tariffs on the sectoral, on the pharmaceutical sectoral tariff specifically. That stock is powering higher in the pre-market, though, up more than 2%. The earnings frenzy does continue. We do have a lot more stocks reporting before the bell. The big ones this morning will be MasterCard, McDonald's, and also from the healthcare industry, CVS.
Valerie, great work. Thanks so much for joining us this morning. Bloomberg's Valerie Teitel. Let's dive deeper into those earnings from Meta and Microsoft. Meta CEO Mark Zuckerberg told investors that he's optimistic despite the tariff-induced uncertainty.
We've had a strong start to the year. Our community keeps growing with more than 3.4 billion people now using at least one of our apps each day. Our business is also performing very well. And I think we're well positioned to navigate the macroeconomic uncertainty.
Joining us now is Mandeep Singh of Bloomberg Intelligence. Mandeep, are you as optimistic as Zuckerberg seemed to be on Meta after those results?
I mean, when I look at the guide they gave for 2Q, clearly it tells me that, the impact from Chinese advertisers, which was the big risk with their earnings, that didn't really pan out, and they are somewhat insulated when it comes to bringing in other advertisers to make up for any lost revenue. And look, overall, their Llama story, the AI story, really is around a personalized assistant. That's why they're raising their capex. I mean, to me, this is a little further out. So clearly they have a plan in terms of how they want to compete with the other LLM players. 4 other players are ahead of them. They are a distant fifth when it comes to these LLMs. But their focus is we have all the data around the 3.5 billion users we have, and we'll offer them a personalized assistant and then focus on voice. So it sounds like an interesting strategy, but clearly that's why they're raising their capex.
And on that capex, we heard from Alphabet last week that they're going to spend something like $75 billion this year. For Meta, it's a sizable raise too, from $39.2 billion spent in 2024 to $72 billion this year. Mandeep, what do you make of those numbers?
Absolutely. I mean, look, they have the highest growth in terms of capex among all the hyperscalers. And you have to ask yourself, with Microsoft, their Azure revenue growth accelerated. With Google Cloud, they have a $50 billion revenue run rate business. In the case of Meta, all the AI investment is showing up in their core business. Clearly, 16% growth with 52% margins was aided by AI. But the standalone Meta app, I mean, I think it's a distant 5 right now. You already have the leaders in ChatGPT, Google Gemini, Claude, Grok. Meta AI is a new app, and it's not even as good as the other 4. So will they be able to monetize it? I don't know. But clearly the AI monetization is showing up in their ad pricing and the ad stack that they currently have with their family of apps.
So Mandeep, just fair to say some of those reports we've seen of X company, X big tech company pulling back on data center spending, that was a bit overdone?
Absolutely. I think AI is still the secular trend. And, these companies are quite prudent when it comes to rationalizing their investments. They did that back in 2023 when the ZERP era ended and, inflation and interest rates were rising. So the fact that nobody is doing that among the hyperscalers goes to show that they feel this is still, a temporary phenomenon with the tariff situation, but they don't see a prolonged downturn here. And that's why they continue to invest big when it comes to capex.
So strong results, Microsoft, Meta, Alphabet. Up next, we have Apple and Amazon, completely different businesses when it comes to the tariff impact. Mandeep, what are you expecting?
Well, I think we had the good prints last night. Tonight isn't going to be as rosy. And my guess is, Apple clearly is the most exposed when it comes to the hit from China in terms of revenue and the supply chain. But they have shown in the past they just know how to maneuver these kind of situations well. And with Amazon, we know what transpired this week. So clearly there is that retail line they will get impacted by when it comes to tariffs. But the AWS side should do well, given what we heard from Microsoft last night, because they said the non-AI portion is also rebounding. So that should actually play into AWS's strength because they are the largest cloud provider when it comes to the traditional cloud.
But does what we heard yesterday coming out of the Trump administration, does it hamstring companies like Apple and Amazon, their ability to rise prices when they are faced with tariffs, Mandeep? Is this going to be a story of impact to margins?
I think more so for Amazon retail business. I think less for Apple because the last time tariffs happened, Apple did manage to get an exception. So that's why I think they will maneuver this around when it comes to their hardware sales. But for a company like Amazon, there is no doubt they will get hit with the tariff situation and the uncertainty given the size of their retail business.
Mandeep, thank you so much for getting up early and joining us this morning. Always fantastic to have your insights. Mandeep Singh of Bloomberg Intelligence. Let's get you some other stories now that are trending on the terminal this morning. The Bank of Japan slashed its growth outlook and delayed the timing of getting to its 2% inflation target. The central bank kept its rate unchanged at 0.5%. The yen continues to weaken against the dollar this morning. JGB yields are lower.
There is more uncertainty than usual about whether the BOJ's forecast will materialize. It is necessary to closely monitor developments on the tariffs front, as we will see a significant rise in adverse effects on our economic and price outlook.
The EU is planning to present a paper on new trade proposals to U.S. negotiators next week. Bloomberg sources say that the paper will set out a package for lowering trade and non-tariff barriers, boost European investments in the U.S., cooperate on global challenges like tackling China's steel overcapacity, and purchase more U.S. goods. Elsewhere, Airbus says it won't cover the cost of tariffs on its planes imported by U.S. airlines. It sets up a clash with some of its biggest customers unwilling to shoulder the duties imposed by President Trump. It's just the latest indication of how the aviation industry is scrambling to adjust to new fees in the already complex aerospace supply chain. Coming up, we speak with the president and CEO of the Canadian Chamber of Commerce on the future of the relationship between the U.S. and Canada. That's coming up next. Stick around for your Bloomberg Brief.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Ripped off by everybody, but really by China. They were the king of ripping off the United States. Now they're not doing any business here because I don't want them to do business. So I set a high tariff. I don't want them to do business. Now, will we make a deal? There's a very good chance we're going to make a deal, but we're going to make it on our terms.
Mr. President,
it's got to be fair.
President Trump speaking to Bill O'Reilly last night about the chances of a trade deal with China. Speaking on the phone, Trump said that there was no rush to get a deal. Joining us now is Kevin Whitelaw, Bloomberg managing editor for Weekends for the Americas. Kevin, on one side of things, you have Trump saying that potential deals are on the way, but on the other side of things, saying that there is no rush. So where do we stand?
I think we're all trying to sort that out. I mean, the biggest problem is it's not even clear there's any real conversations going on between the U.S. and China right now. On the European side, they've been trying to figure out who to talk to and who actually can make a deal. They really haven't been able to engage yet with Trump himself. And ultimately, all these decisions are going to come down to Trump. And, you know, for a lot of countries, they're willing to make some small offers. They're willing to have conversations around the edges. But, you know, the question is going to ultimately be, what is Trump actually looking for? Because he's talked about wanting tariffs for a couple of different reasons. And one of them is about revenues and you know, eliminating or reducing the income tax. Well, that means those tariffs have to stay in place if that's what he's actually looking to do. And so it's really a little bit unclear what the end game is here. It's very clear, however, that the market pain and the economic impact is starting to trouble the White House.
But at least the good sort of vibes, I guess, not actual deals, but talk coming out of the administration is helping this market. Let's just take China, Kevin, because we heard from China that the U.S. is proactively reaching out to China. Trump, we heard there saying that he hopes for a good deal, but China itself saying that they don't need to talk to the U.S. until it takes meaningful measures. Where is the ball? Whose court is it in at the moment, Kevin?
I mean, I guess the ball's going to be in whichever country feels pain faster and has to respond to it. And you know, ultimately, that actually could be the United States. I mean, we're already looking, I think, at some supply shocks developing in the economy with suddenly cargo shipping way down. You know, going to see prices on items go up or things simply become unavailable. That'll start to kick in the coming months. And at some point, that's going to start, I think, worrying consumers. It's going to start worrying businesses. The uncertainty already is kind of paralyzing investment decisions and other things about where exactly they're going to go. How does a company make a long-term investment decision if they don't really know what the situation is going to be next week or next month? And so I think that it's ultimately going to probably fall on the Trump administration to find some way to walk this back, unless they decide this is the fight they want to have. But I think China might actually feel it has a bit of the upper hand and can simply wait it out in a way that it's possible the White House won't be able to do.
Kevin, thank you so much for joining us, and congratulations on the new job. Very well deserved. Bloomberg's Kevin Whitelaw there. Now, as Mark Carney takes office in Canada, he also takes on the challenge of President Trump, who spoke about his relationship with the Prime Minister at a cabinet meeting yesterday.
I think we're going to have a great relationship. He called me up yesterday. He said, let's make a deal.
It's going to be a very different one than we've had in the past. We'll have a partnership on our terms. There's a win-win possibility there, but on our terms, not on their terms. We deserve respect. We expect respect. And I'm sure we'll get it in due course again. And then we can have these discussions.
So as you heard there, Mark Carney speaking about his relationship in maybe a slightly different tone with the U.S., speaking to the BBC yesterday. I'm pleased to say that joining us now is Candice Lang, President and CEO of the Canadian Chamber of Commerce. Candice, thank you so much for joining us this morning. It's wonderful to see you. I'd love to first just get your take on this huge turnaround and ultimate victory for the Liberal Party of Mark Carney's Liberal Party. What message do you think that the Canadian people have sent?
Well, thanks for having me first off. And I think, you know, as we know, Canadians saw this election as one of great consequence. And really, we ended up with the election timing in a very different economic moment than the country was in just a few months ago. So that meant the ballot box questions, you know, shifted with the onset of tariffs and really with the break in what Canadians have known for a long time in that stable relationship between the Canadian people and Americans. So I think at the core, you know, when people headed to the polls, there was this anxiousness looking for economic relief, both at the individual level for cost of living challenges, but now those challenges put in a broader context and external threat. So voters were looking not only for the policy that would support and bolster the Canadian economy, but also for the person they knew they wanted to send into negotiations with the Trump administration.
And of course, who is there in Ottawa makes such a big difference for your tens of thousands of members at the Canadian Chamber of Commerce, Candace. We heard there from President Trump saying that he's ready to make a deal with Canada. Mark Carney, both through his campaign and since securing, again, the prime ministership, has taken more of a hard line. Is that the tone that you think makes the most sense out of the prime minister?
Well, you know, I think what matters most, and I heard President Trump say this himself, is the conversations between the two of them versus the comments made, you know, by either of them, you know, during a campaign or to their constituents. And so I think we're happy to see that, you know, relations and discussions so far have had a positive tone. And I think we're just relieved, the Canadian business, you know, community, that we have a government now that's going to be back at work. We had prorogation, you know, January, March, and then headed into an election. So we've really had our parliament, you know, closed for business. And now we're just relieved that we can turn into real discussions, real negotiations about our critical trade relationship with the United States.
Well, Mark Carney, in his victory speech, said that the economic relationship with the U.S. is over in the shape and form that it had been. Is he correct?
You know, I would agree, but it's a broader aperture I would take on that comment, is that, you know, we are in a shift, a rebalancing of a lot of aspects globally. And so I think, you know, the best way, you know, forward is through to a new version that actually addresses some of the challenges, the irritants, the things we know that need to be, you know, serving global trade in a better fashion. And this is, Danny, where we head into not only Canada having discussions with the United States, but leading discussions for the upcoming G7 summit, and ahead of that, just in a few weeks, the B7 summit, where business leaders from all those same countries gather to talk about what's the best path forward for global trade. How do we address some of the irritants and struggles, and, you know, work with like-minded countries on some of those irritants and address non-market practices that we need to tackle together.
Well, China has certainly been pitching itself as a place that global companies, that global governments can turn to in the absence of the U.S. I know the Chinese ambassador to Canada made similar comments to that degree not that long ago. Do you think it would make sense to see stronger ties between Canada and China at this moment?
Well, with ties right now, it's very interesting because as Canada deals with many tariffs, we have the original border fentanyl tariffs, and we have sectoral tariffs, you know, from the United States as well. But there is an important third bucket of tariffs. I call them the boomerang tariffs, which are from China on Canada right now. And that's 100% tariffs on canola and peas and pulses, and 25% tariffs on pork and other goods. And that's in retaliation for Canada's alignment with the U.S. on EV tariffs and steel tariffs from last year. So I think right now Canada's receiving a very clear message from China, you know, if you align, you're in trouble if you align with the U.S. So it's a very interesting moment. And I think as we head into the G7 and B7 discussions, this is where we really need the U.S. administration to come help lead those discussions and that plan going forward on, you know, how do we maintain multilateral collaboration to address some of the concerns in the trade with China.
It certainly feels like Canada's between a rock and a hard place. But Candace, if we just look at American tariffs, U.S. tariffs on Canada so far, 25% on autos, aluminum, and steel, a similar one on Canadian exports that don't fall within the U.S. MCA. You represent many businesses in Canada. What has been the impact on them so far?
Well, the impact, even before the tariffs came into effect, just the threat of tariffs puts a chill across all business because of the uncertainty. How do you take decisions on anything when you don't know the impacts? You can't forecast. You can't issue your guidance with a level of confidence. And now I would say that shift has gone, you know, from a chill to a complete freeze for a lot of businesses. They're trying to hold off on layoffs if they can, but they're definitely holding off on decisions, you know, on investment and capital flows. So the impacts are great, but some of them are not as well seen as others. And so even though there's reprieve, with an extended indefinite deadline on the original tariffs of 25%, anything that would be CUSMA or USMCA compliant, we're finding businesses are scrambling because many hadn't done the paperwork to make sure they were CUSMA or USMCA compliant. It's quite a process from goods coming out of Canada, dealing with the rules of origin, and then those receiving those goods in the United States, making sure that all the paperwork is done to ensure compliance with our trade agreements. So there's all these knock-on effects from the tariffs, in addition to the obvious direct impact costs, whether they're being absorbed by businesses or passed on to consumers.
Well, Candice, I'm sure it has not been a quiet time for you so far this year. We really appreciate you spending the time with us this morning. Candice Lang of the Canadian Chamber of Commerce. All right, as we head to the commercial break, a quick check on markets boosted by what it hopes will be trade deals, Canada being one of them, potentially India, maybe Japan, South Korea, just some of the names floated by the Trump administration. We're higher by 1 1/3%. This is Bloomberg.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's get you set up for your trading day on this Thursday. We're going to get more earnings. CVS, Eli Lilly, McDonald's, MasterCard all have results before the opening bell. We'll get initial jobless claims at 8:30 a.m., along with ISM Manufacturing at 10 a.m., and Apple and Amazon will then report after the market close, which, by the way, Apple falling in the pre-market session this morning, down more than 1%. That contrasts with Meta and Microsoft and their strong earnings and commitment to CapEx above $70 billion for this year when it comes to Meta. Those shares up 6.5% and 8%. This was your Bloomberg Brief. Surveillance will take things from here.
number of games overseas in recent years. And in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
The S&P today is a very different animal than it's been historically.
U.S. assets are still a safe haven.
I see a lot of duration risk in the market.
A couple of hard data points are already enough to really drive us a leg lower in risk assets.
This is a global rebalancing from a very overweight position in U.S. assets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Welcome to May. April's finally over. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, and the new boss is blaming the old boss.
You probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in, and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
The economy contracting for the first time since 2022 as imports surge in the face of higher tariffs. The prospect of relief, exemptions and deals helping the equity market stage an end-of-month recovery. Entering May with strong earnings from both Meta and Microsoft, offering this market some support this morning. Both names are trading higher.
To me, this really is the story that is the next catalyst that can change the market dynamic. All of a sudden, American exceptionalism, as represented by big tech, has at least reared its head and made a slight comeback with the idea that Meta not only beat revenues, but also increased its expected capital expenditures, and Microsoft increased its estimate for its cloud computing unit. This is not a market that is dying or going away. It is continuing to expand. It is continuing to double down.
It's fair to say at one point it was in April. We were down by about 11% on the S&P 500. We ended the month last month down by 0.75%.
And if you take a look at the NASDAQ, it's actually up 1% on the month. So really, talk about a whipsaw that ended up with an outcome that, at least on the surface, looks fairly calm and fairly normal. The question is, how much has fundamentally changed in the meantime? Microsoft and Meta, we are not that exposed to tariffs, to some of the concerns. They are a software and advertising company. Apple and Amazon today, after the bell, incredibly exposed to the physical goods world as well as the international market in China. That will be a very different story.
China's certainly exposed. The rhetoric is changing. State-run media saying the U.S. has reached out to China for talks. Has the U.S. reached out to China for talks?
Well, clearly they have. I mean, state-run media is now acknowledging that. We've seen the behind-the-scene maneuvering. We've seen also individuals like Jamieson Greer have contact with his counterpart in China. I think what's so interesting about this post, you have to separate the signal from the noise. The noise is a domestic outreach saying things like, clearly the more anxious party at the moment is the United States. That's for domestic consumption. There is an olive branch in this post. If the U.S. wishes to engage with China, there is no harm in it for China at this stage. This is the olive branch Beijing is saying to Washington, we are ready for talks.
It looks like we're getting closer and closer to just that. In the meantime, the damage is being done, isn't it?
That's the reason why people responded yesterday to the idea that the backward-looking GDP print that Trump called Biden data, at the same time that people were looking at core PCE and how it came in at a higher pace. What you're seeing around the world and what we're going to see maybe with jobless claims and even more what people are looking for in non-farm payrolls tomorrow is how much is the pain that we're seeing already an implication from some of the changes in tariffs, and how much can you put forward look in terms of how much more to come?
Equity futures this morning positive by 1.3%, bouncing back again, driven by some powerful earnings from big tech in America. Coming up on this program, joining us will be Barbara Durant of BDA Capital Partners with stocks on a 7-day winning streak. Brian Gardner of Stifel as the Trump administration signals trade deals are close. And Stefan Slowinski of BNP Paribas Exane on strong results from both Meta and Microsoft. We begin this hour with stocks rising following better than expected tech earnings. Barbara Durant of BDA Capital Partners writing Q1 earnings are coming in solid as expected. It remains to be seen how much revenues, margins and earnings will be hit in the future. Barbara joins us now for more. Barbara, welcome to the program. It's difficult to get a clean read on earnings so far. One company tells one story, another company tells a different one. How are you getting a clean read on things?
I think it's very difficult right now because most companies are either not giving guidance or they're saying, well, we'll take I think you had Merck say we'll have a $200 million hit related to tariffs. So you still haven't seen earnings come down because people still don't know. The companies themselves don't know. And you see this reflected in all the so-called soft data, whether it's the consumer surveys, business. There's clearly hesitation and a pause until we get clarity. You know, and every day right now, the administration is talking about perhaps a deal with India. That's 3% of our imports. With Japan, that's almost 5%. So these things are drilling out, with the biggest one being China. That's one of our top 3 importers. So we still don't know. And the effects, I mean, right now, on that GDP, the final pull-through demand was about 3%, you know, which is good. But that was, as we have come to understand, is really because of all the forward buying ahead of the tariffs. You know, so it's interesting when Trump blames this on Biden, it's really a response to the tariffs, I think. So I think we have to wait and see. We haven't yet seen the impacts, you know, of this. And it'll be interesting tomorrow, the non-farm payroll, because what happens there, because yesterday, the ADP jobs number, which is private businesses, was half of what was expected. And it's not sometimes as correlated with that Friday number, but it could be the beginning of signs of softening.
This is the ultimate challenge right now, I think, Barbara, and I'm pleased you picked up on this theme, drawing a distinction between front-loading and genuine underlying demand that's sustainable through this year. And I think the same applies to both the data and to earnings too. How do you draw that distinction?
Well, I think that's a problem, because I think the earnings will come down as we start to get the data. I mean, the Fed itself has said, hey, we don't have enough information yet. We can't just go on, you know, on sentiment surveys, because we'll see how it translates into action. So, and they don't yet know if it's really going to be inflation. You know, it's a one-time hit, and you won't know that until time passes and this starts to filter through. I mean, we're already getting reports of the empty container ships, you know, the reduction in freight by, you know, 1/3, you know, out in the LA port, one of the biggest and important ones in this country. And so that has yet to filter through. And even there, we're not going to know for a few months because of all the forward ordering and buildup of inventory by retail, which it's hard to measure where all that is right now. But I think you'll start to see it in the next month or two. And then you'll be able to start to draw some conclusions and start to figure in real data. And I think you're going to see earnings come down after this report. Right now, it's a little bit of animal spirits. We've recovered half of our drawdown when the S&P was at one moment in April down 20% year to date. And so there was a lot of opportunities, but I think right now that recovery will have a strong day because of Microsoft and Meta, which were just great, really proved the AI theme, that it is alive and well. And in fact, with Meta, you know, what happens when you do invest, you really improve your products and have more pricing control. So those will be supports, and that will certainly help in the next few days in a whole basket of stocks that are related to AI. But after that, you know, the rest of the economy, you're going to start to see it filter through. So for me, it's a trading range. And you just have to be patient and wait for the moments when favorite names, high quality, long-term growth profile kinds of stocks, show you opportunities in terms of their valuation.
There's a lot to unpack there, Barbara. I want to just emphasize one point you were talking about, big tech starting to lead again. Is this going to be the contours of any kind of upswing in that trading range will be led once again by big tech?
Well, for a long time, people don't want it to be big tech because it's such a high percentage. But the fact is the technological innovation and change that's going on is very real and very long lasting. And so I think it's likely after this last 3 months, where they were really down in the dumps and you saw, some of these names like Meta, 30% off their highs. So, yeah, I think there's they should lead. I mean, these have sustainable earnings paths forward. And that's the kind of names that do lead in any kind of market.
So, Barbara, going forward, I'm just wondering how much the nature of the conversation is going to shift away from, say, some of the tariff volatility and going towards some of the taxes and questions around spending and how the offsets could be and how much this could potentially roil the bond market. What's your sense of how much the volatility in the bond market has at least quieted for now, but maybe going forward, not so much?
Yeah, I think that's an excellent question because right now you're starting to hear the Republicans are trying to change the conversation to, hey, we're doing these tax cuts. There's going to be deregulation down the road. But the tax cuts we're talking about are really mostly an extension of what's already there. So it's not going to be, under Trump 1, where you really did see a big boost to the economy. It was a nice sugar high, and it did have a good effect. But right now you're talking, they've got to balance some of the tax cuts they're talking about, whether it's no taxes on tips, no taxes on Social Security, without exploding the deficit even more. And that's why you're starting to see a little bit of talk about taxing the higher earners. Probably won't happen with this administration. But I think the tax cuts really are not going to make a lot of difference. You might see an improvement on the margin, but then what you're talking about in the bond markets, the deficit will probably be even higher projected out. And that is a problem. Plus, we still haven't seen the continual effects of other countries moving away a little bit on the margin from investing in the U.S., whether it's direct investment or central banks saying, well, can keep buying a little more gold. We are still the reserve currency. We are still, the American exceptionalism is there, but it's being tamped down, hopefully temporarily by, this tariff war.
Well, Barbara, when it comes to taxes, yesterday the president said something we haven't heard really from him in months, which is that if you produce or make your products in America, we're going to have a 15% corporate tax rate. Do you think that's really part of this negotiation? If so, how bullish is that for American companies?
Well, that would be bullish because obviously that improves the bottom line, attracts investment, but it's going to be hard to see how they balance that, particularly as we're heading into a probable slowdown. Just about every economist consensus out there is that the tariffs will produce a slowdown effect and also raise inflation. Whether it's one time or not, we don't know. So it's hard to see them get into the 15% because of the impact on the revenue collection.
Barbara, appreciate your time.
It would be a positive.
Got to leave it there. It's got to catch up. Barbara Doran there of BD8 Capital Partners. Really strong earnings from both Microsoft and Meta overnight, supporting this equity market. Lisa, later on this evening, we'll hear from Apple and Amazon.
And there might be a slightly different tone. We heard from both Microsoft, Satya Nadella coming out and saying that they're somewhat more immune to some of the volatility in tariffs. You heard the same thing from Meta. Can't hear the same thing from Apple. There's some big questions about moving production. And Amazon, also the de minimis, not to mention what they plan to do about how they signal price increases on some of their products.
I want to see how much front loading we saw over at Apple towards the end of the quarter.
Interesting.
As well, and how much they saw at the start of this quarter too. Equity futures on the S&P positive by 1.3%. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakos. Hey, Yahara.
Hi, John. Recapping those tech earnings, we start with Meta rallying this morning, up 6.2% after it reported first quarter revenue that beat and provided second quarter guidance in line with expectations. Meta also raising its CapEx and said it's responding to the trade war by rethinking suppliers and projecting higher costs for AI infrastructure. Microsoft shares also higher, up 8% in the pre-market after it reported stronger than expected quarterly sales and profit growth. Customer demand for cloud services held steady despite economic uncertainty, with the company's Azure cloud unit posting a 33% revenue gain in the quarter, with 16 percentage points attributed to AI. And Tesla's chair denied a report that the board looked into replacing CEO Elon Musk. Robin Denholm said directors were highly confident in his ability to continue executing on their growth plan. This after the Wall Street Journal reported board members contacted executive search firms to seek a successor for Musk earlier this year. That's your Bloomberg Brief. John?
Yahara, thank you. Dan Ives of Wedbush joining us later this morning on that story. Look out for that. Up next on the program, the president building a tariff wall.
There's going to be a tariff wall put up, and they won't be happy about it. It's going to get tougher, and then it's going to be real hard to do business in this country.
We need to talk about the they. We'll do that in just a moment. Brian Gardner of Stifel joins us next, live from New York City this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Seven-day winning streak on the S&P 500 over that period, up 8% in yesterday's session, wiping out a 2% slide for the first time since 2022 and finishing positive. We had some weight to the rally, up another 1.3% on the S&P to kick off the month of May. To close out April, the S&P down by 0.75%, the NASDAQ up by 1.52% on the month. Just absolutely unreal. And so surveillance this morning, the president building a tariff wall.
We're going to be getting tremendous amounts of drug and pharmaceutical companies going to be pouring into the country. There's going to be a tariff wall put up, and they won't be happy about it, but they'll be happy if they start building right now. Right now, it's going to be build, and after a certain period of time, it's going to get tougher, and then it's going to be real hard to do business in this country.
So here's the latest this morning. President Trump doubling down on his tariff plan as the trade representative Jamieson Greer says the administration is close to striking trade deals. Joining us now is Bloomberg's Mike Shepard. Mike, messaging matters. And when you start saying things like you can't have 30 dolls this year, you can only have 2, I wonder just where the messaging is in the White House at the moment.
Well, the signaling right now is becoming more apparent from the president. He is acknowledging that there is going to be some political pain in addition to the economic pain that he had already advertised previously. And since really taking office, he has talked about how his tariff program in the short term would have some turbulence for the economy, for consumers, for Wall Street. But now he's acknowledging that, look, during his News Nation interview last night, he talked about how he could even lose the U.S. House. And for him, he sees it as worth taking the hit. He is talking about building this tariff wall, and he is trying to encourage companies and consumers to get on the right side of it while they can, while these deals are still being negotiated. And he's indicating, along with Jameson Greer, the U.S. Trade Representative, that a lot of those deals are in the works now, that they have made substantial progress, in fact, with Japan, with South Korea, and even with India. Now, the timeline on those and when they'll be announced, that's a little murkier. Some were indicating, Jameson Greer was saying, hey, we could be doing something very soon. Scott Bessent talking about South Korea and how quickly and how much progress they have made in their talks. And yet Trump last night also was indicating, well, maybe not so fast. We want to make sure that we get the right deal, that they treat us fairly. And he even used his famous 2 weeks, John, to talk about how he viewed the timeline.
What's the status right now, Mike, when it comes to negotiations or contacts between Washington and Beijing?
Well, you know, Anne-Marie, this is the biggest question of them all, because with the world's second largest economy, we also see for the Trump administration their biggest adversary in this trade war. And China, compared to those other nations I just mentioned, is much further behind when it comes to engagement on trade. There really hasn't been much contact at all between the two sides. And there was even a kerfuffle during the IMF and World Bank meetings last week when there seemed to be some indication from Trump himself that the two sides had some sort of engagement, something that Beijing denied. And now we're hearing from China through state media that the U.S. may be making some entreaties to start talks. And that would contradict a little bit of the messaging here. We've been hearing from Trump and Treasury Secretary Scott Bessent that it's up to Beijing to pick up the phone. It's up to China to actually take the first step. But as you noted, Anne-Marie, this does seem like a little bit of an olive branch through state media from China that we're open to talking. We want to hear from you. We're ready to engage. Now, the question is with whom? And for China, they have to wonder who will be doing the talking and whose voice will have the upper hand inside the administration.
It's a roll in 2 weeks, as you know, Shep. It's a roll in 2 weeks. Mike Shepard of Bloomberg down in Washington, D.C. It's always 2 weeks away, right?
I mean, China's saying that if it's talks, the door's wide open. It's a fight. They're going to fight to the end. So there is a bit of an olive branch if they want to have a discussion.
Brian Gardner of Stifel with us around the table. Brian, good morning to you.
Good morning.
A little bit later this morning, we'll catch up with Binky Chandler at Deutsche Bank, and this is his call. 6150 on the S&P. He says that's going to be driven by a credible relent on tariffs, and that will be shaped by damaged polls. Is this president driven by polling?
No, I think he's driven by legacy. I mean, I think that's what drives everything with the White House right now. This is the second term. There will be no third term, despite the jokes about it. But Trump has been talking about tariffs and a restructured U.S. economy since the 1980s. This is it for him. This is a one chance to get this done. So the idea that there's going to be this massive pullback, despite the pause and everything, I think Trump believes this in his heart. Maybe there is some economic data, some market data that comes in later and causes them to recalibrate. You know, certainly everybody's thought there was a Trump put. I think we mispriced the Trump put to a large extent. Maybe it's still there, but I think at the end of the day, they're thinking about legacy.
Well, he basically said recently to The Atlantic that there's really no red line, no certain number that would pull him back and reverse policy. To your point, though, that he wants to see a global realignment, he talked about yesterday in this town hall the fact that tariffs are difficult to explain because he takes a maximalist approach to then bring it down. Do you believe he wants a full global realignment with some of the figures he has now, or he wants negotiated deals and terms?
I think he wants negotiated deals to get to that endpoint. That endpoint being that restructured global economy, whatever that looks like. And I don't know that he necessarily has a clear picture in his mind what it's supposed to look like, what he wants it to look like. I think at the heart, the current system, in his view, does not serve America well. And you can debate whether that's true or not. But in his mind, it doesn't serve America well. And so he wants to leave something that's better. And I think it's probably through a negotiated deal. How we get there is another matter.
So when it comes to China, what do you think this could look like? 'Cause I was talking to people yesterday in Washington, D.C., who are convinced that Trump wants a grand bargain, includes things like TikTok and other levers they can pull. What do you think that deal could potentially look like?
Yeah, I think I'm not sure what the deal looks like because I think it's a lot more complicated than people think it is. So, look, China takes a much longer view than we do. They think they can outlast us, that the pain threshold that kind of Jonathan was just alluding to, that it'll be so great in the United States that the U.S. is going to have to capitulate at some point. So they're going to wait on this. The other is, there's been this view in the United States that China has more to lose from this than we do. And if you look at the raw numbers, yes, that's true. They export more here than goes the other way. At the same time, the U.S. exports to Chinese exports to the United States are less than 3% than the overall Chinese GDP. That's a big number, but it's a manageable number. And if you take that longer view, you can start to restructure your economy and find other trading partners to at least partially fill the void. So I think this is going to. I think China is going to take much longer than people expect it to.
I want to build on John's line of questioning where he said, right now, it doesn't seem like the polls is really a check on the president, despite what a lot of people had expected. It doesn't seem like the stock market is the check on this president's policies. What is a check, potentially, on what he decides to do, and not just what he decides to do, but how he does it?
Well, I agree, the stock market is not a check. I do think what we've seen is that the bond markets and the broader financial markets are a check. And I think you have the Secretary of the Treasury talking to the president and warning him about economic repercussions if he keeps going down in certain lines on trade policy. I think that's why we got the pause. So there are some checks. Again, we probably have mispriced all of this, right? The checks are still there. They're at just much different levels. What that level is, we don't know until we know. It's impossible to say, but his poll numbers have deteriorated over the last couple of weeks. The honeymoon seems to be over. Very interestingly enough, this is lining up pretty much with the same timing that President Biden saw his honeymoon end when we had the problems with Afghanistan and a few other issues in April of 2021. Maybe there is some level at which further poll deterioration causes the White House to rethink this. And, because the president's not running again, he's a little bit immune to polls, but at some point does the vice president step in? Because obviously the vice president is going to want to succeed. And how much sway does J.D. Vance have with the president? Because clearly he is looking towards 2028. Donald Trump's not.
He's got to. That's a huge question. Brian, it's good to see you, sir.
Thank you for having me.
Gardner there of Stifel. That weekend, halfway through April, the Air Force One indicator, as Anne-Marie called it earlier on in the last month, the person standing behind the president that weekend was not Howard Lutnick, the Commerce Secretary. It was the Secretary of the Treasury. It was Scott Bessent, and the jitters around the bond market did seem to reshape the approach to this story.
The yippee behavior in the bond market seems to be the ultimate test, which actually might be an interesting thing to look at, given that the discussion is shifting to tax cuts. And can they really do some of the tax cuts, the no tax on tips, the bigger SALT tax deduction? Can they do that without causing some sort of reaction in the bond market?
That weekend was critical for me because the way down, Howard Lutnick was standing by the president, and then I peeked my head out. And the way back to Washington, D.C., it was Treasury Secretary Scott Bessent. What have you seen? Since Scott Bessent has been talking about trade, markets have been going up. When Howard Lutnick and Peter Navarro go out, markets go down.
And the Treasury Secretary's been front and centre. Bond yields are lower by a couple of basis points this morning. Up next, the equity market is higher, and it's driven by two names, Meta and Microsoft. The latest on the earnings with Stefan Slavinsky of BNP Paribas Exane. From New York, this is Bloomberg.
Today, CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Equities firmer this morning, higher by more than 1% on the S&P 500 to kick off a brand new month of May. On the S&P 500, we're powered by earnings from Meta, from Microsoft, later from Apple and Amazon. With the latest, your morning movers this morning. Here's Danny Berger. Hey, Danny.
John, I want to show you exactly what the move is in these tech giants, because it is sizable this morning. Microsoft, the best performer on the S&P 500 pre-market, up 8.8%. Defying the gloom, it really was their Azure business, their cloud business, doing so well on AI demand. Satya Nadella also putting to rest that those stories about them pulling back on data centers, that has anything to do with them pulling back on spending. In fact, he pointed out that they signed 10 new data center leases over the past quarter. Meta, also another really strong set of results. Beat on this quarter, it beat on its forecast. Again, any of the economic concerns, the tariff concerns not hitting them. Zuckerberg saying we are well positioned to handle that macro uncertainty. Those shares up 6.4%, and a huge raise in CapEx. $72 billion is what they'll spend this year. Qualcomm, though, has signed that not all tech is created equal. The big chip maker for smartphones, shares down 5.7%, a really tepid forecast. That's what it came down to. Look, they're really caught up in the crosshairs of the trade war, considering China is their biggest market for chips, saying in the earnings call that so far their earnings haven't been impacted by tariffs, but their ability to predict the future, they just can't do it, John.
Danny, thank you. Got some big news right here, some breaking news. General Motors, potentially a $5 billion hit to earnings only 2 days ago, suspending guidance. Here's the update from them. The new outlook for earnings, the guide, $10 to $12.5 billion range for the year. That at the start of the year was as much as $15.7 billion US. It's an update, and it's a major tariff hit.
It is an update even after some of the relief that President Trump provided in terms of having a delay to the start of some of these 25% tariffs, which highlights that they still expect a pretty big hit. They say that we look forward to maintaining our strong dialogue with the administration on trade and other policies as they continue to evolve. So there still is an opening for some sort of negotiation. Interesting to see the shares not necessarily taking a huge additional hit, which raises the question, how much is some visibility, even if it's not great, better than no visibility at all?
Mary Barra this morning saying we'll continue to be nimble and disciplined and keep you updated as we know more, and they don't know enough.
They don't know enough, and to Lisa's point, this comes after even there was some reprieve. At the same time, automakers still face that original 25% duty on imported vehicles. Hurts GM because they have plants in Canada, in Mexico, in South Korea. That is why these auto executives are not just calling the White House daily, full court press in the White House in terms of any sort of tea leaves and what's going to happen, but they are keen to know what the deals look like. Is USMCA going to be brought up forward in terms of negotiations? Will there be a deal with South Korea? Will there be a deal with Japan? The same information we have, the auto executives have, and that is why it's been hard to have guidance, and that's why they're cutting.
It's been a big cut to the outlook from GM 2 days ago, suspending guidance. An update this morning, a new range, 10 billion to 12.5 billion. At the start of the year, that number was higher by about $5 billion US. For the latest on General Motors, Bloomberg Craig Trudeau joins us now from London. Craig, welcome to the program, sir. Let's just frame the moment for this company, what things look like at the start of the year, how they've changed and how they've changed in just a few days.
Yeah, I think coming into the year, GM was really doing well on the sort of old school business of selling big pickups and SUVs. It was getting things figured out in terms of its electric vehicle operations. They really struggled to kind of hit their numbers in the early goings and had issues with scaling up battery production. They had started to work out the kinks there, and things were looking good coming into this year. I think. The dramatic moves that this administration is making, I think, is taking everyone off, catching everyone off guard in Detroit, because I think there was, of course, some expectation that tariffs were coming. I think it's a shock that these are applying to Canada and Mexico, and also that the administration, we've talked a lot about relief, but for this industry, we're talking about relief from really dramatic measures, and the sort of walk back is only, quite incremental. And so this really just sort of draws a line under what, Ford was saying just yesterday, which is, thank you, Mr. Trump, we appreciate this reprieve, but more work needs to be done.
These are financial changes. This is putting numbers, a price on the story. What are they doing at the operational level, Craig? What have they changed in the last few weeks, the last few months?
They've made some incremental changes and some incremental investments in terms of, adding a shift here or deciding to hire workers at particular plants. I would suspect that there's more to come there, that we will see manufacturers sort of bend to what the White House is pressing these companies for, which is more investment, fill the plants that you have here in the U.S. It's not acceptable anymore to underutilize your capacity. But that's all going to cost money, right? It costs money and it costs time. And I think if you're Mary Barr, you have to sort of get your arms around what's it going to take. She could announce tomorrow that they're going to make, a change at this plant, that plant, and the other. But if that's not going to be sufficient for this administration, then she's kind of back at square one, and investors aren't going to be particularly happy about the sort of scattershot planning on the part of the company.
Well, Craig, is it on the table right now for GM to potentially move the manufacturing of some popular models to the United States?
I guess just surface level, sure, they could try to do that. In terms of, the specifics, it's just not that easy, right? One can't snap their fingers and line up, the thousands of workers it would take to, add a shift, let alone, say stand up an entirely new factory. Ford announced a few years ago that they were going to make electric pickups down in the South and in the Memphis area. And it was a few years later, they're still standing up that production and lining up the workers for it, arranging for a supply chain that is needed to support that assembly plant. This is an industry that, even a company like Tesla that moves fast, it takes time to stand up manufacturing capacity. And, I think, speaking of Tesla, Musk on the conference call just last week was talking about, not being able to get manufacturing equipment from China as a result of tariffs. And so, even if you're a company that wants to make these investments, can you do that if the equipment that you need to put into, say, a new facility no longer can be procured affordably?
Craig, appreciate the update, sir. Craig Trudeau down the latest with General Motors. If you are just joining us, welcome to the program. It's a change for GM. 2 days ago, suspending guidance. An update this morning, a new range, 10 to 12.5 billion. The number we had at the start of the year was higher than that by about $5 billion US. Lisa, how do you change your CapEx plans when the rules of the games could change? A week from now, a month from now, a year from now, 2 years from now. They're saying this morning the capital spending plans for the year basically unchanged, still seeing them at around 10 billion to 11 billion.
Policy needs to have a long long-standing kind of trajectory for some of these companies to be able to really invest with any conviction. And there is a sense that possibly things could change again, so they are reluctant to really make massive investments one way or another. They are also reluctant to lose market share. We saw this from Ford, waiting to see whether they were going to raise prices, to see whether competitors did the same. You can get a sense of that macro paralysis, as you keep raising, which is correct, which is the line coming from Jim Zelter over to Apollo.
Jim's line, not mine. I won't take credit for that. GM this morning, negative, as Lisa pointed out, just a bit softer in the pre-market by 0.4%. The power for this market this morning is coming from these two names, Meta and Microsoft, surging in early trading after the tech giants beat top-line estimates. Stefan Slowinski of BNP Paribas writing the following: "We see Microsoft as the hyperscaler that is sprinting the fastest towards delivering Gen AI ROI, and investors will likely continue to cheer Meta as long as it delivers revenue beats, but risks are greater." Stefan joins us now for more. Stefan, welcome to the program, sir. Let's talk about those risks with Meta. Why are they greater with that company?
Yeah, both companies clearly delivering here, Jonathan. In Q1, really impressive, 15% growth for Microsoft, beating the high end of their guide, 20% advertising revenue growth for Meta. But looking forward, as you point out, obviously Microsoft has much greater diversification. So you've got the enterprise cloud business, you've got the SaaS businesses, you've got the OpenAI relationship. So lots of different ways to monetize AI. That's the same for Amazon, it's the same for Google, because they've successfully diversified those businesses into enterprises and into subscriptions. Meta is absolutely executing very well, but it is still 98% advertising. So that's what they're going to live and die by as they go forward here. And as they see CapEx grow by 80% year over year, as they push more into AI and Gen AI.
Did we learn, Stefan, that software providers are at a uniquely beneficial moment right now because they are somewhat less exposed to the tariff turmoil that other companies like Apple, like Amazon, maybe are more susceptible to?
Yeah, absolutely. And that's why we've been preferring enterprise software where you really don't have any direct tariff risk. Also, they have a lot of exposure outside the US where demand trends remain quite favorable. We've preferred enterprise software to internet, where advertising is at risk from more of a macro slowdown. We haven't seen that yet in Google and Meta. And clearly, even in tough times, advertisers gravitate towards those platforms. So they do benefit to a certain extent. But if macro does weaken, you will see that more. And then, as you point out, as we go down that spectrum into e-commerce, Amazon's going to be more kind of in the eye of the tariff storm, and then into hardware. You mentioned Apple tonight and other hardware names. So certainly the software side of things seem to be the most safe in this environment.
What does it say, though, Stefan, about the fact that Meta increased its capital expenditure plan and that you saw, even with a small decline in the expenditures in the third quarter for Microsoft, this commitment, this sense that demand was still outstripping supply when it comes to artificial intelligence and cloud computing? What does that tell you about the longevity of this AI trade and maybe whether it has been overestimated or, over the past couple of weeks and months, underestimated?
Yeah, AI is alive and well, and Gen AI is happening. So, that's something we keep seeing. Just yesterday, I was at Amazon Web Services Summit in London, talking to partners, talking to customers. We're moving from proof of concept into production. So AI is happening. We've had the question this year from investors, how much of the pullback in some of these big tech stocks is kind of macro-related and multiple compression? How much is disappointment in AI? Clearly, we think it's the former. And we've seen multiples compress. So Microsoft, for example, started the year at 34 times forward earnings, quite pricey, but it's now pulled back around 27, 28 times, more in line with its average. Same thing for Meta. We've seen a pullback there, more in line with their averages. So I think now that we're getting confirmation that AI demand is alive and well, now that we see valuations having pulled back, and finally we're starting to get some earnings upgrades, let's see if they last. But that's the magic combination that's driving those two stocks higher today.
When it comes to policy, Mark Zuckerberg yesterday on the conference call said we're well positioned to navigate the macroeconomic uncertainty, AKA all the policy changes we're seeing in Washington, D.C. Who is most immune to those policy changes?
Yeah, I think when it comes to policy and geopolitics, it's kind of a revolving door where each of these big tech companies, kind of gets its time in the sun in terms of attention from regulators. Microsoft seems pretty immune to me. They just announced yesterday a major investment in Europe and trying to appease European governments and regulators around sovereign cloud. I think Meta is maybe a bit more risk. They, if there is one ointment in last night's results, they did call out that in Q3 they could start to see a negative headwind to their operating results as they have to change their services to appease to the European Digital Markets Act. So we're going beyond just fines, and potentially they're going to have to change actually how they deliver their services, which could impact their numbers. They did flag it's only 16% of revenues that they get from EU-based advertisers, but they seem to be obviously more at risk on the European side and obviously with the FTC trial in the US.
It's a space to watch for sure. Stefan, appreciate your time, sir. Stefan Slavinsky there of BNP Paribas Exane. Those two names up nicely in the pre-market, the equity market up nicely as well. Positive here by 1.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Hacker. Say, Yahara.
Hi, John. We start with General Motors. It lowered its full-year profit outlook, citing exposure to as much as $5 billion in auto tariffs. GM's lowered guidance comes even after Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. Meanwhile, Citigroup has hired former Trump trade czar Robert Lighthizer to advise the bank and its clients on how to navigate the president's trade policies. The Wall Street Journal reporting Lighthizer started working for Citi earlier this year and has already traveled to several countries to meet with clients. And a federal judge ruled Apple violated a court order by not opening its App Store to third-party payment options. The judge referred the case to federal prosecutors to investigate if Apple committed criminal contempt of court for ignoring her 2021 ruling. It must now make changes that could sizably dent its App Store revenue. Apple reports after the bell. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, the new boss, blaming the old boss.
Probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in, and I was very against everything that Biden was doing in terms of the economy.
That conversation up next. Jonathan Pingle of Natixis joins us from New York City. You're watching Bloomberg TV.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, We'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good earnings from Meta, from Microsoft, powering this equity market this morning. Good morning to you all. Equity futures up by 1% on the S&P, up by almost 1.7 on the Nasdaq 100. General Motors in focus this morning. GM in the pre-market doing okay. The numbers look like this. We're up by 2.5%. The outlook, 10 billion to 12.5 billion. That's the new range for earnings for this year. It's a cut. At the start of the year, the number was $5 billion higher. Only 2 days ago, suspended guidance. We got the update just moments ago.
And they're saying that this is all because of the tariff plan. There's a 25% tariff right now for the import of auto vehicles. At the same time, Mary Barra, in her letter, the second sentence, we are grateful to President Trump for support of the U.S. automotive industry. Well, is he supportive of it, or is it the reason why you have to lower your guidance?
Okay, this is basically the classic McKinseyism. Listen, yes, all good. This is great. We're just going to cut our guidance by $5 billion and see. We're going to ongoing negotiations. Of course he's going to say this. How else is he going to message this? What I find interesting is the market's reaction. That even worse guidance is better than no guidance right now at a time when everyone has no visibility.
Are you saying they needed 48 hours to get the consultants in to come up with a way to write the letter?
I think that they needed 48 hours to see what the actual policy was, what he put out there, and then essentially the response of saying, like, look, this is terrible for us, but we're so grateful, thank you.
Maybe they took a note from what happened to Amazon and thought, I'm going to actually use a little bit better language, put it out there in the open, and maybe we'll actually get some deals across the finish line.
These companies believe this is just the start. The rules will change again. And they could change a week from now, a month from now.
Well, honestly, this is something that we keep talking about with people who do infrastructure spending or any kind of CapEx. You need policy to be consistent for a longer period of time. It almost matters less what exactly the details of that policy are. But if you don't have a sense of what it's going to be in 2-3 years, why are you going to commit billions of dollars to building a plant?
You can't make plans. Right now, the stock is higher by 2.3% in the pre-market. Under surveillance this morning, the new boss blaming the old boss.
You probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
So here's the latest this morning. President Trump dismissing a weak GDP print as investors await April payrolls tomorrow morning. Jonathan Pingle of Natixis writing, we estimate that non-farm payrolls rose by 140K. We are unlikely to see the brunt of the effects from the administration's recent policy actions in April's employment report. Jonathan joins us now for more. Jonathan, good morning.
Morning, Jonathan.
Give us the clinic then. Why is it too early to see this?
I mean, every indicator of consumer demand that we've seen so far in April has been decently strong. Retail sales kind of was easily maintained, layoffs remained low, job openings were still somewhat elevated compared to what we've been seeing, even though they're cooling. It does not look like this is where the tide kind of broke.
How useful is ADP?
As a predictor
As a read-through into
payrolls?
NFP?
No, it's not
Useless.
useful. Yeah. It is, I think, an interesting and useful indicator of the labor market as a whole. The Fed at various points has put a weighted indicator of ADP and non-farm payrolls to look at it together. But no, it's a poor predictor of payrolls.
During the year of April, we had a lot of different kinds of mood swings and senses of what was going to happen in terms of growth, in terms of inflation, in terms of deals, in terms of tariffs. And there is this question of how you come up with a forecast in all of that. So as someone who has been an accurate forecaster in the past, how are you doing it?
I mean, it's challenging. I was in Europe for investor meetings a couple weeks ago. And it was on April 9th that I flew out, and we printed out the slide deck that morning, and by the afternoon, I had to redo the whole thing. No, you go back to the basics, you look at the path of the monthly data going forward, you look and see where you see the pass-throughs and how that comes, and you end up making a path from there. It's really interesting looking at something like payrolls right now. You commented, I think on Twitter the other day, that it's weird talking about the weather. It's kind of really nearsighted doing this type of conversation. And when you're doing a forecast for April payrolls, it's like, ooh, March was really, really warm. It's not going to be as much this month. And it does feel nearsighted. It doesn't feel like this is the outlook for the economy. And we actually don't even think it'll likely slow down that much until mid-late March or mid-late May, in which case the first data you're really going to see that might be pretty negative or poor is kind of June.
You've been traveling around the world talking with clients. It comes at a time where it seems like the market has shifted away from thinking that the rest of the world would suffer more greatly than the United States when it comes to tariffs. And now the pain might be uniquely focused in the United States and the rest of the world is doing better. What you saw, did it confirm that kind of feeling that you're seeing in markets? Is it reality?
I mean, the sentiment abroad is certainly much more negative than it is domestically. I think there's this somewhat decent consensus in the United States that we're at peak tariff, that this is going to be walked back, that somehow this resolves itself a little bit better in a few months. That is not the case when you're looking at it abroad. And I think you see that especially in inflation expectations, right? Inflation expectations domestically are that it'll eventually kind of come back. The five-year looks pretty decent. Like 5 years, even just inflation swap look decent. There is not the pricing in Fed funds. There's not this idea of we're going through an inflation shock and the Fed's going to have to respond to that. The idea abroad is the opposite, right? Like that these tariffs are here to stay. We have to learn how to manage it, and we have to learn how to adjust to a very uncertain U.S. policy.
Isn't that interesting that they think they're here to stay, given the fact that the administration is very consistent, at least with everyone barring China, that they're going to get deals? How much clarity do you need on China, that one specifically, that 145%, in order to have really positive or accurate forecasting?
It's hard. I mean, I think one of the things you go back to like really basic indicators, like, how many different containers are arriving to LA ports? Like, you go back to these COVID indicators of supply chains, right? And, Torsten Slok's done a lot of good research on this. I think one of the more interesting parts is that you're actually looking to see a pickup in scheduled orders there late May, in which case, at some point, firms were like, all right, there's so much uncertainty, we're not going to submit new orders. And then you're like, let's just try passing these costs through. Let's submit the order, and let's see what happens. And that's when you should start seeing some changes in prices and eventually these tariffs biting.
That's the process I'm interested in. When you frame this for clients, do you talk about it as a one-off event, a shock, or do you describe it as a process that's beginning over the next few months?
I mean, the overall bulk of U.S. policy changes that has happened over the past few months is increasingly negative for U.S. growth, both in the short and long term. I think investors are concerned both about the short term, what you're doing, and how this looks for the U.S. for the next 5 years. And there is a lack of confidence in the administration and the ability for that to be rectified.
Jonathan, it's good to see you.
Good to see you as well.
Fantastic as always. Jonathan Pingle there over the Texas. The latest on the economy and the economic data. Here's the latest on the earnings and the guidance. Harley-Davidson, the latest company here, Lisa, withdrawing their outlook for 2025 because of, guess what, the tariff situation and macro conditions.
Well, and let's just be clear, Harley-Davidson has been uniquely targeted by the likes of Europe as one area to go after because of its southern base, and or Midwestern base, actually, but also its presence in red states. I just wonder how much we're going to see this and how much it's going to get punished in markets.
We're seeing a lot of it. That's the latest in corporate America. Up next on the program, we'll catch up with Binky Chadha of Deutsche Bank, the former Deputy National Security Advisor to President Biden, Dalip Singh, Lauren Hochfelder of Morgan Stanley Real Estate Investing, and Terry Wiseman of Macquarie from New York, the second hour of Bloomberg Surveillance. Up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
A lot of companies are quite uncertain about where things are going.
We gave too much credit to the resilience of the economy.
Undoubtedly, we're going through a period now where it's not just the soft data, it's the hard data.
The direction of travel certainly is in the direction of stagflation.
The reality is this is a stagflationary shock.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P adding some weight to the rally. A 7-day winning streak on the S&P 500, again, over that period of 8 percentage points. Futures up across the board, up by 1.7% on the NASDAQ 100, helped out by this. Really decent earnings from both Meta and Microsoft. The two of these names higher in the pre-market by more than 5%. Microsoft up by close to 9%. Check out GM. General Motors this morning offering an update to the guidance after suspending it only 2 days ago, and the outlook isn't great compared to what the outlook was at the start of the year. The outlook at the start of the year, they were looking for something close to 16 billion. Now it's something like 10 to 12, Lisa, for that company.
Yeah, saying that they're going to take potentially a $5 billion hit from the tariffs and some of what they have already seen from the president's policies. This comes 48 hours after withdrawing guidance. I want to just note that GM shares are up about 2.5% in pre-market trading, which is notable. Maybe some guidance, even if it's negative, is better than no guidance. We keep seeing this. People who have some visibility at a time of such uncertainty seem to be rewarded in markets, even if that visibility isn't great, as long as it's not coming from some fundamental weakness that they're just trying to blame it on tariffs.
Corporate America, the markets, they just want to know what the rules of engagement are. And at this moment, you have an administration that's actively talking about that they're very close to clinching these trade deals. You don't know specifically what the tariff rates are going to be. What I find just almost funny about what GM is doing, they're saying they're going to take this $5 billion hit. The second sentence in this letter is, we are grateful to President Trump for his support of the U.S. automotive industry, yet they're blaming Trump for the $5 billion hit because they don't know what the tariff picture is going to look like.
AKA would like some more help. So let's talk about where the help might come from. China. talks potentially on the table. Help us understand where things are. State TV, just yesterday, putting out a social media post suggesting the United States was looking for talks.
I think this is an olive branch from Beijing. There is some hot rhetoric in it that will be interesting for the domestic audience in China, but it goes on to say if the U.S. wishes to engage with China, there is, quote, no harm in it for China at this stage. What they are saying is we are hearing you, we are seeing this contact, and we're willing to engage, and maybe we'll see actually talks. And the talk will be an actual phone call between Xi Jinping and Donald Trump.
Meanwhile, where is the damage being done? It's difficult to get a read on the U.S. economy right now. Later this morning at 8:30 Eastern Time, you'll get another read on the labour market, jobless claims ahead of payrolls tomorrow. Right now, you're getting another read on the U.S. economy through a very important company, McDonald's. Those numbers just drop in.
Yeah, and the sales miss comes out with comments from the executives saying that essentially this is a deeply concerning moment. Consumers today are grappling with that uncertainty and spending less. They saw the largest U.S. same-store sales decline since 2020. He said that he did believe that McDonald's has the ability to navigate, quote, even the toughest of market conditions and gain market share. That said, McDonald's is uniquely exposed to a lower-income consumer and middle-income consumer. What does this say about how much some of the ramifications are already being felt throughout a number of different groups in the United States?
And they were squeezed under the Biden administration, and the worry is they'll be squeezed even more with these changes to trade policy, at least in the near term. Equity futures on the S&P 500 positive here by 1.2%. Coming up this hour, Binky Chadha at Deutsche Bank looking for stocks to kick higher from here. We'll catch up with the former Deputy National Security Advisor to President Biden, Dalip Singh, and Lauren Hochfelder of Morgan Stanley on real estate investments. We begin this hour with stocks higher. The S&P 500 posting a 7-day winning streak. Binky Chadha at Deutsche Bank writing, our base case remains for a significant rally on a credible relent on trade policies with a target of 6150 by year end. Binky, good morning. Good to see you, sir.
Good morning, John.
6150, the new target. It's down from 7K. Let's deal with the language there. A credible relent on trade policy. What does that mean to you?
So, you know, it's meant to capture an idea, and it's about convincing the market that you're sort of done with the trade policy issue. There is a huge amount of uncertainty about the different ways that can be done. And at the end of the day, given where we are, you know, I expect it will be kind of mushy. I don't have a better word than that. So some trade deals, perhaps some lowering, the big question mark about the 10% uniform tariff, because by the uniform tariff that we have put on ourselves, we've hurt U.S. growth more than we are hurting anyone else.
Lisa asked the question where the pressure would come from. Where do you see the pressure coming from? What drives that credible relent?
I think at the end of the day, it's the same thing. So when you think about presidential elections, you know, we've all heard it's about the economy, stupid, in the sense that other things matter, but it's mostly about the economy. And so I would argue it's presidential job approval ratings. And because, you know, if you think about if the presidential election is about the economy, and then you ask people, you know, where do we ask people, how do they feel about the economy? It's consumer confidence. So the typical pattern is new presidents start with hefty sort of goodwill of a honeymoon period of high approval ratings. The honeymoon then tends to wear down, and the question is, where do we land? We land at levels that are basically, you know, dictated by consumer confidence, I would argue. Happened the last two administrations. And so, you know, we are midway in that process. We started up here, we've been coming down, and the trajectory right now. And I would just remind that current consumer confidence levels, you know, suggest that you might get down to 30%. And so I think there will be a reaction long before.
Yeah, there's some pretty negative soft data that have been coming out. You talked with us when you had still a 7,000 rating, 7,000 target on the S&P 500, saying it was a matter of time. Mm-hmm. And if this uncertainty didn't get resolved, you would have to bring your forecast down, which is part of the reason why you did bring your forecast down. Right. Now there is a question of how much longer can this go on before you bring it down again, before you cannot put the toothpaste back in the tube, you cannot put the genie back in the bottle, pick your potential saying. How much are you looking at that?
Very much. I mean, I think that, you know, the risk is that the relent that we were talking about comes basically too late and the nonlinearities of recession kick in. I think one has to be honest, which is that it's just very difficult to gauge what the impact of the tariffs is going to be. And by that, I mean, I think they're clearly negative for U.S. growth. They're very negative for U.S. earnings. Precisely how much is the question. I mean, on a 12-month basis, we calculate that the impact would be $56 of U.S. S&P 500 EPS. And just to put that number in perspective, last year we had $250 of earnings. So if you're talking about $56 hit, that's a very large number. It's a very large number by any standards. And so, yes, the nonlinearities of recession can kick in and the relent might come too late. But, then you have to think about basically, okay, so if we're going to go down, maybe we have a recession, getting a recovery from a supply-side recession doesn't fit the typical playbook. So it's something that will have to be, seen and worked out, basically.
Do you get the sense that big tech is going to lead this charge? That is essentially what we have already seen from both Meta and Microsoft, as well as Alphabet last week, that there's sort of a resurgence in faith in U.S. tech that can bolster some of the pain that you might see elsewhere from the likes of McDonald's or GM or some of the other companies that are more hit?
Yeah, what I would say is, earnings are basically saying they're hanging in right now, and earnings are fine. But again, this is about, this is about yesterday, not about tomorrow. And the question is, what happens tomorrow? So, our take is that earnings growth for the first quarter currently, looks like it's coming in around 10% year on year. That could drop to basically zero in the second quarter that we are in, and then basically turn negative on the baseline view that the announced tariffs all come into effect and stay. I mean, it's just, if you think about the numbers, they're just, horrendous.
Binky, you talk about this relent. What's the level? What's the destination you think we're going to get to in a base case scenario?
I don't know is the honest answer. I think it's all getting worked out dynamically, and so the circumstances and what happens, so it's data dependent, to use a bad term.
So you think it's politically driven?
It's a question of, yeah, I think it's political. Yeah.
So basically they have till November 3rd of 2026.
The midterm elections start a lot earlier, and I would argue, the clear and present danger is to approval ratings. They have, sort of predictable consequences on your ability to govern. So we shall see.
Binky, we shall see. It's good to get an update from you. Thank you, sir. Appreciate it. Binky Chowdhury there of Deutsche Bank on the equity market. Looking ahead to more earnings a little bit later on this afternoon. You will hear from Apple and from Amazon. Equity futures at the moment positive by 1.2% on the S&P, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hecker. So, Yahara.
Hi, John. The U.S. and Ukraine have reached a deal granting the U.S. privileged access to new investment projects to develop Ukraine's natural resources. The agreement creates a fund to attract global investment into Ukraine, with the U.S. getting first claim on profits transferred into the fund, which will be jointly managed by both nations. And General Motors lowered its full-year profit outlook just 2 days after suspending earnings guidance. The company now citing exposure to as much as $5 billion in auto tariffs. GM's lowered guidance comes even after President Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. And Morgan Stanley is planning to add crypto trading to its E-Trade platform. The firm is looking into partnerships with established crypto companies to allow clients to trade Bitcoin, Ether, and other tokens. The move would mark the most significant action from a major U.S. bank to help everyday investors buy into the asset. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the president downplaying the price of tariffs.
Somebody said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, and maybe the $2 will cost a couple of bucks more than they would normally.
Up next on the program, reaction from the former Deputy National Security Advisor to President Biden, Dileep Singh. Dileep joins us next from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Close to session highs in the equity market on the S&P 500 up by 1.2%, on the S&P on the Nasdaq up by 1.8%. Under surveillance this morning, the president downplaying the price of tariffs.
Somebody said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, you know? And maybe the $2 will cost a couple of bucks more than they would normally. But we're not talking about something that we have to go out of our way. They have ships that are loaded up with stuff, much of which, not all of it, but much of which we don't need.
Here's the latest this morning. The president downplaying the price of tariffs with corporate America pushing back. GM joining the long list of companies to slash its outlook, citing higher levies. Bloomberg's Mike Shepard joins us now for more. Shepard, welcome back to the show, sir. Mike, I want to talk about this. The pressure coming from corporate America, the cut to the outlook from GM, the softer numbers we just saw from McDonald's. How sensitive, how responsive is this White House to the pushback that they might be getting from corporate America?
Well, so far, they have not been convinced or swayed by any of that sort of pushback. You heard the president just talking about this in terms of dolls, but really the warning that we got from GM about the cost of tariffs signals that it is something far more than just low-cost commodity items coming from China. For instance, the main adversary in Donald Trump's trade war. Really, it is across around the world. Supply chains globally are being affected by this. And the risk for companies is that their costs are going to increase because of the components that are coming in. We also saw Harley warning of increased risk and inability to project further because of tariff-related costs. Now, whether the administration is going to start heeding these calls is a different question. GM and other automakers have already been lobbying the administration extensively for changes to the autos tariffs and for some sort of a reprieve. And they already got one on Tuesday before the president's trip to Michigan. We saw him sign an order giving them a little bit of a break on, I guess, a reimbursement, if you will, on tariffs that are imposed on imported parts, the ones that they would need to assemble cars here. But imported cars, which GM imports from Mexico, from Canada, and from South Korea, fully assembled, those are still subject to the full 25% tariff. And that is a big hit to their bottom line, John. And it's something that the president and his team will have to start paying attention to as they enter into these negotiations with other trading partners.
Mike, when the president talks about dolls, he's talking about access to cheap consumer goods. And obviously that talks about China. He said yesterday that that's a very good chance he could strike a deal with China. But he said he wants to make it on our own terms, and it's got to be fair. How long is it going to be for this administration to bring 145% tariff level down when it comes to Beijing?
Well, it will take a long time. The two sides really have to, at first, you were talking earlier about a call between Donald Trump and Xi Jinping. Before that even happens, you need to have lower level advisors make that first contact, have those initial discussions. And getting a trade deal done, as we have observed over the years, is not something that you do like speed dating, as we, in a way, are kind of seeing here with all these other trading partners around the world. Talks happening with India, with South Korea, with Japan, with the European Union, which is going to present its proposal to the U.S. next week. Now, all of this is unfolding at the same time, and trying to reach a complex trade accord with China, which is really smarting from all of the trade pain it is feeling right now from the U.S., is going to take some time. It's complex. China also wants to bring in issues like Taiwan and some of the tech-related export controls that the U.S. has been imposing over years. So it is going to be a delicate dance with Beijing, but also with all these other trading partners around the world, Anne-Marie.
Hey, Shep, appreciate your time, as always, from the nation's capital, down in Washington, D.C. I'm pleased to say that here in New York City, joining us around the table, the former Deputy National Security Advisor to President Biden, Dilip Singh. Dilip, good to see you. Now the Vice Chair, Chief Global Economist, and Head of Global Macroeconomic Research at PGIM. That's quite a title.
You can just call me Dilip.
Happy just to call you Dilip. Dilip, let's get to this. How are you framing the next 12 months for clients? Never mind the next few weeks of economic data. What does the next year look like for you?
You can't get past the economic war we're in with China. Look, I mean, this is the world's undisputed trading and manufacturing superpower. It has unrivaled production scale. I mean, don't forget the lesson of the 1940s. Scale is strategic leverage. Okay, we're not just talking about dolls or furniture or bicycles or underwear. We're talking about goods that are critical for our economic security, our national security. So think about steel, cement, robots, drones, chemicals, pharmaceuticals. This is going to be a blinking contest. And in my opinion, we need China's supply at least as much as they need our demand. Think about this. Which country has a political system with a higher tolerance for economic pain? China. Which country has more policy space to cushion against economic pain? That's China. And which country has an interest in unraveling the economic order that we built? China. So look, we can get the upper hand again. I think what clients have to watch for is, can we pull off a diplomatic masterclass? Get Europe and Asia back on sides, get them to collectively tariff China, isolate Beijing, and pressure them to stop distorting global markets with overcapacity. That's what's at stake.
In your time in government, how difficult is it to do just that? And what were the lessons from your experience down in Washington?
It's very simple. If you're tariffing alone and you're tariffing across the board, that's a self-defeating strategy, and Beijing knows it. They know they have the cards. That's why we're making the calls to them.
Dilip, though, Beijing is feeling some of this pain, though. That Weibo post from CCTV came out the same day that we saw factory orders in China plunge. How long do you think it is until Beijing really does think, I need to come to the phones, I need to pick up this call from President Trump?
Anne-Marie, China plays the long game. They are not focused on quarter-over-quarter GDP numbers. They're a mercantilist power that thinks about leverage as strategic scale. If they're gaining global market share, they can endure far more pain than we can. We're sensitive to markets, we're sensitive to polls, we're sensitive to CEO sentiment, we're sensitive to back-to-school items. It's a very different reaction function here than it is in Beijing.
The Treasury Secretary, a number of the President's economic advisors talking about getting these deals done very quickly with partners, South Korea, India, et cetera. How likely is it for those trading partners to also want to confront China alongside Washington?
My sense is they'll be eager to strike agreements in principle, memoranda of understanding, use whatever term you want, to reduce the threat against them. But when it comes to raising tariffs with the United States to isolate China, I think that's less likely because countries all over the world right now are hedging their bets. There's just too much uncertainty for them to decisively pull themselves into our strategic orbit. So, we're going to have to do this negotiation mostly by ourselves at this point.
During the Biden administration, you would say things like, we're not trying to decouple, we're de-risking from China. What are we doing now?
Well, I think under the current tariff proposal, we would be decoupling from what matters least without de-risking what matters most. So we'd be decoupling from items like bicycles and toys and underwear and low-margin commoditized goods. But I hear much less about maintaining export controls for our technological crown jewels. That's what we meant when we said de-risking. Those are going to be the items that determine our economic growth potential and our national security being intact. And I fear that the kind of deal we may end up with China is going to give away those crown jewels.
But the Trump administration has kept on the Biden administration export controls. You think they need to do more?
Well, they need to do more, and they need to keep the controls in place. And if I had to sketch out what an agreement in principle could look like with China, I was listening to your earlier guest on stage. We could very easily have an agreement in which the United States gets concessions on fentanyl, something on the Panama Canal, purchase orders on soybeans and aircraft and LNG, and some reduction of tariffs by China. China would also get a reduction of tariffs, let's say 60%, generous exemptions, some type of reprieve on TikTok, But again, the real prize for Beijing would be a relaxation of our export controls on the technological crown jewels. I fear that's where this is headed.
Negative supply shocks, as you know, can have ripples and tremors long after they finish, even if they are short-lived. We saw that in the pandemic.
Yeah.
Let's get short-term, medium-term. What does this look like from here? We've seen the freight bookings, the ship bookings all start to roll over from China to the United States. Then we're all asking similar questions. We've all been talking about it. When do we start to see the empty shelves, the price hikes, the lack of access? When does that start to appear?
I think it can take about a quarter. There's been a lot of, you saw in the Q1 GDP data, a lot of front running, a lot of inventory stocking. It'll take about a quarter for that to be exhausted, and it'll start to show up in the hard data, let's say Q2, Q3. And that's when this is going to bite. That's when the pain will be strong enough for the United States to more formally try to seek a meeting at the leader level, which is ultimately how this is going to get brokered.
There's a larger question about how this changes some of your assumptions longer term about how you understand the economy, how you understand growth, how you understand inflation. You had some pretty dire comments in some of your notes to us about the idea of American exceptionalism trade being over for at least a decade. How much does what we have just seen shift your view of the world order going forward as expressed in markets?
Yeah, look, I mean, we just got out of April, and when U.S. equities and bonds and the dollar sell off together, markets are delivering a pretty stark warning, right? So everyone in the world right now is questioning, are our foundational strengths still intact? Rule of law, due process, checks and balances, independent institutions, professional civil service. Countries are wondering whether they can still trust America as a reliable and predictable partner. There are questions as to whether we can still attract the best ideas and talent from across the world. Can our universities and our scientific research still be the lifeblood of innovation? And I think most crucially, and this will come later in the year, can we credibly put our debt and deficit trajectory on a sustainable path before it crescendos into crisis? The fact that those questions are being asked every single day is itself a problem. And if we don't put those questions to rest, the reversal of the American exceptionalism trade is going to be the least of our worries. But yeah, I mean, if you look at the U.S. market share in global bond markets, equity markets, and currency markets, it's about 40, 50, and 60% respectively. It's not far-fetched to imagine those numbers could retreat back towards our share of global GDP, which is 25%. And that doesn't mean the end of dollar primacy. It does mean we pay a heavy price in terms of our funding costs, in terms of our fiscal space, in terms of our ability to absorb a shock, or our ability to deliver a shock.
Dalip, wonderful to see you, as always. Thanks for being here, sir. Dalip Singh there of PGIM. I'm going to say this for you. You don't have to agree with this. Every administration makes mistakes. One of the biggest mistakes of the Biden administration, not letting people like Dalip engage with the media a whole lot more. From New York City, this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Seven days of gains on the S&P 500, the longest stretch of wins so far in 2025, and over that period higher by 8%. This morning we had some weighted rally up another 1.1% on the S&P, driven by some really strong earnings from big tech. On the Nasdaq 100 up by 1.7%. With 2 hours until the cash open, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Let's look at those movers from big tech. Microsoft is up almost 9% in the pre-market trade. Really strong results from cloud. It is that AI demand that Satya Nadella talked about on the call, saying, look, those reports of us canceling leases in the U.S. for data centers, it has nothing to do with us having weaker demand for it. In fact, they talked about laying out new data centers, 10 in the past quarter, and continued spend. Speaking of continued spend, Meta said that it's going to spend $72 billion this year in capital expenditures. That compares to 39 last year. A sign of confidence for the company, which is up 6%, beat on the quarter, beat on its forecast, saying that it doesn't have that terrorist-induced shock, that Zuckerberg feels that the company is well positioned to withstand any macro uncertainty, a big fear coming into this quarter. Finally, one of the other big gainers pre-market off the back of their earnings in the 6 a.m. hour, we heard from CVS, a beat. They're also pulling out of the Affordable Care Act marketplace. That's something that they lost money on, but really the gain of 8 1/3% has to do with the fact that they're partnering with Wegovy, Novo Nordisk rather, making Wegovy their medicine of choice when it comes to weight loss, and now giving cash discounts for Wegovy, so that in itself sending shares higher, John.
Danny, thank you, appreciate it. That stock up by 8.4% now in the pre-market. The opening bound just a few hours away. On our radar this morning, one of our top stories, the US reportedly reaching out to China for trade talks. Chinese state media reporting the US is using multiple channels to start discussions on the levies.
Yeah, this to me is a really interesting question. Who's talking with whom? Is any of this real? How close do we get to some sort of transactional deal? The big question, and Dalip Singh was talking about this just a moment ago, about how much leverage each side has. Who can tolerate the pain for longer? That's really come to the fore as we start to get into this grade school discussion of who called who first.
Well, if it's politics, the United States has months. China has years, maybe even decades, and you could see that with even some of the social media posts they're putting out. They're going to fight to the end. What is so interesting about this post, though, from this affiliate to China State TV, is it is a clear olive branch. They are saying that the United States is more anxious at this moment, a little bit of a domestic flair there. But if the U.S. wishes to engage with China, there is no harm in it for China at this stage, basically saying we are open for business to have this discussion. The whole who's going to make the first call and where it's going to be. Will it just be a phone call? Will there be someone appointed?
He like me?
That's the semantics around it. The fact of the matter is they will have a conversation.
They'll end up in a room, perhaps by accident, and that number will come down. That's the consensus on Wall Street. To what? Maybe down from something like 140, 150 down to what? 50, 60, 70? That's basically the consensus view on Wall Street now.
And now the bigger question is, what is sustainable? Is 60% sustainable? Meh. Is 50% sustainable? Maybe. And what products, what types of exemptions are there going to be? Can I just say, This is going to be just a public service announcement. I don't care who calls who. Ultimately, there's no judgment. Just go ahead, have that conversation. There's no pride lost. You both like each other. There's this feeling of like, really, are we really doing this?
Guess what? Wall Street doesn't care either.
No, not at all.
Wall Street just cares the signal is there that both sides are interested in engaging in talks.
And guess what? We'll have two different readouts, one from Beijing, one from Washington, that will say President Trump called Xi if you're in Beijing, and Xi called President Trump if you're in Washington. Everyone will be able to save face to their domestic audience, and we can get the negotiations on the road.
That conversation ongoing. Let's turn to Tesla. The chair denying a report that the board is looking to replace the CEO, Elon Musk, saying directors are confident in his ability to continue executing on the growth plan. This coming after the Wall Street Journal reported in the last 24 hours that some board members were seeking to start the process to find a successor.
Whether this is still valid remains to be seen, and we'll talk to Dan Ives about that in just a minute, whether this is still a relevant discussion to be had. The fact that it was being had, though, highlights just how much damage Elon Musk's distraction and potential affiliation with the government have been doing to Tesla, the company. If this is true, and the company is denying it, if this is true, it highlights what they were considered doing as a result of their CEO running 5 different companies and the Doge effort in Washington, D.C.
I know Elon Musk and the chair of Tesla is pushing back on this, but there's one part of the story that is absolutely true. Board members told Elon Musk he needs to spend more time at Tesla and needs to say so publicly. And he did say so publicly. On the last earnings call, he said, next month, I'm going to be stepping back from Doge, focusing more on Tesla. And we heard him talk about this yesterday in the cabinet meeting. And the president said, you always have a seat at the table, but I know you want to go focus on your cars.
Yeah, most investors not interested in how we got here, just interested in that he's back, and he seems to be back. We'll catch up with Dan Ives of Wedbush later this morning and talk to him about this name. And this name too, a federal judge ruling against Apple saying it violated a court order requiring it to open up its app store to third-party payment options. The judge ordering the tech giant to stop charging commissions on purchases outside its marketplace. That name is down by 1.5%. Earnings from Apple front and center after the close later.
There are antitrust issues, there are court case issues, and frankly, they face a much higher hurdle when it comes to some of the profitability and visibility, given that they are deeply exposed to China, both on the production side as well as on the sales side, and they are a physical goods side. They have to come over on that ship. It is different when it's software versus something physical and tangible. That is why I think Apple earnings are going to be particularly notable.
After the closing bell, alongside Amazon, look out for that. Let's turn back to tariffs. Levies on building materials from lumber to steel threatening to impact the real estate market. Lauren Hochfelder of Morgan Stanley Real Estate Investing remaining optimistic, writing real estate was already over 3 years into a correction prior to April 2nd, and the market is set up well for a recovery. Lauren joins us now for more. Lauren, good morning. Good to see you.
Good morning. Great to see you.
Thanks for dropping by. Some people are framing this as the great repatriation of U.S. manufacturing back to America, the big rebuild. How would you frame things?
Well, I think it's funny. Everyone's talking about tariffs these days, and of course that is a huge deal. But let's not forget that this restructuring of the global supply chain didn't start on April 2nd. We were seeing long before that companies, having learned the hard way about putting all their eggs in one basket, they were grappling with this U-turn on globalization, grappling with these event-driven supply shocks, COVID, Panama Canal, you name it. Tariffs are one more critical proof point in that they need options. Some of those options will be here in the U.S., some of them will be in other markets around the world like India.
What are you seeing in terms of the types of facilities that companies are investing in as a long-standing policy shift toward repatriating supply chains or redirecting them? Is it putting tubes in a toothpaste into a tube and putting the little handle on it, or is it something like data centers and other type of issues?
Well, it's interesting, right? That you see sort of the memes of those toothpaste and T-shirts, and no, I do not think it's going to be generic manufacturing, commoditized manufacturing here in the U.S., but you do have automated manufacturing, you have various types of advanced manufacturing, and just critical goods. So it may not be toothpaste, but it can be defense in the Midwest. It may not be T-shirts, but it can be building materials in the Carolinas. So we think there's a lot that actually can be reshored back to the U.S.
How much have you seen those investments pick up after the election and after even some of the tariff announcements that we saw about a month ago?
Well, I think that you've been seeing that investment increase since really 2020. So when companies really faced that immense economic disruption driven by the supply chain breakdown, you started to see that plus, frankly, government policy incentivizing building here in the U.S. Since April 2nd, it's hard to say there have been such substantial steps just because we're in a period of uncertainty. And what do companies do in periods of uncertainty? They generally tend to pause decision making.
Which areas are getting the biggest slew of investment as a result of this? And how much have prices already gone up in anticipation of this expected investment?
Yeah, well, it's a few things. First of all, on price increases, I'd say one of the interesting things for real estate is that one of the real tailwinds as we look forward is new construction is so far off. And what will tariffs do? We know they'll make it more difficult, more expensive to build, which will push back the inevitable supply side response. So we think actually, perhaps counterintuitively, long term, this could be really good for real estate because of that cost impact you're discussing. In terms of which markets, we think that it's those markets that are less reliant on cheap labor. Let's more can be more benefited by technology, which should be a tailwind to domestic manufacturing, and those markets, frankly, that would benefit from the relatively lower cost of energy here in the U.S.
You mentioned government policies. We now see on Capitol Hill they're debating pulling back Inflation Reduction Act credits, things like maybe the CHIPS Act, those grants that could be up for grabs. Will that have an impact on building and real estate in America?
Absolutely. Look, it's variables upon variables. It's sort of this Rubik's Cube of outcomes, really. But absolutely, all of these things will, because supply chains are ultimately very complex, and they depend on cost and resilience and all of these things. And policy obviously has a way of distorting the the cost equations. So absolutely, but I do think you're seeing, at least in the short term, a pause because companies rightfully are saying, what's this going to look like?
Let's finish with an area that you really like. When I moved to America about a decade ago, I thought people moved to Florida to retire because of the weather. I found out later on it was about the taxes.
I think the weather's a big part of it.
I'm sure the weather's got something to do with it too, maybe for the rest of us. How are you thinking about retirees in America and investment opportunities on the real estate side?
Yeah, look, we think this is the golden age for senior housing. When you think about what is the ultimate needs-based real estate, it is, there is a silver tsunami underway, right? We can sit around and debate tariff policy or interest rates, but what do we know? We know this population is getting older, and with that, its housing needs change.
Where are they retiring to? Because I can't afford to retire in New York City. Where are they going?
Well, it's, senior housing is really throughout the U.S. It tends to be linked less to whether it's, Florida and whatnot, or where frankly, the oldest daughter lives is actually statistically the most predictive element.
Is that true? Really?
Right, yes.
Amazing. I did not know that.
Yes.
I'm a little bit insulted at the moment. I'm the youngest daughter. I guess that means I'm losing my parents.
So they're going upstate, is that right?
We're going upstate.
Okay, all right. Lauren, appreciate it. Thanks for being
Wonderful
here.
to see you.
Thank you very much for dropping by. Lauren Hogfelder there of Morgan Stanley Real Estate Investing. If you are just joining us, welcome to the program. Equity futures up nicely this morning off the back of earnings from big tech. Earnings elsewhere really, really interesting. We're seeing cuts to guidance. We're seeing guidance pulled. Cuts to guidance from GM. Pulled guidance from Harley-Davidson, and soft earnings from McDonald's as well.
Yeah, and different stories, right? I mean, this is one of the reasons why it's so difficult to really come up with a cohesive narrative. GM saying we're going to take a $5 billion hit, we're going to lower our guidance. HOG, or Harley-Davidson, HOG is the ticker that you can see, withdrawing guidance, especially given the fact that they're getting pushed back from Europe, but at the same time, maybe other places might offset that. McDonald's. How much are we going to see lower income consumers really retrench from spending first, and how much is that already some kind of breaking point that we're seeing play out in the data?
Not a great read on things from that corporation this morning. That name is down by close to 1% in the pre-market. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Staying on McDonald's, those shares are falling nearly 1% after reporting a sales decline in the first quarter. Sales dropped 1% globally compared to a year ago, driven by a big decline in sales here in the U.S. The results suggest that McDonald's focus on affordable menu options have not been enough to get anxious consumers to spend.
Meanwhile, Ford says it will not increase the price of its vehicles until it sees how its competitors respond to higher costs from tariffs. This comes after it had previously said it planned to raise prices in May. CEO Jim Farley says Ford will detail how much the levies will increase its costs when it reports first quarter earnings next Monday. And EV maker Rivian is said to have stockpiled a reserve of batteries from Asia ahead of President Trump's tariffs. Sources say it acquired a supply of cells from China late last year ahead of the U.S. election. Sources told Bloomberg that Rivian has also recently worked with Korean supplier Samsung SDI to move a large amount of battery inventory to the U.S. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, the greenback safe haven status in question.
We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run if the goal here by the Trump administration is to reduce those trade deficits. It means foreigners over time don't need to hold as many dollars.
We'll pick up on that conversation in just a second when we catch up with Terry Wiseman of Macquarie from New York City. You're watching Bloomberg TV.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China. In 2023, it's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's do a couple of things. Let's start with stocks, then we'll get to bonds. Equities at the moment firmer on the S&P 500. This session highs up by 1.2%, supported by beats from Meta and Microsoft. Later on, Apple and Amazon. On the Nasdaq 100, we're higher by 1.8%. In the bond market, let's talk about this. I just want to sit on the front end of the curve. The 2-year at the moment is trading at 358. Yields are down by 2 basis points on the session. The Treasury Secretary, Scott Bessent, speaking to Fox News earlier on this morning, saying the 2-year rate is below Fed funds, and that signals this Fed should cut. Fed funds is about 450.
So I'm old enough to remember when he said that he wasn't going to talk about or comment on the Fed policy because ultimately this was the Fed's job, and at their lunches every week he lets them do their thing. At the same time, it is increasingly evident that there is focus on how to conduct monetary policy based on the president's comments, as well as who's going to take the blame for an economy that a lot of people say will clearly weaken heading into the next few months.
We've asked a lot of questions about Fed independence in the last couple of weeks, that's for sure. Under surveillance this morning, the greenback safe haven status in question.
We try not to be too alarmist about it. We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run if the goal here by the Trump administration is to reduce those trade deficits. Then maybe that means we have less of a capital account surplus, and it means foreigners over time don't need to hold as many dollars. Obviously, there's concerns out there, but we're not saying you need to get out of the dollar.
So here's the latest this morning. The US dollar posting its worst month since 2022 as tariff turmoil weighs on the US currency. Terry Wiseman of Macquarie writing, to avoid poor GDP growth, the US administration will have to shift aggressively towards more negotiations and concessions on tariffs, a renewal on tax cuts and tax reform, and more deregulation. Terry joins us now for more. Terry, good morning.
Good morning, John.
Thanks for being here. Let's sum up and wrap up the month of April. What did you make of that?
Well,
Take breath, Terry.
Well, look, going into April 2nd, I don't think that anyone thought that the tariff announcements were going to be as aggressive as they were. So if you have to point to a surprise in April, it's the aggressiveness, the pugnacity of the tariff policy that came out on so-called Liberation Day. And that was a shock, and that caused two things to happen. First of all, it created the sense that we are going to have not just a prospective U.S. slowdown, but potentially a global slowdown sometime starting in the second quarter. But I think the more structural thing that happened, the more profound thing that happened, was that all of a sudden, there was a sudden shock to people's perceptions of the United States. The United States as a counterparty, as a full faith and credit counterparty. The United States as a protector and guarantor of international law and international customs. Of course, international law and customs that the U.S. itself helped build post-World War II. I think those things created a loss of confidence in the U.S. The arbitrary nature of the tariffs, the abruptness of the tariffs, the aggressiveness of the tariffs on Liberation Day created that change in perception and sentiment. Even if the U.S. were to walk back all of the tariffs that this administration put on, I don't think we're going to get back to a situation where people are going to fully trust the U.S. again. And I think that is going to have an implication for the markets, but especially for the currency. I don't think, for example, that the days of American exceptionalism that we witnessed in the fourth quarter of last year and the early part of this year, really a story about American exceptionalism began in 2012 because we had a stronger dollar since then, effectively. I don't think that's going to return anytime soon. Does that mean that the dollar can't appreciate a little bit from here? I think it can. There is a lot of things pointing to the prospect that it is already oversold on a technical basis. You could see that in positioning. You could see that in risk reversal pricing. But the idea that we were going to get back to where we were in early January, I think that ship has sailed, and it has sailed for good.
Equities recovered in April, bonds recovered, the dollar did not. You say the ship has sailed for good. Where's the ship going to?
Well, again, if we see, it depends again on how much of a walk back we're going to see.
What are we rebalancing towards? The euro? The Chinese currency?
Oh, yes. It's going to be prospectively anything that can serve as an alternative reserve currency, any currency of any country that is deemed to be a safer harbor than the U.S. in view of the arbitrariness and the uncertainty emitting from U.S. policy agenda. I don't think it's going to be the yuan. We have to wait until the China opens up its capital markets a little bit more. But certainly the euro, certainly the yen, sterling to some extent, the Aussie, the Canadian dollar. These form a complex of currencies in countries and regions, in the case of the EU, that are perceived to be more stable at this point.
How much does that increase structurally the funding cost for the United States if people are not looking for places to park their cash and dollar-denominated assets?
Yeah, so you're not going to see it now. And the reason you're not going to see it now is that the perceptions of a recession and the prospect of a recession in the U.S., at least the mindset of traders and investors, is too strong to allow yields in the U.S. in the Treasury market to go up. In fact, every recession, with the exception of one since the end of World War II, has been associated with a decline in U.S. rates, base rates, Treasury rates. However, when this fear of recession passes, we are probably going to settle into a real rate environment for the U.S. that is higher, and a real yield environment in the U.S. that is higher than it otherwise would have been if we never had this episode to begin with.
Let's talk about policy response. Treasury Secretary Scott Bessent just said moments ago that the two-year rate below the Fed funds rate signals that the Fed should cut. Do you agree?
They have a point, and the point is this. Even before the election in the U.S., we were already seeing some weakness in the U.S. economy among low-income consumers in the cyclical sectors. It looked like things were heading down, and they were heading down because of the pressure of high interest rates, presumably. The thing that saved the U.S. economy in Q4 was that we had an election that created some exuberance among high-income consumers, and of course, we had government spending taking place in the last few months and weeks of the Biden administration. They were trying to get all of those fiscal allocations out the door. So that saved the U.S. economy. But underlying that bump was a slowdown. And I think if there's a case to be made for lower rates, it's that case, that we already have fragility among the consumer and some businesses. However, and there's always a however is we have no idea what the impact of the tariffs are going to be on inflation and inflation expectations. In the case of the U.S., it's almost assured that measured inflation is going to go up if the tariffs stick. That's very different than what's happening abroad. The implication of U.S. import tariffs for Europe, for Japan, for the UK, for Canada even, for Australia, for the emerging markets is disinflation. Those emerging market central banks and developed market central banks that are confronting that disinflation have the luxury of being able to speak more dovishly and act more dovishly. You're seeing it with the Bank of Japan overnight. But the Fed, it doesn't have that luxury right now.
The president once again yesterday suggested he knows more than Fed Chair Jay Powell. Then you hear from the Treasury Secretary today, which a few weeks ago said to me, monetary policy is a jewel box that needs to be preserved, even if they have a case to make. Is it appropriate that they're making it?
Like I said before, I think they have a point. It may not be a point that is strong enough to overturn the current consensus of the FOMC. It may not be a point that is valid enough to overturn the current consensus of the FOMC, which is to wait. But it is a point, and it is a valid point. There is a cyclical downturn in the U.S. that was prevailing before the election, and the only reason we didn't see it show up in GDP growth in Q4 is because the election created a burst of exuberance and because we had a lot of government spending. I think the administration is concerned that going forward, there's going to be less government spending, there's going to be retrenchment on the budget, and now they're seeing, of course, the impact of tariffs, although they won't tell you this, on sentiment among high-income spenders, and those high-income spenders, those luxury spenders, those discretionary spenders are retrenching as well. You see it, of course, with the guidance we're getting from some U.S. corporations recently.
Terry, we've got to go. Appreciate your time, as always.
Pleasure.
Terry Wiseman there from Macquarie. Neil Dutta of Renmac agrees. The Treasury Secretary, he says, knows how to feel the market. Up next, we'll catch up with Liz Ann Sanders of Charles Schwab, Dan Ives of Wedbush, Nita Richardson of ADP, Ian Lingen of BMO.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, The world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The S&P today is a very different animal than it's been historically.
U.S. assets are still a safe haven.
I see a lot of duration risk in the market.
A couple of hard data points are already enough to really drive us a leg lower in risk assets.
This is a global rebalancing from a very overweight position in U.S. assets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes out from the opening bell, and your scores look like this in the equity market. Equity futures looking to extend the winning streak from day 7 to day 8 on the S&P 500 right now, firmer across the board. We're up by more than 1%. On the NASDAQ 100, up by 1.8%. Thank you, Meta. Thank you, Microsoft, in the pre-market, doing nicely. Both of those companies delivering a beat after the close yesterday. Microsoft up by more than 9 percentage points in the pre-market. Let's turn to the bond market and sit at the front end of the curve on a 2-year this morning. Your yield, 358. Yields lower by 2 or 3 basis points. And this message coming from the Treasury Secretary, Scott Bessent, just moments ago to Fox News early this morning, saying this: the 2-year rate below the Fed funds rate signals this Fed should come.
And clearly, a number of people agree with him. Neil Dutta, as you mentioned just moments ago, coming out and saying that the Treasury Secretary knows how to feel out the market. Wage and salary growth is running below the level of the Fed funds rate, a sign that past policy has already been too tight. That said, there is a larger question, especially after Treasury Secretary Bessent's comments about not commenting on current Fed policy, about how much this current administration is leaning on this as a real question mark. Has has this Fed chair acted in an appropriate way given some kind of slowing in the economy already heading into this period?
This is another layer of jawboning at Jay Powell. We heard it from the president in Michigan when he said that person running the Fed doesn't really know what he's doing. And then yesterday as well from the White House, he talked about the fact that Jay Powell is, quote, not really doing a good job. And to Lisa's point, the Treasury Secretary told me weeks ago, monetary policy is a jewel box that should be independent. Now there's going to be these questions yet once again about whether or not there's an independent Fed under Trump 2.0.
I think a good question in the news conference next week, next Wednesday, take the Treasury Secretary's name out of it. Just ask him about that measure. Just say at the moment the 2-year yield is trading below Fed funds. Is that a sign that you're too tight right now? And see what he says back to it.
Well, I think that that's a great idea. Anyone taking notes, please ask that question.
Mike McKee, if you watch.
Because, you know, Mike can ask that question. Because ultimately, there are a number of people, and Terry Wiseman just said basically, yes, there is a sense that the economy was slowing heading into this. The big question mark, and this is really kind of the issue for a lot of people, we don't know what the tariffs are actually going to do to inflation expectations. We haven't seen that pricing pass along yet. That's why it's a fly in the ointment that they cannot dismiss.
Companies are juggling this as well. We've heard from several already this morning. So GM is cutting guidance. Harley-Davidson is pulling guidance. The earnings that came from McDonald's were softer. In about 27 minutes' time, you'll get more economic data. Jobless claims at 8:30. One to watch. Then later on this morning, Lisa, ISM Manufacturing at 10 a.m. Eastern Time.
Which will be important given the fact that supposedly companies are moving back manufacturing here, and yet we've seen a bit of a weak spot there. Some of this data, the ISM Manufacturing, we saw that Dallas survey where you just saw manufacturers report real severe declines in confidence. How much and how quickly can we see the soft data converge with the hard data will continue to be a question.
Improving confidence over the past few days, the past week for that matter. Your equity market higher by 1.2% on the S&P. Coming up this hour, Liz Ann Saunders at Charles Schwab with stocks riding a 7-day winning streak and looking to make it day 8. Dan Ives of Wedbush on big gains from big tech, and Nina Richardson of ADP looking ahead to the payrolls report. We begin this hour with stocks higher following strong earnings from big tech. Liz Ann Saunders at Charles Schwab writing, earnings season is better than expected so far, but guidance looking ahead continues to be murky at best. We still think an up in quality factor focus makes sense. Liz Ann joins us now for more. Liz Ann, good morning and welcome to New York City.
Good morning. Nice to be here.
Good to see you in person as always.
Ditto.
Let's talk about what we've heard so far from corporate America. Can you get a clean read on things at all?
You know, I've been listening to you guys this morning and talking about the rules of the game. I think what you're also hearing from business leaders is not just we're unsure about the rules of the game, but what is the playing field? Are we on a soccer pitch? Are we on a basketball court? So I think it's the combination of those things. And it reminds me of the early part of COVID, when you had, at that time, a record number of companies just withdrew guidance altogether. And that's that, you know, businesses have put themselves in a timeout, similar to what the Fed has done, which has put itself in a timeout. And that's probably the right position to be in.
I feel like I'm ice skating really badly and face planting every couple of days. Isn't that what it feels like?
Yeah, on a soccer pitch. You're ice skating on a soccer pitch.
Just to describe the last month, the fact that we ended up finishing the month down by 0.75%. Have you ever seen a month like that where you're down 0.75%, but it feels like you're down 20?
Maybe October of '87.
Is that the parallel for you?
Well, the year of 1987 was almost completely flat. Yet, obviously, what happened along the way was extraordinary, particularly around that crash period of time. I think more recent examples, I think COVID is probably somewhat of a proxy for this. Maybe the important difference being, you know, we had this massive uncertainty, sort of freeze activity, but at that time we kind of knew not only what the solution would be, health-related solution, vaccines, but also massive, massive stimulus, both of the fiscal and monetary variety. Now, when you don't really know the rules of the game, trying to gauge, okay, what ends this? What do deals look like? Not to mention, there is monetary firepower, but it doesn't really get to the heart of what is plaguing the economy right now. This has not been a problem of interest rates being too high or credit constraints or a serious plumbing system problem in the financial system. And arguably, there's less fiscal firepower. So that's, I think, the important difference between today and the COVID period.
We also don't know who the potential winners are going to be on the other side. Is it going to be the big tech players that really were the beneficiaries or some of the biggest ones on the heels of the pandemic and what happened with respect to everyone staying at home and buying 15 iPads? Or is it going to be some of the industries that are going to be reinvesting in domestic production? What's your sense?
I think another thing that was interesting about April with the renewed interest in tech, and even beyond that, the so-called growth trio, as I like to call it, tech communication services and consumer discretionary that house the Magnificent Seven. I think what we're seeing in the month of April is sort of the resurgence again of actually retail traders into their favorite hotspots. You know, Goldman Sachs has some of those great indexes, and their meme stock basket has been on a tear. You see the Vandatrack research that tracks what retail traders are doing. So institutions have pared back and CTAs have pared back, but that's where I think you're seeing that buy the dip mentality. And that sort of has this knee-jerk back into tech and AI-related names. Whether that's sustainable is hard to judge.
Well, that's what I was going to say. You sound deeply skeptical. If the institutions aren't following suit, then there could be an argument made that the retail traders are just basically doing a knee-jerk response based on what has worked in the recent past. On the flip side, they've been right sometimes.
They have been right sometimes, and there have been periods in the last decade or so where you've seen retail investor optimism stay high. You see it sink on the institutional side, and the convergence has been a catch-up by the institutional side, not a catch down by the retail side. I don't know how, it might be actually a little bit of both this time, but that's where they continue to sort of place their bets. And I think a day like today, when you have Meta and Microsoft as two of the poster children for this, when you've got more direct in the teeth of the tariff stuff, like Harley-Davidson or General Motors pulling or lowering guidance, there's also that dichotomy that I think is an interesting one that has manifestations in market behavior.
Lizanne, when we're trying to understand what's going on, you talk about COVID as being this proxy. Why is Trump 1.0 not a proxy for Trump 2.0?
I think the nature of the people who are advising Trump, I think there might have been a little bit more pushback by many members of the cabinet. For whatever reason, the equity markets seem to be the driver of the Trump put at the time, now a little bit more on the bond market side. So in terms of whether we get to that moment again, I think the bond market is more in the driver's seat now than the equity market. Plus, frankly, the 2018 trade war tariffs, they were minuscule compared to what we're
And it was focused really just on China.
And importantly, when you hear people talk about the offset of major tax cuts coming, it's the extension of the 2017 tax cuts. On the margin, potentially more. That's a very different backdrop than what preceded 2018, which was brand new tax cuts. So the difference is we got the candy first and the spinach later. Now the spinach first this time, and it's aged a bit more, the spinach, by virtue of just the scope and size and the global uncertainty associated with this.
If the bond market is the Trump put of 2.0, what's the level?
I don't know if it's a level per se. I think it was the speed with which we saw the move from 3.9 to 4.5 on the 10-year. So direction of travel, but speed of travel, I think, is maybe more important than a particular level.
8:30 yesterday, Lisa picked up on it almost immediately. There was a stagflationary mix to the economic data. Did you start to feel like investors were reaching for a stagflationary playbook? And what does that look like?
I think that is the flavor that we're getting out of recent economic data points, certainly embedded in the GDP and related data that we got. What I find interesting, though, is you can track mentions on conference calls, and we're right in the teeth of earnings season right now, and stagflation mentions have actually come down, but tariff mentions continue to spike. So maybe now companies are just getting right to the heart of this is how it's going to impact us, as opposed to just speaking in more macro terms. I think what we're also facing right now, and part of the reason why bond yields have come back down, is there was a lot of debate as to what would happen first. Would you get the growth weakness first, or would you get the pop in inflation. It looks like we might be getting the growth weakness first. Last thing I'd say is this notion, probably accurate to some degree, that this would be a one-time step up in prices. First of all, I think there are still ripple effects. We talk all the time about if you've got a significant increase in the average price of a car, well, that also raises insurance rates. So there are tentacles here. But I think it's also important, even if it is just a one-time step up in prices, you guys know this. This is how consumers think of inflation. We're all in the weeds of core versus headline, month over month versus year over year, core services X housing. Is it PCE, CPI, PPI? You know, the person on the street says stuff is more expensive than it was, you know, a year ago, pre-COVID, whatever the reference point is. So that matters because of animal spirits and the psychology of not just inflation, but the economy more broadly.
They have a tendency to extrapolate it out and behave accordingly. Then that's the worry of this Federal Reserve. You can see it's why the chairman at the moment has repeatedly, Lisa, again and again and again, pledged to anchor inflation expectations. Repeatedly done that going into this meeting.
And it's especially salient because we're coming from a higher inflationary place where companies have been able to pass along price increases. And it's something Mohamed El-Erian has talked about. The fact that there aren't sort of suggested prices on different goods is actually really important because a lot of companies are saying we can adjust things around the margins and just test the waters and see how much we can actually pass along to
They want maximum flexibility, but what did you make from the news from Ford? That Ford was basically waiting to see what everyone else was going to do.
I thought that was fascinating. Basically, that they would have to increase the prices maybe $5,000 or $10,000 per vehicle, but they wanted to wait to see if their competitors were doing the same because they don't want to lose market share. So there is this ultimate test, and we heard this earlier this morning, where companies don't know and they're going to wait, maybe order some things, try to pass it along. This is a huge experiment where we don't know where we're coming from and we don't know where we're going.
Lizanne, just to finish there, starting points matter. Consumer price tolerance now versus a couple of years ago coming out of the pandemic. How different are things now? The ability for companies to say, you know what, prices are going up 10, 20%.
There may be more of an emotional, less emotional tolerance for higher prices, in part because of the policy decision aspect of it, as opposed to COVID. I think that's a very different backdrop. Lisa, I also think it's fascinating what you talked about, because part of the reason for weaker GDP that we got yesterday was the massive surge in imports. That could continue a little bit, which means then you have to think about the flip side of that when that ends. But it also means that companies have really boosted their inventories. That might push out the empty shelves concern about this. It also maybe gives companies a little wiggle room, to your point, to try to test the waters with price increases because they've got a lower cost basis now in this inventory build. Let's see what sticks and what doesn't. So you could see a lot of volatility as they try to figure out what sticks.
It's going to be a volatile summer for the economy, that's for sure. Lizanne, fantastic to catch up in person. Thanks for being here.
My pleasure.
Appreciate it. Lizanne Summers there of Charles Schwab. Your equity market near session highs up 1.2% on the S&P with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. GM lowered its full-year profit outlook, saying it expects a tariff impact of up to $5 billion this year. It's among the biggest financial hits revealed by any company so far from President Trump's trade war. GM's lowered guidance comes even after Trump issued some relief for automakers by lowering some levies on imported vehicles and parts. Meanwhile, Airbus says it won't cover the cost of tariffs on its planes imported by U.S. airlines, setting up a clash with the carriers. The plane maker's CEO says its customers are not willing to pay the levies, but that's on them. Airlines, including Delta, say they won't pay the extra costs, but are finding workarounds, such as routing new aircraft through another country first. And a federal judge ruled that Apple violated a court order by not opening the App Store to third-party payment options. The judge referred the case to federal prosecutors to investigate whether Apple committed criminal contempt of court for ignoring her 2021 ruling. Apple must now make changes that could put a sizable dent in its App Store revenue. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, the morning calls plus Dan Ives of Wedbush with tech earnings in full swing.
tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The open about 1 hour and 12 minutes away. Going into it, equity futures near session highs up by 1.2% on the S&P, up by 1.9% on the Nasdaq. That's the price action. Here are your morning calls. First up, HSBC downgrading UPS to hold, saying tariff headwinds are weighing on the outlook. That name is down by 0.1%. Your second call from Bank of America, raising its price target on Microsoft to $5.15, highlighting its strong earnings report driven by cloud growth. That name is up by 9% this morning. And finally, Morgan Stanley raising its price target on Meta to $6.50, saying it remains the, quote, cleanest GPU-enabled leader in the space. That name is up by close to 7% in early trading. Let's stick with tech. Apple reporting results after the closing bout today. Dan Ives of Wedbush writing, we remain bullish on the long-term opportunity for Apple's flagship ecosystem. Investors need to look past the next 3 months and assume China tariff negotiations take a positive turn. Dan, optimistic as always, joins us now for more. Dan, welcome to the program, sir. Let's get straight to it with Apple. How are you going to draw a distinction later on this afternoon between a front-loading, people rushing to the stores before the tariffs, and decent, sustainable underlying demand?
Yeah, I'm actually less focused in the quarter, as you talk about in terms of pull forward or front-loading. It's really about what Cook talks about in terms of tariffs. Like, are they going to stay on schedule with the iPhone 17 launch? You know, how are they going to sort of scenario analysis in terms of everything they're seeing in China? They're waiting to hear from Trump administration. Those are the keys. I actually think numbers take a back seat to Cook's commentary about that.
So, Dan, let's talk about the guidance then. What kind of scenarios they could offer, and what you think of the approach so far from corporate America, because we've seen a range of things done. Some people have just pulled guidance, haven't offered any. Other people have cut. Some people have offered multiple scenarios. What would you appreciate? What would you prefer to see this afternoon?
I prefer no guidance, because I think if you give guidance, you actually put your back against the wall. They could give some sort of scenarios, but it comes down to June's a mulligan. It's a toss-away quarter. I think the really focus is, you know, do you launch in terms of September iPhone 17 and give some scenarios and ranges for investors to understand what this could do? Look, we've already factored 10% cuts in numbers. Worst case, 12 to 15%. Best case, 2 to 5%. That's how we're going into tonight.
You know, John raised this really interesting point earlier, Dan, about how much forward buying there was over the past couple of months and frankly over the past couple of weeks to get ahead of any potential disruptions in shipments from China. Are you expecting to get any guidance about the pull forward effects, and maybe that we could even see much better than expected numbers that will only be made up in maybe declines later on?
Yeah, look, there will be pull forward. And again, I think numbers are actually going to be very strong. And I think they could quantify some of that, but that's sort of breadcrumbs. I think the real focus is next few quarters, over the next 6 to 9 months, how they're going to navigate these tariffs, like in terms of maybe even talking about some supply chain plans, the India, scenario. I think any commentary like that would be very important to understand from Cook, to kind of put a flashlight in a dark tunnel when it comes to tariff scenarios.
We're hearing a lot of commentary about how maybe Meta and Microsoft have been somewhat immune. We're going to be hearing more potentially from Apple and Amazon. We got this reporting overnight from the Wall Street Journal that they were thinking among some of the height at Tesla, at some of the height of the carnage and some of the boycotts, that they were looking at potentially getting another CEO to replace Elon Musk. What do you make of that?
Look, we talked about it on your show, right? A lot. I mean, the point is, regardless the board denies it and the scenarios, this was the moment of truth. The board had to do something, whether it's a warning shot or whatever it may be. And Musk had to choose CEO of Tesla, Doge. And we thought that conference call is probably the best conference call I've seen Musk do maybe ever, or at least in the last 4 or 5 years. So important because the brand damage and what was ultimately happening, clock struck midnight. So regardless of the semantics and what actually happened, what didn't happen, the end result is a huge positive. Musk back in the driver's seat, CEO of Tesla. And I continue to think like his days at the White House are essentially done.
Well, Dan, they're not in the sense that he was at the cabinet meeting yesterday wearing not just one, but 2 Make America Great hats stacked on top of each other. Even though he is more focused maybe on Tesla now than he was in the beginning of this administration, when he was very focused on Doge, can that brand destruction still carry through?
Yeah, look, I mean, you've talked about that a lot. And I'd be surprised if these are other cabinet meetings. I mean, just given, I think, the pressure for him to sort of detach himself. But we've talked about brand damage. You got to contain it. You have a massive era of growth ahead. Autonomous, robotics, turning things around in China, especially BYD in terms of rising, in terms of from a share perspective. Leaders lead. That's what Musk has to do now. And I just think like that was the move that he started to take on last week's call. And I think that's what we expect to see from Musk going forward. It's also why the stock's up. Because ultimately, now you have the biggest asset of Tesla back, regardless of the drama that went through between the board and Musk or whatever did or didn't happen.
Dan, let's finish on the biggest challenge to them right now, which I think could possibly be a tie-up between Waymo and Toyota. We're talking about the best-selling car brand on the planet, 2 of the best-selling models out of the top 3 in the world in the last 12 months, getting together with Waymo that's delivering 200,000, 250,000 paid trips every single week. Why isn't that a threat to Tesla?
Yeah, I personally think that's not as big of a threat as maybe some have talked about. Look, Waymo, $240,000 cars in 4 cities. They obviously will expand. They had the lead in terms of coming out of the gate. I think when it comes to cybercabs and Tesla, I think autonomous, the scale and scope, they're really going to own that market. So you're going to see more and more partnerships like this, but it's not like I view this partnership as something that changes my thesis on Tesla in terms of autonomous. But it also speaks more and more, Musk needs to be leading Tesla, not sitting there, as Anne-Marie said, wearing 2 or 3 hats in the cabinet meeting.
I'm guessing you're at the airport, Dan. Travel safely.
I am.
It's good to see you, sir.
Thank you.
Thanks for making time for us. Dan Ives of Wedbush there on Big Tech. In just a moment, we've got to talk about the data. Jobless claims just around the corner. Another read on the labour market ahead of payrolls tomorrow morning. Really important stuff. We're starting to see some cracks. Will you see it in the hard data? Nita Richardson of ADP joins us in just a moment, alongside BMO's Ian Lingen from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
So we're on a really good run of gains on the S&P 500, 7 straight, extended the longest winning streak of the year so far, looking for day 8 and up nicely again this morning, lifted by what's happening elsewhere from big tech, from Meta, from Microsoft. Equity futures up this morning by 1 percentage point on the NASDAQ 100, up by 1.7. Coming up very shortly, a really important read on the labour market. This weekly data, just increasingly important following the policy volatility down in Washington, D.C. With your data this morning, let's cross over to Mike McKee. Good morning, Mike.
Good morning, guys. I'm still waiting for the data. I think maybe everybody is at this point, because the question is, what happens tomorrow when we get the jobs numbers? We, at this point, see a big jump in jobless claims last week, 241,000 up from 223 revised. So we do have some added jobless claims numbers here for the first time in many, many weeks, and really since the Doge people started their job cuts. The 4-week moving average is at 226 from 220, and the continuing claims number, 1,916, up from 1,833. The interesting thing, though, is we don't see a big rise in the number of federal employees filing jobless claims. Remember, they have a different category, only 470 people. We know that a lot more federal workers have lost their jobs, but maybe because they get severance, they're not quite eligible yet. Next thing we wait for is ISM at the top of the 10 o'clock hour on Wall Street, and we'll see what the jobs numbers say in that indicator as well.
So, Mike, I'll come back to you in a second. I just want to share the price action with you because we are responding to this. So it's an upside surprise on claims, the wrong kind of upside surprise. 241, the estimate 223. Equity futures come off the highs, now positive by just about 0.9%. And in the bond market, just another leg lower in bond yields. We're down about 3 or 4 basis points on a 10-year to 4.12. Lisa, just reading between the lines, weaker than was expected.
Yeah, and if you look at the continuing claims, that is actually particularly interesting, as Mike mentioned. It's actually the highest reading going back to late 2021. So you saw a real jump up. And there's a question here, how much is this people not able to find a job on the other side after having left the workforce? And that might raise a question about the stagnancy of a labor market that isn't very forgiving for people who might get kicked out of it in some capacity.
The range of estimates for tomorrow morning, incredibly wide. At the high end, we're at 171. That's the estimate for payrolls. At the low end, we're at 50. The median is 135. And Mike, the conversations we've had so far this week regarding payrolls have been very, very different. We've heard from Torsten Slock of Apollo, who's made the case that perhaps you could see a big downside surprise, maybe even a negative print. And other people, many in fact, Mike, have made the point that it's too early to expect the tariff volatility of the last month to hit hard data like payrolls. Mike, what are you hearing?
I think the latter view is correct. It is pretty early because the president announced his Liberation Day tariffs on April 2nd and then backtracked on April 8th, I think it was. And those are just at the very beginning of the cycle for the survey for the April jobs numbers. So they probably didn't have as much of an effect. but we will see it probably going into later months. And of course, the jobless claims numbers we got today were for last week, way after the survey week. So this jump doesn't mean anything in terms of what we're going to get tomorrow. But if this continues, it presages maybe we get real slowdown when we get the May numbers in June.
Do you have a sense, Mike, of what people make of these initial jobless claims? It used to be one of the most high frequency and important tells, and then it went flat and people started to dismiss it as maybe not necessarily reflecting what truly was going on. How much are people using this to really model forward how we're going to see the labor market progress?
Well, I think what people are doing is looking at it as a sign that we have a fairly static labor market, that we're not losing a lot of jobs yet. Now, the thing that happens is when we start to see these jump up, other than the 1 week or two blips, they tend to go very quickly. And so if that starts to happen, then you'll see people get really worried about what we're going to see in payrolls.
Mike, appreciate the updates, sir. Mike McKee there, breaking down the economic data. If you're just joining us, an upside surprise, the wrong kind on jobless claims, 241, the estimate 223. And as Lisa pointed out, continuing claims more elevated than expected as well. Joining us around the table, Nita Richardson of ADP. Nita, good morning.
Good morning.
Big downside surprise on your number yesterday. Right. What drove that?
Hiring hesitancy. There is a price of unease and a price of uncertainty. So I want to go back to what Mike was saying about the reference week, because I think this is very significant. The reference week includes the 12th of the month. And so we were at a time of peak uncertainty for small businesses, medium-sized and large businesses at this time period when this data was being collected, both in the ADP numbers and the BLS numbers. So what you might be seeing in the reflection of that 62,000 is a hesitancy. It doesn't mean it's a turning point, meaning that the labor market is being weakening. It could just be that people just let up their foot off the gas a bit when it came to hiring and went into wait and see mode. We've seen this before, and it was followed by a surge in hiring. So whether it's hesitancy or a turning point, it's the May data that will tell you.
I think it was Jamie Dimon at JP Morgan who last month said clients had gone into what? Wait and see mode. How many times have we heard that phrase?
And how that's going to translate into very noisy data that may give one signal, but maybe not the one that's the correct one. In other words, could we see negativity that doesn't really translate in terms of payrolls maybe in May or June or July?
Do you think that introduces some downside risk for this month, for the payrolls figure tomorrow?
Yes, I definitely do. This hiring hesitancy is prevalent. What I'm looking for is it going to be more frequent? Are we going to get more frequent pullbacks from employers who are like, let's wait and see, let's brace ourselves for what's coming? We don't know that. So far, even if there was a hesitancy, as I said, there was a rebound the previous month. So at ADP, we have a lot of data. We look not just at the jobs, but hours, because before an employer cuts a job, they cut an hour. We actually saw that hours ticked up. Then we went into payrolls. We pay about 1 in 6 workers in the United States. We saw for people who switched jobs recently, pay growth went up. So the elements of the labor market are still solid. It really looks like employers are taking a pause, especially when there was a lot of uncertainty in that mid-April timeframe.
You say, as you look at all of this data, that you don't see a recession anywhere in here. This looks like really a strong labor market. How quickly could that change? I mean, is that something that is vulnerable, or is this really a very solid backdrop with a lot of uncertainty? Because why would anyone make big moves right now?
Right. So every year you're going into a year with a 1 in 4 chance of recession, about 25%. And so the question always is, what's the trigger? Well, we know what the trigger is in this point, how people are responding to what could be a transition in terms of higher prices from tariffs. The trigger is obvious to everyone. It's not always obvious going into a recession. We're also going into, we're still in an environment with higher than normal inflation and interest rates. So there is some trigger components that could lead to softness this year, but it's not yet coming from the labor market. It's not yet coming from a reduction in consumer resilience to the point that it's troubling. Even if you look at that contraction in the GDP numbers in the first 3 months of the year, you saw a moderated consumer, but not a down and out consumer. You saw that, domestic, the real economy grew by 3%, even as those imports swamped that growth. So Main Street's still okay. we don't know how long that lasts yet.
We're going to get ISM manufacturing data a little bit later this morning, and there's this question about whether some of the changes are going to cause employers to pull employment back to the United States, particularly in the industrialized sector. Are you seeing any signs of that, any increase in hiring?
Yeah, in fact, for the goods sector, it was pretty stable, but it wasn't as strong as it was the last 2 months in manufacturing. We saw this abnormal pickup in hiring in the first 2 months. I don't credit that with bringing employment back to the U.S. I think that's going to take a much longer time, because what that suggests is that you're not just bringing in people, you're bringing in infrastructure, you're bringing in facilities, you're having to invest. If you're a goods manufacturer, this is not a 3-month turnaround story. This is a yearly, maybe even decade-long story. So we're not going to see that impact very, very quickly. This is really employers responding to the here and now of the policy rather than making big bets on the next 10 years.
Anita, I really appreciate this framing because I think it's so important. If we do get a weak number tomorrow, the way you describe it, it's employers basically reacting to an event to go into wait-and-see mode, and not the start of a process for them where they start to lay people off, which could mean we start to go into recession. Now, you can do that for 1 month. Problem is, you start to do that for 2, 3, 4, it takes on a life of its own, and that's the risk here. That's why you're playing with fire with these kind of policies.
And it's also the reason why you're playing with fire when you extrapolate out a trend line based on one data point that might confirm a bias in the market, which is that things are going to be weakening. If you look under the hood, as Neela was saying, I think that is the most important, that hours actually went up and that pay increased for people who switched jobs. This is not the hallmarks of a market that is absolutely tanking.
If we get a weak number tomorrow, I'm pretty sure a lot of people will extrapolate that
100%.
Like several years.
Yes.
End of cycle type stuff. Nita, thank you. It's good to see you.
Always
as always.
A pleasure. Thank
Nita
you.
Richardson of ADP will attempt to bring some balance to that conversation if we do get a downside surprise. Mike McKee joins us now for more. Mike, I want to talk about not just the labour market data, but the potential Fed response to it. You're going to catch up with the Fed Chair, Jay Powell, next week when you head down to Washington, D.C. for the news conference. Now, nobody's expecting a change to policy, but Mike, I'd love a question from you to him if possible. The Treasury Secretary, Scott Bessent, said this morning that the fact that the 2-year yield was trading below Fed funds was evidence that the Fed was too tight. Mike, how do you think the Fed would respond to that as a question?
I think at this point, the Fed would probably look beyond it and say, we don't know that. I mean, we want it tight right now because we're still trying to bring down inflation to its target, but the tariffs could be inflationary. And the last thing the Fed would want to do is cut rates and then have to raise them again if inflation started to go up again. So they would dismiss something like that. I do want to point out, John, that tomorrow, the idea of a weak number is kind of off the mark for the Fed, because the Fed's going to look at the unemployment rate rather than the number of jobs created. 138,000 would be okay for the Fed because they think you need about 100,000 as a replacement rate. So they wouldn't worry about it, but it may get the market's attention. They're going to keep an eye on the unemployment rate because that suggests then that companies are taking active efforts to manage a downturn.
Unemployment at the moment, 4.2%. The estimate for tomorrow morning, 4.2%. Mike, thank you, sir. Mike McKee joining us on the data and a look ahead to the Federal Reserve next week. To extend that conversation, with us around the table now, Ian Lingen of BMO Capital Markets. Ian, good morning.
Morning. Thanks for having me on.
I'm going to repeat that question for you. The Treasury Secretary, Scott Bessent, said because the 2-year yield is trading below Fed funds, it's evidence that they are too tight and they should cut interest rates. What's your response to that?
It's suggesting that the market anticipates that over the course of the next 24 months, effective Fed funds is going to be lower than it is. That doesn't mean that now is the time to cut. That just means that the market is telling us that the Fed will resume normalization at one point.
Does it concern you that there is so much discussion around Fed policy from administration officials?
Well, we came into this knowing that there was going to be some political pressure put on Powell. There's been conversations coming out of the White House about potentially removing him. I don't think that that's really in the cards, nor do I think that's frankly possible. It's not surprising, however, that we have started to see some negotiations with potential replacements for Powell coming into, whether it's via the media, whether it's conversations that have been had at the White House. So I'm not really surprised, but somewhat apprehensive of the uncertainty created by this political pressure.
Well, that's what I was going to say. On the margins, does this affect not just Fed policy, but also how the market responds to it if there is this feeling that there will be somebody else coming in, that there could be a shadow Fed, that there is pressure increasing job owning, and frankly, that Fed officials may feel like any decision or words that they say will be interpreted in a political way, both in the market and in the White House?
I don't think it's really atypical for the administration to be pushing back against any given Fed or any head of the Fed. But what I think what's so unique in this cycle is how vocal and how real time it has become. Typically, you would expect any sitting president to want the easiest monetary policy possible, but Powell's objectives are for the long-term stability and health of the U.S. economy, which involves price stability, and that's the battle he's fighting at the moment.
Ian, because it's so vocal, and the Fed chair had to come out and say this is inappropriate in a sense, saying by law he's allowed to stay in his job. Does it make it harder for them to cut rates if they had to? Because then it just looks like they're placating the President of the United States.
Well, I think something that we've learned over the course of the last several weeks is, yes, there's a Powell put, but there's also a Trump put. And the Trump put is struck higher than the Powell put. Powell doesn't want to encourage and reinforce behavior in the White House that isn't necessarily going to be good for the long-term health of the economy. And so, to your point, I think that when Powell deems it time to resume normalization, that's when it happens, and he won't give in to the political pressure.
Following the Treasury Secretary's comments about the two-year rate below the Fed funds rate, Neil Dutta put out a note and said wage and salary growth is running below the level of Fed funds rate as well, meaning it's already too tight. What do you make of that argument? Well,
I will argue that the bulk of what has occurred over the last 6 or 8 weeks has been really a uncertainty-inducing event, and it follows intuitively that as some of the backward-looking data could suggest that it's time to cut rates, that the market is focused on those aspects of it. There's also aspects of the data that suggest that the Fed should continue to remain on hold until September or later, which is actually my assumption at this point.
It's a really difficult moment. Take the numbers from Visa. We mentioned this just yesterday. We've not seen any signs of overall consumer spending weakening. That's from the CEO. From McDonald's right now. This is what they're saying. They're cautious about the overall health of the consumer. They're seeing pressure hitting the middle-income consumer in America and elsewhere. Pick your poison right now. It's difficult.
And that's the reason why cruise liners are up. But if you look at one cruise liner, it's up, but maybe not the other. And then you have people saying, well, sometimes companies are just trying to use the circumstances as an excuse to talk about weakness that might have already been present in their business models. It is difficult to understand whether this consumer is going to be tolerant of price increases or not, which is the reason why you might see some testing by companies to see, let's get a sense, can they absorb this and can we pass it along?
I don't think it gets any easier from here. You're going to see way more distortions in the data for weeks, maybe even months to come. Ian, it's wonderful to catch up with you, sir. Appreciate it. Ian Lingen there of BMO Capital Markets. Equity futures at the moment on the S&P 500 higher by about 1 full percentage point, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Recapping that latest data, an upside surprise to jobless claims hitting their highest level last week since February. Initial claims coming in at 241,000. The median in a Bloomberg survey of economists was calling for 223,000 applications. Continuing claims also coming in elevated, rising to 1.9 million. And McDonald's shares are falling nearly 1.5% after reporting a sales decline in the first quarter. Sales dropped 1% globally compared to a year ago, driven by a big decline in sales in the U.S. The results suggest that McDonald's focus on value meals has not been enough to get anxious consumers to spend. And General Motors shares are rising 3.7% despite lowering its full-year profit outlook. The automaker cited exposure to as much as $5 billion in tariffs. GM's lowered guidance comes even after Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Ed Ludlow, looking ahead to numbers from Apple and Amazon. From New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Equity futures on the S&P still elevated here by 1 full percentage point on the S&P 500. Lots of earnings to talk about. Let's get you some movers. We can do that with Danny Berger. Hey, Danny.
Hey, John. And I got to say, this is a market that's very willing to reward earnings when they show up and they beat. The tech giants so far have shown us this. Microsoft, one of the biggest gainers pre-market on the S&P, up more than 8.5% this morning. Their cloud business, really strong results, just shows the AI demand. And the company underscoring the fact that they still are going to be investing in AI despite some of those reports of canceled U.S. data center leases. Same goes for Meta. Post-market yesterday, also strong results too, that's sending their shares higher by 6.8% this morning. Mark Zuckerberg saying that we are ready to weather economic uncertainty, macroeconomic uncertainty. Results beat, forecast beats, and at the same time, the company being rewarded for that, up 6.8%. Finally, GM, even though the numbers weren't good, the shares are higher. We finally got some contours of what a tariff hit might look like to them. It is a profit lowered by $5 billion for the entirety of the year. But Mary Barra is saying that they're continuing a dialogue with the Trump administration. Perhaps that's why shares are higher, saying that they will remain nimble. Those shares up 3.7%, John.
Danny, thank you. A couple of names to watch going into the opening bell. That opening bell is about 38 minutes away. As we count you down, your calendar, your trading diary looks a little something like this. At 9:45 Eastern Time, we'll get some PMI data. ISM manufacturing at 10 a.m. Look out for that. Then after the closing bell, two big names, Amazon, Apple. Tomorrow morning, the payrolls report, and next week, of course, a highlight of next week, looking ahead to Wednesday, Fed rate decision and Chairman Powell news conference. With us here in New York, I'm very happy to say Ed Ludlow joins us with a preview of two big names after the closing bell. Let's start with Apple. Yeah. What's front and center for you?
Yeah, this is a company that makes consumer electronics, and all of those parts are moved from one jurisdiction to another around the world. And so if you want to learn something about not just the impact of tariff is a levy, a cost. But as we've been reporting in detail, there's also an issue of moving a good across a border and a customs review and all the stuff about, flying tons of iPhones out of India into the United States. I think you're going to get a really real answer on what's going to happen going forward. Forget the numbers in the quarter gone, I think is what my mate Mark Gurman would say, and look forward.
How easy is it to move production out of China to India to satisfy the demand here in the US?
It's not easy. Basically, there's a limit on the number of handsets that India can produce currently. Of the millions it sells around the world, it's I think 20-25%, right? So it's also more about when you have an assembly facility, we talk about Apple being highly vertically integrated, but it relies on a contract manufacturer, Foxconn. That contract manufacturer in small cities in China has all of the critical parts suppliers with buildings literally around it. That infrastructure doesn't exist in India currently at that scale. So it's not just saying, oh, I've got to put my assembly plant in India. It's about saying, and then I've got to get the screen and RF components also nearby, and that takes time and money.
There's a large they've been able to get on that train quickly enough to be competitive so that they get some sort of competitive edge and market share. What are we expecting to hear today from that?
I was looking around the table. We all have iPhones, right? I don't use Siri. I haven't used it since it...
Never used it once.
Yeah.
No, once. Don't even say.
I use ChatGPT, I use Meta AI, I use Grok, and I use Gemini to an extent on a daily basis. And the Siri functionality, I think the reporting's there that it was sort of rushed and it doesn't offer anything useful. Now, we did have a piece of news that you may have missed amongst everything in the last 24 hours, that Sundar Pichai of Alphabet talking up the prospect of Gemini and its integration into Apple. What we know from Mark Gurman's reporting in particular is that the heads have rolled, right? Executives have changed, the structure of the org has changed. But really, it still is a story about handsets. You know, how many handsets do you sell? And whether the attractiveness of the software helps that or not, I think that's what they will focus on.
Ed, it's good to see you. Great to catch up. Look out for Ed Radlow, Caroline Hyde at 11 a.m. Eastern Time for Bloomberg Technology. Look out tomorrow, 8:30 Eastern Time. Payroll's just around the corner.
At a time when we have the lowest two-year yield going back to September of last year, as people take a look at what we just saw with initial jobless claims, the unkind kind of upside surprise, what does this mean for what's coming?
I'm interested to see what the Truth Social is going to be. Jonathan, you talk about the drafts. I'm sure there's a draft saying that it's Biden's data if it's bad, and there's a draft being worked up if it's really good data. That's all the tariffs and manufacturing and those jobs coming onshore.
Looking forward to the reaction from the strategist, President Donald Trump, a little bit later this week. Coming up tomorrow, Priya Misra of JP Morgan, Sarah House of Wells Fargo. We'll catch up with Jeff Rosenberg of BlackRock, Mohammed Al-Aaron of Queen's College, Cambridge. From New York, thank you for choosing Bloomberg TV.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Defending champion Iga Swiatek avenged her defeat to Madison Keys in the semis at the Australian Open with a 3-set comeback win to reach the Final Four. After losing the opening set 6-love in just 24 minutes, Swiatek found her feet on the dirt, dropping just 5 games in the last 2 sets before closing out the win 6-2 in the decider.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are going for an 8-day winning streak, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, strong tech earnings are setting the stage for stocks to rally for an 8th straight day.
Coming up next, Apple and Amazon headline the busiest earnings day this quarter, with companies worth a combined $9 trillion reporting numbers today.
And uncertainty remains the buzzword as corporate America seeks clarity on Trump's tariff strategy. All of that and more coming up. But let's take a look at some of those stocks, because Microsoft cloud growth surged last quarter. It did slow down spending for its data centers that are crucial to its AI ambitions, not slowing down the stock at all, up 9% pre-market.
So Meta, Facebook, Instagram, quarterly sales beat estimates. The company raised its AI CapEx plans as well for the full year. The shares are up 7% in the pre-market.
Got another Mag 7 name. Apple, though, down pre-market. It reports after the bell. Overnight, a federal judge ruled that its app commissions are violating a court order, Katie.
And as we count down to Apple and Amazon, the Magnificent Seven earnings so far have been mostly positive despite global market volatility, with Meta CEO Mark Zuckerberg confident in his company's position.
We've had a strong start to the year. Our community keeps growing, with more than 3.4 billion people now using at least one of our apps each day. Our business is also performing very well, and I think we're well positioned to navigate the macroeconomic uncertainty.
Let's discuss now with Bloomberg Technology co-host Caroline Hyde. So we got Microsoft, we got Meta last night, and the stakes were high in terms of broader market sentiment, and it looks like the two of these did deliver.
And they're both going to wipe away the stock market losses of this year. If we hold on to these gains, boom, they're then flat, if not higher for the year if you're looking at Microsoft. This is such a relief. You're seeing such a relief that not only are people, more and more people are using Meta, more and more people are using the AI that they offer to build ads on them. They're able to charge more for those ads, and they're sticking with the Meta, with the alphabets, despite these market uncertainties. The fact that Meta was able to give guidance, resilient guidance of growth, we're still going to see revenue up about 14% in the next fiscal quarter. That is why you're seeing this relief rally. And notably, you're also saying, look, we're still building in on that CapEx. We're going to raise that from $64 to $72 billion. Look, that's where the tariff hardware hit comes in, because infrastructure, lots of it, hardware coming from abroad, going to be impacted by tariffs, so they're going to commit to still rolling out their overall compute needs for themselves. That's going to cost more. When you're looking at Microsoft, they are, unsurprisingly, perhaps a little bit more conservative in terms of the spending on capital expenditure. They say it's still going to grow, but not to grow as fast as it has been in the past. And in fact, for the first time in a couple of years, we saw capital expenditure just come down a little bit in the previous quarter, 24.1 billion. But again, Amy Hood really showing that resilience, able to give a forecast. People are still turning to Azure for their compute in this market.
They're crushing it. Massive gains in the pre-market for the M's. The A's are up next, right? Apple and Amazon. So what do we expect?
Well, I'd also think we should turn our attention to what just happened in Apple. In pre-market moves will be lower because they got a crushing defeat in terms of the courts. This is the epic battle that has been going on for more than 4 years with Epic Games. This is Tim Sweeney finally winning out once again, as Apple had appealed, saying, look, you cannot keep charging me the commission that you were asking me when I'm going off of Apple's App Store. Now,
the judge here is saying that Apple, in many ways, is in some ways potentially a criminal act here. They're saying that you lied under oath, that you've been, in any case, been trying to be anti-competitive. This is a big blow to Apple, I think, from the App Store perspective, so keep that one in mind. But look, we're likely to see a lot of pull forward. You're going to have a lot of people rushing out to get their iPods, to get their AirPods, I should call them. No one gets iPods anymore. But their AirPods and their iPhones. So there'll be a resilient set of numbers for Apple, I think, going forward. But what will they guide? How will they manage to give a picture of what the next quarter looks like when they're moving all their infrastructure build really into India at the moment? Apple's going to be one to move, and Amazon, boy, that had a tough week as well, didn't they? Remember how we started with the eye of the storm coming from the White House? What will they say in terms of tariff impact on consumer sentiment? Cloud probably still going to be strong.
All right, Caroline, thanks very much. Caroline Hyde is the co-anchor of Bloomberg Technology. You can catch her program at 11. Obviously, they're going to be highlighting all of these earnings beats as well. I want to switch gears, though, now to automakers. GM has slashed its full-year guidance after revealing a $5 billion exposure to auto tariffs. The news is one of the biggest financial hits revealed by any company from President Trump's trade war. Obviously, it's far worse than when Ford said it was going to take a $4 billion hit for its EV investment. Joining us now to talk about this is Bloomberg's Keith Naughton out of Detroit. So General Motors really taking a hit, Keith, from these tariffs.
Yeah, they certainly are, Matt. $5 billion is a lot of money. It's interesting, though, because analysts a week ago, before the tariff relief that Trump delivered on Tuesday, were saying GM would take a $10 billion hit. So it's not as bad as first feared because of this recent auto tariff relief, but still quite bad. And they also say it's going to lower their earnings for the year.
I also want to talk about Ford, Keith, because you did see them come out and say that they won't increase the price of vehicles until they see what rivals are doing. How do we expect the industry to be reacting now that we know a general sense of the costs?
Yeah, and GM just on its call said that it's also holding its fire on price increases. These changes in the auto tariffs are causing the whole industry to rethink. Ford had earlier told its dealers that it would start adjusting prices in May, but now they're saying they're going to hold off. They're going to see what their competitors do. It's going to be an interesting summer for the auto market because if the prices do go up, these very go-go sales that we've had this spring will certainly slow down.
All right, Keith Naughton, we appreciate your reporting. We do want to bring you some breaking news right now. This coming from the retail sector and Kohl's. The shares are halted right now for news pending, and we just got the news. Kohl's announcing that the board has terminated its CEO, Ashley Buchanan, for cause. According to the company, Buchanan violated company policies, and this investigation was conducted by an outside counsel. Now, in the meantime, they have named Michael Bender as interim CEO, but the board will initiate a search to identify a permanent CEO. So just to read you that breaking news headline once again, the board of Kohl's has terminated its CEO, Ashley Buchanan, for cause, Shanali.
And we are going to switch gears now. We're going to go back to the earnings season because over in healthcare, CVS boosted its profit outlook, and it also negotiated a deal to make Novo Nordisk's Wegovy more available to its members in a blow to Eli Lilly. Let's discuss this with Bloomberg's Madison Muller. This seems to be the trend, keeping prices low, making the drugs more available. Matt Miller is smiling somewhere, I think.
Exactly. I know we've talked about this already this week. This comes on the heels of Novo announcing deals with telehealth companies earlier this week to sell its drug Wegovy for half the price of its U.S. list price. And now they've negotiated a deal with CVS to do the same thing in retail pharmacies. CVS operates 9,000 retail pharmacies nationwide. So patients who go shop at those pharmacies now will be able to get Wegovy for half the price, more than half off the price. And then they are also negotiating a deal with CVS's drug benefits unit, which works with insurers to manage drug benefits for their health plans. And so companies and insurers that use those, that have health plans that are managed by CVS, will be able to pay less for the drugs. So it effectively saves them money and makes Wegovy more widely available.
let's focus on Eli Lilly a little bit more specifically here, because it feels like they got a double whammy this morning. I mean, CVS announcing a plan to drop Zepbound, their version of weight loss drugs. And then you also had them report, and they beat on earnings, but the guidance was tempered a little bit. And you can see shares moving lower right now to almost 5% in the pre-market.
Exactly. The expectations for Lilly are just so high, and that was sort of the sentiment this morning, is people expected them to raise their guidance. They ended up cutting it, which was not... It's a little bit tricky because they cut it on research and development costs, not because of any real impact. And so they, investors were looking for a better result for them this morning. And even though they beat, it was just not enough to satisfy them.
All right, Madison, thanks so much for joining us. Madison Mueller talking about the continued news on weight loss drugs and a combination with, or I guess a joint venture, in a sense, cooperation with CVS. We're watching a number of other companies moving after earnings. McDonald's sales slumped on consumer anxiety. I think same-store sales were down 3.6%. The shares are up 1.33%. Harley-Davidson shares are up. But what a disappointing slate of numbers from the MoCo out of Milwaukee. I think global shipments dropped to 38,000. That's a 33% drop. They sold 33 live-wire electric motorcycles in the first quarter. 33 globally.
Crazy.
Those shares are up almost 2%, but they have lost a quarter of their value year to date. And then Robinhood rising. Investors flock to the retail brokerage to trade the wild market swings. Obviously, this is good for Vlad Tenev's business. The shares are up 4.25%. He is going to join us at 10:30, so stay tuned for the Vlad Tenev interview this next hour.
Yeah, we also want to take a look here at Kohl's, as Katie had mentioned earlier in the breaking news, that they are terminating their CEO, Ashley Buchanan. They have cited a violation of company policies after an investigation by an outside counsel, and they are looking for a new permanent CEO. But this is the year-to-date shares, guys. It has been down more than 52%. Shares have been halted in the wake of the news.
Yeah, and the board also saying the company that Buchanan directed transactions with conflicts of interest. So we're looking for more details there. They also announced preliminary results. This company wasn't supposed to report until May 30th, but they came out and said that their preliminary comparable sales for the first quarter were between -4% to -4.3%. So a lot of bad news there. Shares still halted. We'll bring you the update once they start trading again. But coming up, Tesla denying a report that the EV giant is searching for a new CEO. We'll take a look under the hood next. This is Open Interest.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In case you missed it, on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding, That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Let's get to high interest now. Look at what's making headlines around the world. President Trump is acknowledging that his tariffs may result in fewer and more expensive products.
He said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, you know? And maybe the $2 will cost a couple of bucks more than they would normally.
Many American toy makers and retailers have started to pause their orders as the effects of the tariffs threaten to hit supply chains. Roughly 80% of toys sold in the U.S. are made in China, according to the Toy Association. Now, chip giant Qualcomm is sliding in early trading after giving a tepid revenue forecast. The outlook is renewing fears that the smartphone maker will suffer from a looming trade war. Qualcomm is seen as highly vulnerable to the tariff fallout, given that nearly 46% of that company's sales come from China. And Tesla chair Robin Denholm is denying a Wall Street Journal story that reported the board was looking to replace CEO Elon Musk as investors worried about the amount of time he was devoting to his role in government. In a post on X, Denholm wrote, quote, earlier today there was a media report erroneously claiming that the Tesla board had contacted recruitment firms to initiate a CEO search at the company. This is absolutely false, end quote. The CEO of Tesla is Elon Musk, and the board is highly confident in his ability to continue executing on the exciting growth plan. I guess the quote ends there. Sorry, Shonali ended that too early, but definitely a denial.
Definitely denial. We're going to bring in now Bloomberg's Max Chafkin for more on Tesla, and this denial of this Wall Street Journal report was interesting, particularly because you've seen the chair, Robin Denholm, be very silent on this issue before, regardless of analysts after analysts and many other investors saying that maybe Musk is pretty distracted. Maybe he should return to one job.
Yeah, I mean, if this were a normal company, I think a CEO search would probably be, you know, totally expected, right? You have wild swings in the stock price. You have a CEO with multiple jobs, a lot of controversy. Like, of course they would be considering their options. But Tesla, of course, is not a normal company. You know, we got to remember, this board has been trying to pay Elon Musk an enormous amount of money. It's been having this huge fight with Delaware courts over a $50 billion plus bonus package, despite the fact that, you know, you look at the stock price, right? It hasn't exactly done well in recent years. So this is a board that is very much behind Elon Musk, and an investor base that is very much behind Elon Musk. So it's not totally surprising that they're coming out and saying, hey, nothing to this story, you know, let's on to the next.
And you talk about the investor base, and we certainly saw that when he said on the earnings call that he was going to spend significantly more time on Tesla. The stock soared after that. So talk us through the next month, because now, I guess we're in May, it's May 1st. Now is theoretically when he would start stepping back from Doge.
Yeah, I mean, it's not clear to me how much stepping back there really will be. Elon Musk was at a cabinet meeting. He was wearing 2 hats, which, you know, now seeing this Wall Street Journal report maybe seems like a wink or something at the idea that maybe he's wearing too many hats. He shows up to a Trump cabinet meeting wearing 2 hats. President Trump says you can stay as long as you like. I believe later today he's going to do an interview on Fox News. So, you know, he is still going to be engaged in politics. What he is saying, if you look at it closely, is he's no longer going to be essentially camped out in the executive office building, which I do think is going to be a good sign for Tesla shareholders. But if they're hoping to avoid the kind of negative brand associations, you know, these protests, the anger that we're seeing, that I don't think is going to go away.
All right, Max, thanks so much for joining us. Bloomberg's Max Chafkin talking about Elon Musk in this picture wearing a hat that says Trump was right about everything. And I wonder if he still feels that way when he looks at how the tariffs are affecting his car sales. In terms of Ford's car sales, they rose 16.2% in this country in April. The company said U.S. sales were boosted by Ford's employee pricing for everyone discount campaign. So we continue to get car news, and global trade, it turns out, is cars. Cars is global trade.
Certainly, and we're going to keep a close eye on that auto sector, but we're also going to keep a close eye on some more movers on our radar. We're looking at NVIDIA because the CEO had asked Trump to change AI export rules, but of course we also had those big tech earnings last night that were very promising. So you are seeing NVIDIA on the rise this morning, almost 4.6%. Roblox up 7.3%. They reported a larger than expected jump in active users for the first quarter. Daily active users rose 26%. Also watching MasterCard up about 1%, but remember, people are watching consumers very closely, and revenue topped estimates even though purchase volume missed. Katie.
All right, so that's some of your pre-market action. We're about 10 minutes away from the opening bell, and we're going to begin today's trading day with Laffer Tengler's Nancy Tengler coming up next. This is Open Interest.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
I think COVID is probably somewhat of a proxy for this. Maybe the important difference being, we had this massive uncertainty, sort of freeze activity, but at that time we kind of knew not only what the solution would be, health-related solution, vaccines, but also massive, massive stimulus, both of the fiscal and monetary variety. Now, when you don't really know the rules of the game, trying to gauge, okay, what ends this?
That was Liz Ann Saunders from Charles Schwab speaking on Bloomberg Television this morning. And let's keep the conversation going now with Laffer Tengler, CEO and CIO Nancy Tengler. Nancy, great to see you again. I think Liz Ann makes some really interesting points when you think about COVID being a proxy to this period, but it's unclear what the solution would be when you think about the tough economic data we got yesterday morning. I mean, you can't really envision a scenario where the government would come out with stimulus. It's unclear whether Fed rate cuts would help, and I don't know what a vaccine would do here. So in your view, what turns this ship around when it comes to some of the worrying signals in the economy?
A vaccine against tariffs. Yeah, thanks, Katie, for having me. I think she's right. I think there are a number of analogies, but I think what we're getting as an inoculation is we're getting much better earnings than many expected, including me, across the board. I mean, we were optimistic about earnings, but I've been happily surprised. And the guidance, importantly, has been decent and in some cases really good. And so I think that's one of the things that has catalyzed stock prices. We've gotten less chaotic messaging from the White House, so there seems to be more strategic understanding and communication, and I credit Scott Bessent for that. The Fed is on the sidelines, so I think you're right. I don't think we'll necessarily get a cut, but I think as investors, we need to always be looking forward. And what I heard a lot of my colleagues saying in the industry was that the AI trade was overdone. And I think what we're hearing from the likes of ServiceNow and Microsoft is that it's not even close to being done. And Google and Meta are still spending, reiterating their CapEx budgets. So I think all of that is bullish, and that when we begin to see the sort of tariff stop, we'll be good.
I'm glad you brought up Scott Bessent. He said earlier, I think he was on either Fox or CNBC, that because the 2-year is so far below the Fed funds rate, it means that they should cut. He's jawboning Jerome Powell as well. And here you see how far down we've come on the 2-year. Neil Dutta from Renaissance Macro put out a note earlier. The Treasury Secretary knows how to feel the market. He says wage and salary growth is running below the level of the Fed funds rate as well. That's a sign that past policy has already been too tight. Why doesn't Jerome Powell just come out and cut? Inflation be damned, Nancy.
Well, I actually agree with Neil, and we've been really vocal on this. The Fed chairman has been 100% wrong at every turning point. And I think that when I make mistakes, it engenders humility, and I make them every day. But there is no humility from this Fed, and he's right. Real wages, real rates. This would be a good time, as opposed to August and September when we cut 50 and then ultimately 100 basis points, and the 10-year rose. So 100 basis points. So I think the market has expressed a lack of confidence in this Fed, and I think the stubborn sort of heels dug in, we're going to wait for the data. That just means, that guarantees they're going to be too late.
Nancy, you're going to stick with us through the open, but before we get there, let's get a check, Katie, on these markets.
Yeah, we got green on the screen. It is going to be the first official trading day of May, continuing that rally that we've seen. Somehow April was actually a really quiet month. If you just take a look at the monthly performance, down only 0.8%. We saw some pretty amazing intra-month action there, but all things considered, pretty quiet overall. You can see the S&P 500 up 1%. It's big tech that's leading the charge today on the biggest earnings day of this season. We'll bring you the details next at the opening bell. This is Open Interest.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, and futures are very positive, more than 1% on the S&P 500. You can see the gains on the NASDAQ, 1.6% as tech earnings come in strong. Meta and Microsoft really knocking it out of the park, moving higher in the pre-market, and we're waiting to get Apple and Amazon after the bell. You hear the opening bell, and down the New York Stock Exchange, you've got a company, Core Molding Technologies, out of Columbus, Ohio. Probably the greatest city in the greatest state of the nation. It's worth like $100 million. And then down at the NASDAQ market site, SkyCorp is a Chinese company that's very excited to ring the bell there as well. They've had a lot of Chinese companies at the NASDAQ. Maybe they're trying to, a solar company at that. So Chinese and green, Katie. I wonder if they're trying to make a point.
Yeah, it's an interesting mix, but I want to get to Kohl's. This breaking news in the last 20 minutes or so that Kohl's says that the board has terminated CEO Ashley Buchanan due to undisclosed conflicts of interest involving a vendor. So firing him for cause. Shanali, he only joined earlier this year. You can see the shares are up about 6% right now, so traders clearly reacting positively.
Also some positive news here. You have some big tech on a tear. Microsoft cloud growth surged last quarter, but it did slow down spending for data centers, crucial to its AI ambitions, yet you see Microsoft up more than 10% at the open. Meta quarterly sales beat estimates and raised its AI CapEx plans for the year. They say it's getting more expensive out there. It's up, though, almost 8% at the market open, Matt.
All right, so there you have, Shanali brings us the M's. I'm looking at the A's. Going to report after the bell, Apple and Amazon. And overnight, speaking of Apple, a federal judge ruled that its app commissions violate a court order. Essentially that Apple breaks the law. Essentially that Apple is doing illegal stuff. So maybe that's why you see the shares down early in the trading. Amazon right now up about 3%, Katie.
All right, let's dig into these earnings with Bloomberg Technologies' Ed Ludlow, who's sitting to my left in New York City. It's great to see you.
At least you don't pretend that I'm not sitting to your left. I remember last time I was in New York, Matt's like, he joins us from, New York City. Thank you.
We're always glad you're here.
Thank you.
You know,
it is
it's too rare.
A unique privilege to speak to you today on the biggest earnings day of the earnings
probably
season.
is, yeah.
Apple, Amazon coming up after the bell. Like Matt said, we had the M's knock it out of the park last night. What are we expecting from both of these companies? Because there's a lot of drama surrounding both of them this week.
No, I think we start with Apple, and it's just tariffs related, right? Apple makes consumer electronics and electronics generally, and those are physical things where components come from all over the world and are assembled largely in one place, China, some in India. And so we talked a lot about the impact of tariffs on largely bottom line, actually, if you think about how it might pressure margins. But the tariff as a levy is one thing. The trade implications of moving parts from one place to another is an operational risk. And so how Apple talks about supply chain adjustment going forward, the movement of components from place A to place B, and the final product from market A to market B, I think that we'll learn quite a lot. Tim Cook often says, I am not an economist, but you'll also get that macro readout as well.
I want the skinny on Amazon because a fair bit of drama this week already with the scuffle with the White House and then them saying they will not post those price increases relative to tariffs, but that doesn't mean per se that they won't happen, right?
Yeah, Amazon is much more analogous with what we saw from Alphabet and Microsoft and Meta, right? The story for those three names is core business strong, top line growth, supported by AI investment that justifies further capital expenditures growth. Amazon's the same. The cash cow of that business is its cloud unit, AWS. They're the #1 player in that unit. But there will be a tariff discussion because what is Amazon.com? Again, it's the movement of goods from one place to another, and there are cost implications and logistics implications on the consumer. And you're absolutely right that they denied that report from Punchbowl, but conceded it had been a consideration for Hall, which is products basically below $20, labeling it, saying, by the way, this is how much tariffs are hitting you on this product. That ain't happening, though.
Ed, great to have you here. Look forward to your program, Bloomberg Technology, at 11. I want to get back right now to Laffer Tangler, CEO and CIO, Nancy Tangler, and talk a little bit about Amazon, Nancy, you know, Walmart, places we would normally see consumers flock at times of trouble. But what happens when these tariffs kick in? Target, I mean, do you start to see empty shelves? Do you start to see rising prices?
Well, Matt, I think one of the it was great listening to Ed, by the way. I think one of the things that we saw in the GDP report is that there was a pull forward of goods purchases and imports. So whether we see that in the near term or not is yet to be determined. But I like where Amazon sits. It's a member of our 5 for 25 and our 12 best ideas portfolio. If they disappoint on earnings, which I doubt, I think, but if they do, then we'll be in buying more. Just as we were with Microsoft earlier in April, we bought, you know, we added to our holdings at about
Nancy,
$370.
Can I double down on this? Because, I mean, you look across Amazon's website, almost everything that they sell is Chinese, right? I mean, there's just a collection of consonants that make up a name you can't pronounce for everyday products. They're all out of China. I think I saw something like 70% of their products are Chinese. Why do you want to buy that in the era of Donald Trump?
Well, I think you want to buy it for Prime, you want to buy it for AWS, and you want to buy it for advertising. There will be, you know, this is a multifaceted company. So to your point, yeah, we may see prices rise. Amazon is still about 15% the low-cost producer compared to other companies. And so, you know, it may benefit Walmart, which we also own. But I think you have to look at the company in toto, and they've been really cutting costs, focused on eliminating bureaucracy. This too shall pass. There's probably going to be some carve-outs, as we know, in the negotiations with the Chinese, but they will resource, and it will take some time. But that isn't, you know, that isn't any different really than what we see from Walmart. They also get a good chunk of their suppliers come from China.
We can see Amazon shares rallying right now in anticipation of earnings. Looking forward to that after the bell. But Nancy, I'm so excited to talk to you about Tesla and Elon Musk. Of course, the Wall Street Journal reporting that Tesla had initiated a search for perhaps another CEO, and then the board chairwoman came out and denied that. At the end of March, we spoke to you, and you had mentioned that you recently added to Tesla. So as an investor in this company, I wonder what you make of Elon Musk's role in the government and role at Tesla.
Yeah, Katie. Well, so we added, I think, on March 10th, and we already owned it, and we acquired it at about $240 a share. That to us was a good entry point for the name. In the last conference call, the earnings were dreadful, but Elon announced that he was, going to spend more time in the company, and just on a narrative basis, that is positive for the underlying shares. I think you own this stock for the energy business. Yes, they have to sell cars, but full self-driving and AI in general is really what's going to drive this company into the future and the stock price. So anytime we get a chance to acquire it at a reasonable valuation, it's not reasonable compared to other stocks, but compared to its own name, then we step in. But we were actually selling in January in the mid-3s because it is a volatile stock, and you do have to be nimble around the edges.
Nancy, I want to pull up a total return index of the Magnificent Seven because you are seeing a little bit of change. You are seeing Microsoft now in the green, but it is the only stock in the green for the index. You are looking at Tesla being the worst performer of that index, down almost 30% on the year. You talked about the ability a little bit to buy on the edges here. But of the group, what else would you buy given the discounts that we're seeing?
Well, I think Meta looks interesting here. As you know, we had sold that stock and added Spotify instead. And that's been a great decision. They're not all great, by the way, Shanali, but that one worked out pretty nicely. I think you want to pick away at NVIDIA here, and we added at the same time that we added to Tesla, we added to NVIDIA, and I think it was around $108 a share. And so if you're looking out 2 to 3 years, that's probably a name you want to own. Again, the tariffs, the bans, all of that I think will get resolved. And what we're seeing from the Mag 7 in terms of CapEx spending is they're not just reiterating, in some cases, like as in Meta's case, they're increasing CapEx. That's going to benefit NVIDIA ultimately as we look around all of the sectors. We're hearing it from companies that they are investing in AI. So I think you could add to Google here relatively attractive valuation, and those are the things that we've been doing.
All right, Nancy, great day to have you on as we look at the biggest day for earnings this quarter, the market up for an 8th day in a row. Really appreciate your candor and your humility, Nancy Tangler there from Laffer Tangler. Now, some of the movers on our radar today include General Motors. That company slashing guidance, saying that tariffs are going to cause a $5 billion hit in 1 year, and yet Mary Barra still thanks President Trump on CNBC. CVS Health up 6.5%, raising its guidance for the full year profit.
Can we meditate on that? CVS raised guidance. Do you know how rare that is in this earnings season? You can see it being rewarded in shares. I do want to point out that CVS is up 60% on a total return basis this year alone. Of course, They were beaten up pretty mightily, but definitely one of the year's dark horses.
Very welcome reprieve after 3 years of declines, including 43% last year. But this is a turnaround story underway.
Yeah, one that's actually working.
And then you can see Shake Shack, my favorite place to secretly go after work. Thank goodness my wife doesn't watch this program. Up 4 1/3% right now. Shake Shack shares have been hit hard, down I think 35% year to date, but it sees slow single-digit sales growth in 2Q, and investors like it.
Yeah, apparently. So definitely some silver linings that traders are finding when it comes to Shake Shack. But coming up, Apple's earnings test. We'll discuss what to expect after the bell with Craig Moffett of MoffettNathanson next. This is Open Interest.
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Open Interest. A check on the stock market right now. That rally still underway. This is the first trading day of May, and this month is off to a good start. The S&P 500 higher by about 0.9%. Big tech leading the way higher, with the NASDAQ 100 up 1.4% after what we heard from Microsoft and Meta after the bell last night. But Shonali, now the focus is on the A's coming after the bell today.
And one of those A's, Apple. They will deliver results after the close, and shares are down in the early trade after the company suffered a loss in court related to its App Store sales commissions. The judge presiding over the case said that Apple intended to create new anti-competitive barriers and thought that it could get away with it. We're joined now by Craig Moffett, founding partner and senior research analyst at Moffett-Nathanson. Craig is a rare bear on Apple. There's a lot to talk about here, including how people are buying phones to get ahead of the tariffs. But these legal cases alone, how much of an issue does this create? Because you do have a federal judge in this case deferring the company to prosecutors for a possible criminal probe in this matter.
Yeah, good morning, Shonali. You're right. This is a significant issue, in part because the part of Apple that investors seem to be most excited about for the last few years has been services, and this case gets at a very specific plank of Apple's services revenue, and that is charging companies for, or I should say, prohibiting companies from working outside of the Apple platform for handling payments and subscriptions and that sort of thing, and taking a significant cut of the revenues that come because of that prohibition. So the fact that that has been called illegal is potentially material. I would point out, though, it's only one of two really significant cases, and that's before we get to the antitrust cases against Apple itself. The one that we've been watching really carefully is the Google antitrust case, where the payments that Google makes to Apple, which represent about 25% of Apple's operating income, have already been called illegal by the judge in that case, Judge Mehta. And where it's important to note, the current administration has specifically declined to withdraw their own recommendation that those payments be stopped. So it's been striking to us that as that case has developed, and that first you had the finding that the payments were illegal, and then you had the recommendation from the courts that those payments should stop, that it hasn't really been reflected at all in the stock price.
Yeah, $20 billion is not an insignificant amount of payments, even for Apple. Craig, why are you such a rare bear? I mean, I look at the Bloomberg terminal ANR function, and I can see that there are only 3 sells on this company out of 60 analysts. How come this market is so hesitant to say get out of Apple?
Yeah, good morning, Matt. You know, I would, first of all, I would say I am not a bear on Apple. I think I have a tremendous amount of respect for the company. I love the company's products just like everyone else does. My concern has been from the beginning that the valuation for Apple is out of line with its growth expectations. That's, you know, when we moved to a sell rating in the beginning of this year, Apple was trading at something like 2x the PEG ratio of the rest of the Mag 7. So as tariffs the tariff story has developed since April 2nd, tariffs have become almost the only thing that people pay attention to with Apple. But there's some longer term questions that are reasonable to ask about Apple's growth rate that suggests that the valuation was simply too stretched for a company with the kind of growth profile that Apple has, not just now, but is likely to have for the next few years.
Yeah, it's a fair point. I see Apple's PE ratio trading at just around 30, so still quite elevated. Craig, unfortunately, we have to leave it there. Really appreciate your time this morning. That is Craig MoffettNathanson, founding partner and senior research analyst. This is Open Interest.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller, and we're seeing another great day for stocks. 8 in a row. It's going to be the longest winning streak since at least November of last year. The S&P up a solid 1% right now. The NASDAQ 100 up 1.5% after tech companies, the M's at least, knocked the cover off the ball. I'm talking about Meta and Microsoft. You can see Facebook is up almost 5%, Microsoft almost 10%. And then you've got Well, General Motors says that tariffs are going to take $5 billion off its bottom line this year. That is not an insignificant amount of money. The shares are only down 0.5% after the CEO thanked President Trump on CNBC. Harley-Davidson said it only sold 33,000 motorcycles to retail customers. That's down 21% in the first quarter. Only 33 live-wire electric bikes. But the shares are up 4%. Okay, they lost a quarter of their value this year. CVS, as Katie pointed out, raised its outlook. Tremendous day for those shareholders, up more than 7%. And then Kohl's up 3.5% after it looks like, Katie, they got rid of a bad apple from the bunch.
Yeah, let's talk about that. As we reported earlier this hour, Kohl's has terminated its CEO, Ashley Buchanan, because of, quote, vendor transactions that involved undisclosed conflicts of interest. So fired for cause. Let's get more insight now from Bloomberg's Shelley Banjo. So, Shelley, it's surprising to see any CEO get sacked. This is made more interesting by the fact that Ashley Buchanan just joined Kohl's a couple of months ago.
Yeah, just a couple months into his tenure here. We're seeing a lot of detail from this board investigation, talking about how he pushed the company to do business with this vendor that he had a personal relationship with. We don't yet know this nature of the personal relationship, but that he directed multi-million dollars of business to the vendor.
It's a really tough time for Kohl's to go through this. The stock has already been down 50% this year. What are the challenges the company is navigating as it looks for a new permanent replacement?
Yeah, I mean, the company replaced its CEO because they weren't doing very well. And then as soon as the Ashley Buchanan took over, they decided to cut 10% of their corporate staff. Sales are already low. You're trying to do a turnaround right as the economy is starting to crater. Consumer demand is going down. The macroeconomic environment is clearly terrible. So it is not good news for this company, but the stock, of course, went up because I think it shows the board, you know, seeing something, saying something, doing something about it.
It moved quickly.
Yeah, moved quickly, and as Katie points out, 12 straight quarters of revenue declines. Clearly, they had to bring in somebody. They thought this guy was the superstar, obviously, because they paid him $20 million for this year. He's going to lose some of that money.
Yeah, I mean, I haven't quite looked at if they've disclosed yet if how much he's going to lose or if they've come out with that yet. But yeah, I mean, might be the shortest tenure of anyone ever. I'm going to have to check.
He's the Liz Truss of retail CEOs.
Exactly.
Yeah, so, I mean, as we keep talking about, you just think about the retail landscape overall right now. Kohl's, it seems like, has some pretty idiosyncratic issues, to put it mildly, but give us a lay of the land. When you think about the overall landscape, obviously, I have to imagine every C-suite right now is trying to figure out tariffs.
Yeah, I mean, we've had a really early read into earnings so far this season. Every single company has talked about the macroeconomic environment, some saying a bigger impact, some saying a lesser impact, but you're seeing McDonald's today, we saw JetBlue, we're seeing GM, all these companies saying the consumer backdrop is bad. People are starting to spend less, prices are going up. This is going to get even worse, and we're going to have some more data on jobs coming up to see how that's going to translate. So it's not a great time for you to be losing your CEO. I will say they immediately named their interim board member, Michael Bender, to step in. He has a long track record of retail history. He has had a number of jobs in retail, and so, you know, maybe they'll pull it out. Let's see.
We will see. And it's really interesting because even though you have Kohl's down that much this year, you actually have others. TJX, Walmart, actually up on the year. So a lot of catch up to do there. Shelley Banjo, Bloomberg Managing Editor for Global Business. We're watching some more movers on our radar as well. We've been talking about it this morning. Tesla denying a report about a CEO search to replace Elon Musk. You do have Tesla on the rise, about 0.8% this morning. NVIDIA more so, 4.2%, 3%. Interesting moves, of course. They are looking for some reprieve from the White House, but also you have the big tech companies doing well. Qualcomm, though, down 8%, more than that. They're offering a tepid forecast. We are knee deep in it, guys. It is the busiest day of earnings season today.
That's right. It's all about tech earnings today, and we're up another 1%. So 8 days in a row of gains if we hold through the end of this Thursday. Coming up in the next hour, Morgan Stanley's Sarah Wolf, the CEO of Robinhood, Vlad Tenev, and the CEO of Mizuho USA on the LPGA.
we're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Michael Wallace. The White House is touting the new minerals deal the U.S. and Ukraine have signed. Press Secretary Caroline Leavitt.
This partnership represents the United States taking an economic stake in securing a free, peaceful, and sovereign future for Ukraine.
More from CBS's Remy Inocencio.
From Ukraine's position, the hope is that this agreement, which ultimately is economic, will mean that the U.S. will be more inclined to protect its interests that it could now invest in. Basically, that Washington will want to keep its money safe and will keep defending against Russia's invasion like under the Biden administration.
Democrats blame President Trump's tariffs for the economy contracting during the first quarter. Trump blames a hangover from the Biden administration. More from CBS's Weijia Jiang.
Senate Republicans narrowly voted down a Democratic resolution Wednesday aimed at blocking Trump's tariffs. Tomorrow, another key number will add to the overall economic picture. That's when the jobs report for April is released.
This morning, we learned first-time jobless claims jumped by 18,000 last week to their highest level in 2 months. This May Day will feature anti-Trump protests across the country. CUNY law professor Shamtoli Huck.
In terms of working conditions, American workers are worse off. I think most workers today do not have guaranteed pension, health insurance.
Many of the protests will also focus on immigrants' rights. There are more flood warnings for Oklahoma today after some areas got 12 inches of rain this week. Robin Sweden is assessing the damage at her Lexington home.
I can't believe this. It's terrible. I've never seen it like this. I want to cry, because of my car.
At least 2 people have drowned in the floodwaters. That storm system is drenching the Mississippi Valley today. No need to flash your ID or phone anymore. CBS's Jim Krasula explains.
Sam Altman's iris scanning identity verification venture is here. Altman, who is CEO of OpenAI, is opening 6 flagship stores in the U.S. today where people can sign up to have their eyeballs scanned. It's a global identity verification system that creates and stores a unique, quote, iris code for people that's intended to fight against fraud and bots.
During the Cubs-Pirates game in Pittsburgh last night, a fan fell 21 feet from the right field bleachers onto the warning track.
Pirates manager Derek Shelton.
Even though it's, 350 feet away or whatever it is, I mean, the fact of how it went down, and it's extremely unfortunate. I mean, that's an understatement.
The man is in critical condition. The game was delayed for 10 minutes as he was treated and then carted off the field. Stocks have opened higher. This is CBS News. A company town formed by the world's richest man may soon become an official city.
A vote is set for Saturday to turn the South Texas home of Elon Musk's SpaceX rocket company into an official city known as Starbase.
Ignition.
Approval is likely. Most of the eligible voters are SpaceX workers. In fact, 200 of 283 eligible voters have already cast ballots. Opponents say this gives Musk and his company too much power in the coastal area, with control over access to popular swimming and camping areas known for generations as the Poor People's Beach. Those beaches have been closed at times for rocket launches. Steve Kathan, CBS News.
The cybersecurity firm Hive Systems has timed how long it takes the average hacker to crack passwords. If it's only 4 characters long, it takes less than a second. A 12-character password with numbers and symbols, 3 billion years. Michael Wallace, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube, so head over there. You can check us out there, Bloomberg Podcast Live, and that's where you'll find us. We got some economic data out here today. I want to get right to that. ISM Manufacturing, 48.7. The consensus was 47.9, so a little bit better. But remember, last period was 49, so continuing to trend down. We want to get the details of that because this is a big economic indicator as it relates to the Fed. Timothy Fiore joins us. He's the chairman of the Manufacturing Business Survey at the Institute for Supply Management. Hey, Tim, what do you make of kind of what we're seeing coming out of the manufacturing part of the U.S. economy?
Yeah, so good morning, Paul. So, this is our 6th report since we had a change in administration, at least the election. First couple of reports were very positive, optimistic. The last 3 months have seen a gradual decline. So let's talk about demand first. Demand is 33 months into contraction, declining new order receipts. That's not good. But most importantly, in the month of April, we had new export orders sag below at about 43. So our international partners, whether it be Canada, Mexico, or Europe, are reducing the amount of orders that they're placing with us, probably because of counter tariffs and other strife. But the most important thing in this report is that our production number, which is a really good surrogate for revenue, has sagged to below 45. Any of the major indexes, new orders, production, employment that are under 45 are a huge warning. And we're sitting here at 44 now on the production number after last month being 48, the month before that being 50 and some change. So we're headed in the wrong direction. We're still continuing to release people because of that reduced factory output. And I'm not really sure where this is going because there's no real sign of improved demand on the near-term horizon.
Do you get a sense from the manufacturers that if all of a sudden the tariffs were reversed today, that demand would come rushing in, or is the stagnancy of all of this here to stay a bit?
I think it's the unsurety now, Alex. I think even if this thing lifted right away, there'd be a pause. But I don't think we're going to get any clarity here until after the summertime. This may go on throughout the rest of the year. And clarity means firm commitment, we're committed and moving, not just words. So, we're now at the tail end of this. Lots of words, lots of lack of movement, and here we are. We're destaffing people. Our output is down. Our billings will be down. You've heard it in some of the earnings reports, but that was the end of March. This is April. Our prices index is still very high, although that's really only carryover from the steel and aluminum tariffs that started to be seen back in February. So as this thing develops, continues with this whole reciprocal tariffs and things, you can see that prices number going up. So we got demand sagging, we got prices going up. Not a good combination. And, my biggest concern here is when revenue starts to erode, then all kinds of crazy stuff happens. And we may be sitting on the cusp of that. Hopefully not.
All right, Tim, thanks so much for joining us. Tim Fury, chairman of the Manufacturing Business Survey at the Institute for Supply Management. Again, just another data point here with ISM manufacturing coming in well below 50, as it's been for a while, but getting a little bit weaker, as Tim was saying, in the new orders. The weaker than expected new orders is really the concern there, so we'll stay on top of that news. Right now, let's kick things off, get a reset of this market here, and we'll check in with Lisa Mateo for Bloomberg.
Yeah, we want to start with this news just coming in. The headline coming across: South Korea's Finance Minister Choi has resigned after an impeachment move. We will definitely keep you updated on this as more information does come in. In our neck of the woods, stocks are higher. This is on the back of stronger than expected tech earnings yesterday from Microsoft and Meta. Right now, Microsoft up 8%. We have Meta up about 4%. Apple and Amazon post their results later today. Ahead of it, we have some news around both companies. For Apple, it's a judge ruling that it has to stop charging commissions on non-App Store purchases. Apple shares are down about 1%. Then as far as Amazon is concerned, it plans to spend more than $4 billion by 2026 to expand its rural delivery network in the U.S. Amazon shares are up about 1.5%. So we go to the NASDAQ, up 1.5%. The S&P 500 up 0.8%. The Dow up 0.5%. The two-year yield 3.59%. That's little change, and the yield on the 10-year 4.18%, and that is up about 2 basis points. You mentioned ISM data. Just want to point out jobless claims jumped to the highest level since February. Initial claims increased 18,000 to 241,000 last week. It comes ahead of tomorrow's jobs report. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. S&P still up 0.8%. What I can tell you is earnings seem to be trumping eco that we got today. Let's take a look at some of those stocks on the move. We are joined now by Bloomberg's Denitsa Sekova. All right, let's kick it off with Meta. Big tech delivered so far.
Big tech delivered amid very high macro uncertainty. We're seeing what's happening with the data. Meta's shares jumped as much as 8% earlier. Still, the company, despite the macro uncertainties, up more than 4% year to date. This, of course, comes on the back of very strong earnings reports, and particularly advertising sales, something that everyone has been looking at. Of course, the advertising business is very important for Meta. It makes up 98% of the company revenue. The company is obviously really increasing artificial intelligence spending, and of course this is where the advertising business becomes so important because it's the way to fund it. The company reported 42.3 billion in first quarter sales. This is about 1 billion higher than what the street was expecting. We also had good guidance, which has been the deal breaker. Of course, this earnings season, current quarter revenue will be in line with analyst expectations, and we have Mark Zuckerberg saying that the company is well positioned to navigate the macro uncertainty. So very good earnings reports, strong guidance, and a good day for the company. Still has small loss year to date, but definitely much needed relief today.
And so Meta had good numbers. Microsoft had good numbers.
Yeah.
$3 trillion market cap company. Stocks up 9%. That is crazy. Incredible. Shareholder wealth being created. What else you got?
We have Eli Lilly. The news here are not so good. The shares dropped in morning trading as much as 8%. We have a combination of not so good earnings report. Actually, Bloomberg Intelligence had a very good way to say it. Basically, the earnings report, which is not worth paying a premium. So that was a really good way to put it. Of course, we have the news from CVS Health planning to distribute Wegovy, which is obviously the rival of Eli Lilly. So that combined with the earnings report puts a lot of pressure on the stock. From the earnings report, the drug maker cut its full year's earnings outlook. And again, the guidance is where investors have clearly been very worried. It also cut the 2025 adjusted earning outlook. The stock had a super strong start of the year. Now it's still up about 6-7%, but we've had a very tough week for Eli Lilly. So clearly investors are getting worried about those more high-flying stocks that have very high multiples.
All right, real quick, let's kiss off Kohl's. Get it? Kiss?
Yeah. Oh yeah, we're
We're
having some breaking news there. Kohl's fired its CEO after the board found that he directed the company to do millions of dollars of business with someone he had personal relationship with. Interestingly, that reaction is positive. The stock rose as much as 8% in earlier trading. The company said it's starting to search to find a permanent replacement, so we're yet to see. Of course, this is abrupt change for a company that has struggled for years. It has posted 12 straight quarters of revenue declines, and it's down about 50% years to date.
All right, Denitsa, thanks a lot. Really appreciate it. Denitsa Sakova joining us. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Microsoft off the highs here, but holding on, up about 8.6%. This is the best post-earnings performance since April of 2015.
Nice.
How's that stat for you? Ed Ludlow is in studio with us. He is co-host of Bloomberg Technology. I do want to point out that hedge funds are really short this name, according to certain firms. Yes, going into the quarter. So is this like fundamental buying? Is this short covering? Like what can we really latch onto here?
I think what's really beautiful, that's a funny word, but beautiful about this technology earnings season is that tech companies are complicated. They do lots of things. But if you simplify the story to, is the thing that's most important, did they do it well? In Microsoft's case, cloud growth. It's not just that cloud growth was 33%. That's 4 percentage points beyond the street.
So, wait a second. Azure cloud growth was 33% revenue?
Yes, top line
growth. Yeah,
and so of course it's a higher margin business, cloud computing. But it's not just that. It's that's where the cash cow is, the money. So we always talk about AI, the capital expenditure commitment for data centers that power the AI. That was still there, but the street wants to have it both ways, right? And so they say, oh, your core businesses are quite good, and get this, there's evidence that AI helped you. Terrific. Keep going. Yeah.
Are we going to hear the same thing then from Amazon?
Exactly,
because AWS leads in this business so far.
Amazon.com is an e-commerce business. Everyone listening to me say that knows that. But the majority of operating income for Amazon comes from AWS. It's cloud computing business. It's the #1 in that market. And exactly the same, we micro-focus on the capital expenditures and commitment to build more data centers to power AI. Is that the story? Is their core business, Amazon.com, and AWS top-line growth and advertising good? And if so, great, carry on with your capital expenditures commitment and we'll all be happy. Now, of course, there's the political tariff stuff in the background, and there's tariff impact to how Amazon.com functions as a business, and they'll talk about that because it's news and people as consumers care. But AWS operating income, stick to the basics.
Well, tonight we're going to get Apple as well. They do not necessarily have that similar AI story or cloud story, perhaps, that Amazon has, and some of the others have. What are you looking for from Apple?
Really simple about the long-term supply chain story.
Okay.
Is that simple? Because are we going to get something clear from them?
No, it's not simple. But, I think I heard Bloomberg's Mark Gurman, who frankly is the world's leading correspondent covering Apple, right, say that he's not interested in the quarter-gone numbers at all. I would say I take a slightly different approach, that Apple is the master of profit management and bottom line, irrespective of macro conditions. Tim Cook infamously says periodically, I am not an economist, but, and then we'll go on to tell us about the world. Apple makes most of the iPhone in China. iPhone is the single most important story. Increasingly, they're built in India. How do those proportions change and over what period of time? Of course, there will be tariff impact to margin, of course. But how do they manage it? Because their track record in managing the bottom line, as I say, is astonishingly good.
It really is. It's just amazing. So we'll get, again, some more tech earnings after the close. We like what we saw so far last night from Meta and Microsoft. pushing the NASDAQ up 1.7%. Ed Ludlow, thank you so much. We appreciate it. Ed Ludlow, Bloomberg Technology co-host, joining us live here in our Bloomberg Interactive Broker Studio. We finally got him out of California. He's never going back
For
to
like
England.
48 hours,
But he's
though.
never going back to England. I gotta call his mom and dad and say, it ain't happening in the family. I mean, he's a Californian.
No, he's
dude.
hardcore now. He just had a kid. He's never moving again.
Yeah, exactly. Who wants to do all that?
Yeah.
All right, we got a red headline just across the Bloomberg terminal. Third Point owns a, quote, meaningful stake in U.S. Steel. That's according to Reuters, so we'll have more reporting on that coming up. Again, the S&P is up just over 1% here, about 60 points. The Dow's up 280 points, and the NASDAQ's up 310 points. That's 1.8%. Coming up, David Welch, Bloomberg Detroit Bureau Chief, GM, lowering guidance. This is
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Will U.S. initial jobless claims exceed 260,000 for the week ending May 10th, 2025? The yes recently at 8%. Trade your prediction with IBKR Forecast Trader at IBKR.com/forecast. The last trading day for this contract, May 14th. All right, we've got the NASDAQ leading the charge this morning. This is on the back of stronger than expected tech earnings yesterday from Microsoft and Meta. Right now, we have the NASDAQ up more than 1.5%, 328 points. The S&P 500 up more than 1%, 61 points. And the Dow up 0.6%, 281 points. The two-year yield, 3.61%. That's up 1 basis point. The yield on the 10-year, 4.19%. That's up 3 basis points. To commodities, I have to point out Brent crude up about 0.5%, $61 a barrel. WTI crude, $58 a barrel. The Bloomberg Dollar Spot Index up about 0.3%. And over to Bitcoin, it's up about 2% at just over 96,000. Shares of CVS Health are up nearly 7%. This is after its Caremark division. It partners with Novo Nordisk to make Wegovy more available to its members. So that has shares of Novo Nordisk up about 2%, but it's a big hit to Eli Lilly and its Zepbound because that was moved off the company's list of preferred drugs. Its shares are down this morning nearly 7%. And that's despite first quarter revenue meeting estimates. McDonald's having issues luring customers into its locations. Its shares are down 1% after its sales fell in the first quarter. And finally, shares of Qualcomm. They're the biggest maker of chips that run smartphones, down 8%. They delivered a revenue forecast that was below estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. All right, so 2 days later, we finally get GM's conference call slashing guidance with up to $5 billion hit from tariffs. Joining us now, David Welch, Bloomberg Detroit Bureau Chief. David, I thought that these offsets that were announced on Monday or Tuesday, I forget, my time has no meaning, were supposed to help this part from the administration.
They did. I mean, some analysts had the hit to General Motors from tariffs being as high as $10 billion.
Wow.
So it did help some, but you still have a 25% tariff on imported vehicles. This does help offset some of the parts tariffs. And I think what GM's hoping for here is that eventually the Trump administration gets trade deals with South Korea, for example, and something new with USMCA, because that's where GM's really taking a big hit here are those countries in terms of where they get imported vehicles from. And so it's $4 to $5 billion. $2 billion of that is from the vehicles they import, and the rest is parts. So if the auto industry wants to escape a heavy hit from tariffs, there's still a lot more to be done in terms of either resourcing parts or getting some new trade deals.
So, David, is the expectation this kind of a worst case scenario, or is the company positioning that as, hey, this is kind of what we know and this is kind of our best guess?
It's what they know based on the structure of the tariffs right now. So if, let's say, next week, the Trump administration cut a deal to lower tariffs with South Korea, GM gets a couple 100,000 vehicles, all entry-level models, from its factories in Korea. That would lower this burden. If they got something that would reduce the tariffs on the non-U.S. parts in vehicles GM makes in Canada and Mexico, that would also give them some relief. But right now, those are the so-called fentanyl tariffs with Canada and Mexico. Those are still hanging out there. Those are still in force here. So they would need something that would either lower that or get rid of those to really get this burden down, unless they start relocating vehicles and doing things like that.
Hey, David, earlier, the Wall Street Journal reporting that the board at Tesla may have started efforts to take a look at a search for a new chief executive officer to succeed Elon Musk. What's your take on that?
The company denied it. I always wonder about these things when there's a story written with conviction and then a denial with conviction. You do wonder if maybe some people on the board started talking to other executives or executive search firms out there to get some ideas, but it wasn't maybe an official board search. That's me speculating. But look, Elon Musk has a lot of interest here, and this has always been an issue with Tesla shareholders.
Yep.
And this is well before he was in the Trump administration and politically active with Doge. He had the Boring Company, of course, has SpaceX. Then he got Twitter, now X, and he's got Tesla. And then you add into it a big government role, and this is somebody who has a lot of different things going on. And when Tesla starts to struggle shareholders, and the board has to do its fiduciary duty if shareholders are asking questions. Maybe they're asking questions about when this guy is going to come back in the chair, and if he's not, then they need someone who's going to really take a look at getting their sales turned around.
If Elon Musk goes back, as it looks like he will, to Tesla, does all the problem just go away?
No, it doesn't. I mean, Tesla's got some real issues here. The product line's very stale, right? Most of these vehicles, the Model S goes back 12 years, and the other vehicles in the lineup, with the exception of Cybertruck, all kind of carry the same basic styling on the exterior, right? So nothing looks fresh. The Cybertruck is obviously very fresh and different, but it's a niche product. It's an expensive pickup truck that a lot of people think is pretty weird looking. So this is a company with stale product, a lot of new competition from the Korean automakers in the U.S., from General Motors, heavy competition in China. European automakers, especially on the high end, have a lot of new EVs in Europe. So they don't have an oligopoly like they did 5 years ago, and they just haven't freshened up the product line. And then there's the AI and the autonomy strategy of Tesla's. I think that's going to take a while. It took Waymo a very long time of testing vehicles on public roads to actually launch a service. Tesla hasn't done any of that yet. So you're looking at turning around a product line that's pretty stale in the face of tough competition, and you're looking at going from an announcement last year on autonomous vehicles to robo-taxis on the road, which took Waymo about at least a decade. These are things that are difficult to do, and getting an active CEO back in the chair helps, but it's still a lot of heavy lifting to get those initiatives going.
All right, David, thank you so much. Appreciate it. A lot going on in the world of the automobile. David Welch, Bloomberg Detroit Bureau Chief. What's the word we're hearing coming out of most corporate executives on their conference calls? I think it's uncertainty. I don't care what business you're in, you're operating in a world with a lot of uncertainty. A lot of folks, a lot of CEOs, a lot of folks in the C-suite are looking for maybe a little bit of guidance, maybe a sounding board, and I think that's kind of where our next guest comes in. David Garfield, co-CEO of Alex Partners, joining us via Zoom from Chicago, one of my all-time favorite towns. David, thanks so much for joining us here. What are the conversations you're having with your executive clients in the C-suite, about tariffs, about economic uncertainty? What are the conversations you're having?
Well, CEOs are clearly dealing with huge amounts of uncertainty and upheaval related to tariffs. They're trying to make the best decisions that they can, despite the changes that are taking place. So what we're hearing and what we're helping CEOs with is identifying what are the critical things that they can and should do to mitigate some of the impacts of the tariffs and trade war now.
So especially when companies come out and report, there's only so many ways and times you can say uncertainty, right? Like, we all know it's uncertainty. We all want uncertainty resolved. How are you advising them to talk about uncertainty, but with like material facts, basically?
So the big thing that we're advising is to focus on the things that are controllable. So there are certain things that are outside of an executive's control, but there are a lot of things that companies can do, not to eliminate the impact of tariffs, but to mitigate the impact of tariffs. For example, one big thing that we're doing is helping companies to set up tariff war rooms. So virtual or physical spaces where key executives can come together and make critical decisions about how to steer the company through current market conditions and how to take concrete actions. For example, if you have the right types of supply sources and contracts, to some degree, companies can tariff shop. In other words, they can shift the mix of goods that they source from different jurisdictions to try to reduce the impact of tariffs. But there are things that companies can do beyond that help to offset some of the impact. For example, operational offsets. So there are things that companies can do with the domestic portions of their operations that help to reduce cost and expand margin and cushion the blow of tariffs. And then there are things that they can do on the commercial front of their business. For example, sharpening their competitive pricing. So really understanding competitors' positions, their shares, their price sensitivities, and taking the right actions to know how much of a tariff's impact to pass along to their customers and how much to absorb in order to take share or differentiate themselves in the market.
So, David, I think what we're hearing a lot more on conference calls this quarter is companies kind of stepping back from some capital commitments, whether that's, investment in CapEx, in maybe M&A, things like that, maybe just sitting on their hands and seeing how this thing's going to play out. What's your advice to some of your C-suite clients that are expressing that kind of process?
Our advice is certainly to be thoughtful about long-term capital commitments, but to take action now on the things that they can do with their existing footprint of manufacturing and distribution, and in the case of retail, their storefronts. For example, right now, companies can and should be pressure testing their cash flow, pressure testing their balance sheet, and also pressure testing their compliance. Are they able to track and trace all of the changes in tariffs and other regulations and how they impact their financial statements? So those are things that businesses can be doing right now to build some resiliency, even as they consider longer-term strategies and CapEx.
Before we let you go, I was wondering, in terms of CapEx, do you get the feeling that the CapEx is on hold for a long time? Or do you get the feeling that if all of a sudden there's a headline that reverses something, that CapEx will be put to work more quickly?
Well, I think executives are careful not to whipsaw their capital expenditure programs. To build a brand new manufacturing plant takes anywhere from 3 to as many as 10 years, depending on the industry and the amount of investment required. So clearly that's not a decision, and it's not a flow of financing that can be turned on and off and on again on a weekly or a daily basis. But it doesn't mean that businesses are stopping all of their investment. It means that they're being very choiceful and making investments where it matters. For example, continuing to invest in technology, AI and automation to drive productivity in their existing assets is a smart capital expenditure to make now.
All right, David, thanks a lot. Really appreciate it. David Garfield, co-CEO at Alex Partners. I know he's advising global CEOs on how to shift their business. And it's all about kind of cutting those expenses. We've been hearing that from different CEOs. Manage what you can control. All right, coming up, we're going to hit the pharma sector here. Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals, will join us on Moderna and Eli Lilly earnings. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, the major indexes close to erasing losses from tariff worries that hit the markets just weeks ago. We'll start with the Nasdaq, up more than 2%, 398 points. The S&P 500 up more than 1%, 76 points. And the Dow up 0.8%, 337 points. The two-year yield, 3.64%. That's up 3 basis points. The yield on the 10-year, 4.20%, and that's up 4 basis points. To commodities, we have Brent crude up more than 1%, $61 a barrel. WTI crude at $58 a barrel. We have spot gold down nearly 2% at $3,228 an ounce. The Bloomberg Dollar Spot Index up about 0.4%. And we have Bitcoin up more than 2% at just over 96,000. Since we're talking crypto, Morgan Stanley actually working on a plan to add cryptocurrency trading to its E-Trade platform. Other companies making news. The board at Kohl's let go of its CEO Ashley Buchanan for violating company policy. It's named Chairman Michael Bender as an interim CEO. Now, after halting trading earlier this morning, its shares right now are up about 7%. General Motors lowered its full-year profit outlook just 2 days after suspending its earning guidance, saying tariffs could cost up to $5 billion. GM shares up about 1.5%. And Harley-Davidson, they withdrew its 2025 outlook over tariff worries. Shares are up about nearly 5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
Thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. One stock to watch here is Eli Lilly, down still about 6%. That's after CVS announced a plan to drop Lilly's weight loss drug Zepbound. This obviously makes its rival Wegovy much more widely available. The company also cut its full-year outlook for earnings this year, citing R&D. Well, we are blessed that we have Sam Fazeli in the studio. This was a surprise, totally made my morning. Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. What did you make of CVS dropping a Zepbound?
Yeah, so Alex, thanks for the very nice words, by the way.
Always.
These things happen all the time. When the products are introduced over in the early days of their introduction, some cover it, some don't cover it. And then you start getting formulary fights. So CVS will cover it now, starting from the 1st of July, I think. And then it might change in a year or two. And they'll go for it's all in the pricing negotiations. What's interesting is that it's a signal that the price, I don't want to call it war, but that the price game has started. It always starts. It started when these drugs were being used for diabetes, then on the insulins, and these companies keep vying for formulary position. And in this case, Novo has won. But I don't think it's something that we can say is not going to reverse, or then Lilly won't announce something that's they've won. So, but prices are going down.
Alex, I noticed that January and February, we never see Fazeli. He's not, but as soon as the weather turns nice, boom, he pops up.
Really? With these allergies?
Exactly. So what is the story at Eli Lilly? The stock's still up 9% year to date. It's always been just kind of, in my mind, the prototypical big pharma. What's the investment story behind Lilly these days?
So Lilly's got more than obesity, but obesity is the biggest game, right? They have a whole bunch of cancer drugs. They've got some interesting drugs for Alzheimer's. They really want to solve the Alzheimer's problem.
But obesity is not a bigger market than cancer, is it?
Well, obesity is one big market. Cancer is lots of, then added up gets to a big market. So, and all important, right? The thing that Lilly has got going for it is that it's got this breadth. And maybe they'll be able to get to Alzheimer's at an earlier stage of disease than anybody else has so far. We'll wait and see. The problem today is they reported they didn't raise guidance.
Okay.
And why would you? It's Q1. You've got double-barreled gun pointing at you, possibly with tariffs. Why would any sensible pharma company, or any company, frankly, unless they're not affected by tariffs at all, stick their head above the parapet? So I think that's what's a bit more of an issue here. It's not the CVS. Well, CVS is a contributor, but it's not the only thing.
So explain to me tariffs and drugs. How does that work? Don't drugs come manufactured everywhere around the world? I mean, it's not just a U.S. thing, or it's manufactured everywhere, right?
Also, how easy to change that manufacturing?
Yeah, it's not. It's not very easy. But a country close to your heart is a major producer of. Yeah, there you go. A major producer of pharmaceuticals. And what the pharma companies do is they manufacture there. pay their tax there, and then they put the price up 4 times, 5x, 6x, and transfer it to the US subsidiary. And the US subsidiary doesn't make as much profit. So that's what's been going on. And one of the things that the administration wants is to bring that, that manufacturing back to the US. But it's not every drug. It's not all the drugs. You know, it's 24% of pharma imports globally for the US are from Ireland. So it's substantial.
That's all. Okay.
It's a lot of money. But at the end of the day, there's a lot of manufacturing here. They have capacity. They can switch. It takes time, though, right? And I think a lot of this started during the pandemic when they were trying to reduce supply chain risks and shocks. So,
what else have you noticed as we've had pharmaceutical industry start to roll out earnings?
Yeah, so nobody commented on tariffs. They all said, you know, we think there are better ways of dealing with this issue than tariffs. And I think they're right. Drop the tax here and people will bring their manufacturing here because they won't have that advantage anymore. It would take time. They're all giving out numbers about how much they're investing in manufacturing. I don't know how much of that is actual difference, actual new increase. And then, of course, the conversation about M&A and you know, the capital expenditure in terms of getting new products in, that's still happening. And, you know, there's a bit of M&A going on with the biotech sector, but not that much. But that's generally the tone that we're getting. Nobody's suffering.
Is the expectation that, I mean, again, I always joke, next life I'm going to come back as a healthcare M&A banker because every Monday there's a huge deal on the tape. Is the expectation that this administration will be more open to consolidation in healthcare or not? Because I think there's a lot of people saying, I'm not sure that's necessarily the case.
Yeah, but so there's two types of companies. If you're talking two big companies getting together, I don't think there's much room left there for really creating much value, more of the actual value creation as an investor. And I don't think that there's so much overlap that I don't think the FTC will put up with it. Buying biotech companies of different sizes, that has slowed down a little bit because of the uncertainty in the markets and still the biotech companies' management's expectations, remembering what their share price used to be. But aside from that, the whole idea is that the FTC is supposed to be getting a little more amenable in general. So that should help M&A once uncertainty disappears.
All right, so let's switch gears here. Let's talk about something near and dear to my heart. Allergy season.
Yes. Oh, yeah.
So I've had shots for allergies for 10 years, and I feel like I am 1 foot in the grave right now. Why are allergies so bad right now? And do we not have the effective kind of medicine to manage these symptoms?
Well, if you're really, really bad, there is a drug that reduces that particular thing that is involved in an allergy, which is something called IgE. I don't know why it's happened, why humans react to allergens like this. It's not evolutionary useful.
There's not like a weird tree that just started sprouting this year?
No, I think it just depends on the season and the wind and the, you know, how. So, and also every year you're not exactly the same as the year before. And I'm not talking about getting older. I'm talking about you come into the year with slightly different history. You maybe had another infection at some point of something else. Who knows? So, but allergy is a tough one because you're not really, I mean, of course you're sick, but it's like vaccines going into healthy people, right? So you need to be really, really sick for somebody to think about, let's go and develop. But there are new products in development.
So what's this new drug you're talking about?
It's not that new. It's called, it just suppresses something called IgE. So, but it's really for, it's not cheap. It's not cheap. Okay. But also it's really for somebody who's really severe.
All right, important stuff. Back on the farm, what are you drinking these days?
Oh, I just came from Chicago and found a really nice restaurant. I don't know if I can name restaurants here. Yeah. And I mean, it's part of a group. It's called Avec.
Okay.
And loved going there twice because they have this eclectic wine list. And guess what happens on Tuesdays? 50% off.
What was that?
50% off across the wine list. There you go. Double take.
Oh, wait, okay. Now Paul's like, let me book that ticket. Let me book that seat. All right. Sam, so good to see you. Thank you so much. Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst. He also heads up all our Bloomberg Intelligence business coverage. Here is a headline for you from CBS. Apparently, National Security Advisor Mike Waltz will be stepping down.
Really? Okay.
So maybe this is the start of the ramifications of the signal security breach. This is according to CBS. National Security Advisor Mike Waltz to step down. All right, coming up, we will dissect Microsoft earnings with Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Thursday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. I want to get back to the breaking news with CBS saying the National Security Advisor, Mike Waltz, will be stepping down. That is according to reports from CBS. We will continue to follow that news as well.
All right, let's bring in Laura Davison. She is the Deputy Bureau Chief for Bloomberg News in Washington, D.C. She's got more on this story. Laura, I'm looking at some of the Bloomberg News reporting here. Waltz had come under fire in the weeks since he acknowledged inadvertently ending Atlantic editor Jeffrey Goldberg to a Signal chat group to discuss, set up to discuss pending attacks on Houthis. Is this the fallout here, Laura?
Yes, yeah. This is sort of a delayed fallout that we've seen, sort of in the immediate aftermath. Members of the administration, Trump himself, White House Chief of Staff Susie Wiles, came to his defense, saying that he would be staying on and that the president had full trust in Waltz. However, there had been sort of rumblings behind the scenes that perhaps Waltz's position was not secure. So now CBS reporting that both Waltz and his deputy, Alex Wong, will be out. The question is really sort of what changed in those intervening weeks. There's been a real concerted effort from Susie Wiles at the White House to keep this team together and to not start, having people be pushed out or fired or that would create some fissures in the ranks.
What do we think the spin will be from the White House?
That's an excellent question. We have not yet seen any initial reaction, but there's a couple ways that this could go in terms of, one, that, there was, essentially that this is sort of the direct fallout. Trump will almost certainly be asked about this when he speaks publicly later today, and will sort of indicate, he may even have a different narrative than what the official narrative is out of the White House. We've seen this multiple times that he says the aides are trying to spin it one way, but then Trump comes out and says, oh yeah, I ultimately wasn't happy with what we saw there. That all remains to be seen. This is just in its initial moments of breaking.
Hey, Laura, what do we know about, or what does this mean potentially for Secretary of Defense Pete Hegseth, who again was under some pressure because it was obviously him disclosing some of this information? Does this perhaps, at least for now, remove some of the pressure on him?
It potentially does if you have one person take the fall. It sort of relieves the pressure, the need to sort of make a change elsewhere. Hegseth has had, since then, come under additional scrutiny because of a second Signal chat group that involved his wife and his brother and other close contacts. Really not calling into question, how a journalist got added to the Signal chat, but sort of the appearance that there is a widespread Signal use and that Hegseth is spreading, sharing information in these chats that at least have the appearance or that could have been classified.
So the defense line has always been that there was no classified information. Is that now proven false, or are we still thinking that there was no classified information?
The sort of to the plain eye, pre-attack plans are almost always classified. Hegseth and Trump, do have the ability to declassify, some of this information, and the White House has maintained that this is, not classified information. Though, most experts who deal with national security say it's very clear on its face that is just a false statement.
Laura, how's the White House kind of reacting to some of the polling that shows President Trump's approval levels have declined pretty significantly? How are they kind of dealing with that?
Yeah, this has been sort of a blow that the White House has really pushed back on significantly. Polling has shown that that Americans broadly think that Trump has gone too far, whether that's on tariff policy, economic policy, even with DOGE and federal cuts. They're not seeing the results that he said there would be. Day one ending to some of these foreign conflicts. On immigration as well, that he's overplaying his hand. So this is how you see, even yesterday, Trump very viscerally, reacting publicly, saying that, this is Joe Biden's stock market, that his tariff policies, are not related to some of the weakness that we're seeing in economic data and in financial markets.
When we take a look at potential trade deals and how that's going to be framed, if we get a headline that says trade deal struck with China, trade deal struck with Japan, can you help us understand the difference between like a trade deal and a trade agreement or a memo of understanding? How are you guys thinking about that in DC?
This is almost certainly not going to be, what has traditionally been considered a trade deal, which are hashed out over many cases years. Very detailed, going through all the products affected. What the tariff rates are. This is very much likely to be sort of a concept of a plan or some sort of top line agreement that will almost certainly require additional talks. Even Bessent himself said a couple weeks ago that he expects a trade deal with China could be reached in 2 to 3 years, whereas the White House is talking about for these 60-some trade deals that they're working on negotiating. They want to get these done in the next couple weeks, which just the timing does not allow for those very detailed agreements. It's going to be some sort of agreement, top line understanding that will have to then be hashed out in the coming months.
Very good. Laura Davison, thank you so much for joining us on short notice. Laura Davison, Deputy Bureau Chief for Bloomberg News in Washington, D.C. Again, getting a reaction to National Security Advisor Mike Waltz to step down. That's according to CBS News. Bloomberg News reporting that, that Mr. Waltz has been under pressure from some of those disclosures of military plans against the Houthis via the chat app Signal.
Mm-hmm.
So, and that's been an issue, and apparently he was the person responsible for putting that journalist on that chat. So again, a little bit of fallout there. We'll keep you up to date on that with any upcoming reporting.
All right, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by ShipStation. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now with the NASDAQ flying higher, up 2.5%. The S&P not far behind, up 1.5%. And the Dow Jones Industrial Average up 0.9%. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday. Happy Friday Eve. Alex Steele here alongside Paul Sweeney. We have a great hour of Bloomberg Intelligence lined up for you. We're going to cover earnings from all the angles with our great, amazing experts at Bloomberg Intelligence. We're going to cover Microsoft. We're going to cover Kohl's. We're going to look ahead to Amazon and Apple. We got Anurag Rana, Bloomberg Intelligence, Mary Ross Gilbert, Bloomberg Intelligence, Michael Halen of Bloomberg Intelligence, and Madeleine Mecklenburg. She's Bloomberg Legal Texas reporter on our Big Take story talking about Tesla rockets and Elon Musk. So you definitely don't want to miss that. But let's kick it all off for you right now with a Bloomberg Business Flash. And for that, we go to Charlie Pellet.
All right. Thank you very much, Alex Steele. Happy Thursday. Again, let's recap, reset, developing story. President Trump's National Security Advisor, Michael Waltz, and one of his top deputies are resigning. That, according to CBS News. CBS reporting that Waltz and his deputy, Alex Wong, will be leaving their posts. The report citing several people familiar with the matter. Again, stay with Bloomberg for the latest on this developing story. The Dow, the S&P, NASDAQ all ripping higher right now. S&P up 78. That is a gain of 1.4%. The Dow up 337, up 0.8%. NASDAQ, though, as Alex mentioned, absolutely surging, up 2.4% right now, up 413 points. The NASDAQ Composite Index advancing again 2.4%. The NASDAQ 100 Index up 2%, and the Russell 2000 Index up by 1.3%. The Bloomberg Mag 7 Index after and before earnings, that index up now by 3.8%. Apple and Amazon both report after the close of trading today. Apple right now up 0.1%. Amazon up now by 3%. We've got the 10-year yielding 4.20% with the 2-year 3.64%. Gold down 2.1%, 32.19 the ounce on gold, while West Texas Intermediate crude still below 59 a barrel, 58.53 right now. WTI at up by about 0.5%. Brent, the global benchmark, 61.35 a barrel. U.S. manufacturing activity shrank in April by the most in 5 months as lean order books prompted the steepest output contraction since 2020. Tim Fiore is chairman of the Manufacturing Business Survey at the Institute for Supply Management, and he was a guest this morning right here on Bloomberg Intelligence.
The most important thing in this report is that our production number, which is a really good surrogate for revenue, has sagged to below 45. Any of the major indexes, new orders, production, employment that are under 45 are a huge warning. And we're sitting here at 44 now on the production number after last month being 48, the month before that being 50 and some change. So we're headed in the wrong direction.
ISM's Tim Fiore, a guest on Bloomberg Intelligence. GM cutting its full-year profit outlook, citing as much as $5 billion of exposure to auto tariffs. General Motors shares up by 0.9%. Also citing tariffs, Harley-Davidson withdrawing its 2025 outlook, citing a lack of clarity around U.S. trade policy and weakening economic conditions. HOG is the ticker on Harley. It is up now by 4.8%. So again, recapping the Dow, the S&P, NASDAQ, all advancing. Key earnings after the bell today, Apple and Amazon, Bloomberg Television and Radio. We got you covered on those coming up. Again, S&P up by 1.4%. And for on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. As always, Alex Steele, Paul Sweeney live with you in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Tom from the Upper East Side writes in and asks, I need a Bitcoin quote. Bitcoin up $2,300, that's 2.5%, rated at $97,000 per token. We're getting back to that 107,000 kind of level here. So
Tom's excited.
Yeah, that gets your attention here. All right, let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Norma Linda. Norma, what are you looking at?
Well, a super busy earnings day today, but I'm keeping an eye on Kohl's. Of course, this is the news that everyone's been really looking through, parsing through. The CEO was removed from the board, and the CEO will be stepping down. This is after the board found out that Ashley Buchanan, the CEO, was being pushed the company to enter into a multi-million-dollar consulting agreement where they found out that that same individual was also a part of the consulting team. And it was made clear that Mr. Buchanan did not disclose this relationship as was required under the company's code of ethics. So, of course, that's going to be a shakeup at Kohl's. And they did put in an interim CEO that they pulled from the board. So great for Kohl's in that scenario. But we are seeing shares of the company higher, up about 7% right now. So it seems as though Wall Street is happy that this is being cleared up here, but definitely a lot of uncertainty when you look at it on a broader landscape. I mean, we're seeing Kohl's shares down about 49% so far this year. So brutal year for the company thus far.
Yeah, talk about brutal. All right, let's go to Eli Lilly. That stock around the lows of the session, down about 8%. What happened here that's giving so much angst to investors?
So what's happening here with Eli Lilly is the CVS situation that's going on there. So CES said that it will be dropping Eli Lilly's weight loss drug Zepbound. They will then be turning toward Novo Nordisk's Wegovy drug instead. So, of course, this isn't great news for Eli Lilly to lose such a deal like that. We're seeing Eli Lilly shares down about 8% right now. But we are seeing Novo Nordisk shares up just a touch, about 0.5% right now. But we do think that, of course, this is some great news for Novo Nordisk to be getting this deal with CVS for a stock that's been down about 22% this year in comparison to Eli Lilly's 7% gain.
Microsoft. How about that one?
I mean, that's really been pushing indexes higher as we're seeing information technology, the best performing group in the S&P 500 today. Shares of Microsoft are up about 2%, but they were really hitting some highs. This is after its third quarter results beat expectations. Of course, we're in the midst of these tech earnings, and people are really looking to see there's a really high bar for these companies and whether or not they're actually able to meet them or surpass them. So here for Microsoft, the company's cloud business was seen as a highlight, and they're seeing that it continues to benefit from the demand in its AI services, which we know AI has been a hot topic.
Yep, 16 points AI contributed to Azure growth. That's up from 13 points the previous quarter.
Wow.
Like they are making money on that investment, period. All right, Nora, thanks a lot. Really appreciate Norma Linda joining us from Bloomberg News. And for more conversations like this, go ahead and listen to our Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or on anywhere you get your podcasts. All right, let's get more on Kohl's here. That stock readjusting after we saw the CEO being ousted from inappropriate behavior and a probe that uncovers personal ties to the vendor. Yep. But overall, like the stock's not done well, as Nora was saying. Mary Ross Gilbert's Bloomberg Intelligence senior equity analyst who covers retail for us. Hey, Mary, if we just take out this 10% pop on the CEO ouster, how is Kohl's actually doing?
So that's a good question, Alex. So really what's happening here, yes, we had the news that the CEO was ousted, but that's big news, right? Because now we have Michael Bender stepping in as CEO, and he's the fourth in under 3 years. But let's give you a little bit of a backdrop. Since 2021, when the company added Sephora shops to their stores, their revenues have fallen $2.2 billion. But in the meantime, Sephora added $1.8 billion. So that means that their revenues are down almost $5 billion away from beauty. So that kind of gives you the backdrop of what's happening operationally here. And with these different CEOs, nobody has seemed to find the formula how to get back to growth. The reason why the stock has popped today is really because they came out with their first quarter preliminary figures showing that their comp sales were down 4 to 4.3% when the company was guiding down 6% and consensus was at down 6.4%, and earnings were even higher. So what I mean by higher is from an operating income perspective, consensus was at $6 million, and they're guiding to somewhere around $40 million. So that's much better. And so from an EPS perspective, the loss is going to be about half of what analysts expected, and that's really the pop. And the good news here is that the company is rich in real estate. And so if you look at the potential value of the real estate holdings, which could be nearly $6 billion, and if you look at their stock and where it's trading and how it's valuing the business, that's under $5 billion. So that kind of gives you sort of a framework.
When you start going to the value of the real estate, then you know the business
that's never a good sign.
In trouble.
Yeah.
We did that with Macy's and the value of their air rights in Manhattan. That's not good. So, Mary, what is Kohl's saying? What are some of the retailers that you cover? What are they saying about tariffs, their ability to manage tariffs, how much they will take in their profit margin versus how much they'll try to pass along to consumers?
Paul, you're right. Tariffs is really a big issue, and there was no commentary regarding that, neither in this call and neither in their fourth quarter call. But we do know that roughly over 30% of their revenues, they directly import. So there is going to be a hit here or some sort of exposure. And we're still early in the earnings for the first quarter, because that's where we're going to really get an update. Because when these companies reported their fourth quarter earnings, we were talking about tariffs in that sort of 20% range. And now we're at 145 for China.
Yep.
So yeah, so we're going to learn more, obviously, when we get the call. But for now, there's not a lot of disclosure around it, but we do know there is an impact.
All right, Mary, thank you so much. We always appreciate getting your thoughts on the global retailers here. Mary Ross Gilbert, Bloomberg Intelligence Senior Equity Analyst. She covers the retail space. One of the big stories here today from an earnings perspective is Facebook. Some of the kids call it Meta, META. The stock's up 6% here today on some pretty solid numbers. And you want to talk about this company, there's really only a couple of folks you want to talk to. One of them is David Kirkpatrick, founder of Techomany in New York. And of course, he is the author of what I think remains the definitive book about Facebook in the early days of Facebook. It's called The Facebook Effect. It's a great book, highly recommended. Hey, David, what do you make of the numbers coming out of Meta these days?
Well, thanks, Paul. Thanks for your nice comments. Well, Meta really is a kind of bellwether, I think, for what's happening with the digital economy. And their numbers were quite surprisingly good, almost spectacular, you might say. I mean, they've been delivering very steadily for a long time. But I think that the most important thing that their numbers indicated, and the comments that Zuckerberg made yesterday indicated, are that, this very crazy, unpredictable economic environment we're in right now, which you were just discussing regarding retail, is not likely to affect these companies as much as some feared, at least in the near term. And that's really good news. There's a whole lot about AI and other stuff that we learned about what they're doing that was quite spectacular also.
Yeah, so let's get to that. So as you mentioned, the advertising business, which is 98% of the company's revenue, has continued to grow. So check that box. Let's get to the AI, because they unveiled a new standalone AI app called Meta AI. What is that? What's it going to do for me?
Well, thanks, Alex. Meta is one of the top players in AI. There's no question. and they are spending an extraordinary amount on this. I mean, they upped their capital expenditure estimate to up to 72 billion from a high of 65 billion, and that's like a huge percentage above last year, which was under 40 billion. So they're really, really cranking really hard on data center investment and AI. And what they want to do is they want to compete head-to-head with ChatGPT and all the other Claude, et cetera, all the other AIs that are directed particularly at consumers. And they have a unique advantage in doing that because they have this extraordinary, unique trove of data about all of us that they have been accumulating for decades, and they can use that in the training of the AI to customize and personalize the results they give to people in a way that could be a major competitive differentiator down the road. And of course, they'll use it in all the normal ways. You know, they bring it into a WhatsApp chat, et cetera. But they, I think, are extremely well positioned to become a very, very major force in especially consumer AI.
And Alex, you know, at cocktail parties, people often come up to me and say, hey, Paul, give me an example of AI. And the example I give is just what David explained here. So a lot of these advertising companies like Google and Facebook, they can really get to know who the consumer is better and better and better, and then charge more for the ads.
I mean,
and that's kind of what I think we're
right.
seeing.
Well, that's
here.
true too.
Yeah, I mean, it's also
they're customizing the ads using AI. That's a thing I didn't even mention. I'm talking about the results before, but the ads themselves will be far more accurately targeted, and they're already doing that tremendously often.
And isn't that just like free training because you have all the input from Instagram and Threads and Facebook and all that?
Absolutely. They have the best, one of the best training, maybe the best training corpus for consumer AI that anybody has. I mean, this is the thing that has differentiated Facebook and Meta from the beginning was the depth and volume of their data about individuals. It continues to get more and more rich, and they're figuring out new ways to mine it in the age of AI, and that is going to be a huge advantage.
Hey, Dave, you look at this stock chart since its IPO, the only thing that's ever derailed this stock has been the metaverse. What's the latest on that whole thing? How are they positioning it?
Well, they don't talk about it nearly as much as they did, but you know, I think what they're finding is that there may be an overlap between the metaverse and AI. And you know, they're one of the things that I'd say they got into because of their metaverse obsession is hardware, and they are now saying that their hardware business, their Ray-Ban AI glasses, their Quest gaming and other virtual reality headsets, those are going to be an incredible entree into the world of AI. And I think what we'll see is that they dovetail their work in metaverse, in immersive content, with their work in AI. I don't think we can exactly predict how that's going to happen, but certainly, you know, glasses that sort of look at the world around you and give you answers and information about everything you see, that's something we can all use, and it's starting to happen. And they would not be in that position had they not made that many, many tens of billions dollar investment in metaverse. Now, was that a good investment? I don't know. I don't think Zuckerberg would today say that metaverse is their future the way he did not very long ago. Clearly, AI is the future, but there will be an overlap.
Just some breaking news here for you. Apparently, the U.S. is now weighing easing NVIDIA chip curbs on the UAE. This comes as Trump is planning a visit to the region. Apparently, it's his first overseas trip aside from going to the Pope's funeral. Okay. So that is definitely quite interesting. NVIDIA and other tech companies have been pushing for this U.S. rule change, and President Trump is set to visit the UAE on a Gulf trip coming later this month. All right, David, we're going to leave it there. David Kirkpatrick joining us, one of the best. He literally wrote the book on Facebook, founder of Techonomy, helping us to break through Meta earnings. Here's my question. Oh, wow, went away. Look at that question. Well, NVIDIA. NVIDIA got a sell rating yesterday from Seagate.
Really?
Did you see that?
I did not see that.
Saying that AI is priced in and their customers are going to start making their own AI chip.
Interesting. The stock's up 5% today, so a good move here. And again, it seems like when you think about these tariffs, I think what we learned from the first Trump presidency to now is a very fluid situation. There's an announcement, then there's some negotiation, then there's some walk back, there's some change, and you're not really sure where you're going to end up. I just go back and look at kind of how everybody behaved back in the first Trump administration. Stock market did okay. I mean, it's just everything. It just relax.
Still, but the UAE is not China. And
I know.
It's I don't know.
I would suggest maybe those conversations are ongoing, and we'll see. But I tell you, it gives us something to talk about.
Oh, yeah. All right, coming up, we're going to talk more about the administration. Tyler Kendall is Bloomberg Television Washington correspondent on National Security Advisor Mike Waltz going to step down. This is, of course, according to CBS. And then Marcy McGregor joining us from a Bank of America private bank on her market outlook. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and repeating our earlier headline, the U.S. is weighing easing NVIDIA chip curbs on the UAE as President Trump plans a visit. NVIDIA shares, they're part of a broader tech rally today, up now by 5.5%. The other developing story that we continue to monitor, President Trump's national security advisor, Michael Waltz, and his deputy are stepping down. This, according to a report on CBS News, a stunning fall for one of President Trump's Trump's top aides. The Dow, the S&P, and NASDAQ all advancing now, with the S&P up 86. That is a gain of 1.5%. We have got the Dow Jones Industrial Average up 394, also up by 1%. NASDAQ, the composite index, is surging 2.6%. The NASDAQ 100 index up 2.2%, with the Russell 2000 index up now by 1.3%. 10-year 4.21%, with the 2-year currently yielding 3.66%. Gold is down 2.2%. Spot gold now at $32.17 the ounce. West Texas Intermediate crude oil up 0.7%, 58.60 for a barrel of WTI, and Bitcoin up 2.7%, 97,106 on Bitcoin. McDonald's U.S. sales fell 3.6% in the first quarter, mainly due to a decline in guest counts, marking the biggest drop in the chain's home market since 2020. McDonald's again down 0.5%, but other quick service restaurants, specifically burger joints, we've got Wendy's up by 0.8%, Shake Shack up 3.5%, and shares of Restaurant Brands International uses the ticker QSR. That is up now by about 0.8%. That, of course, the parent of Burger King and, yes, Tim Hortons. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on that YouTube thing. I think that's the internet. Go over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Well, certainly on the political front here, the story of the day just breaking within the last half hour. National Security Advisor Mike Waltz is to step down, according to CBS News, tied to the Signal issue. Some of the texts that were made public here. So we want to get the latest reporting. Unfortunately, we have great reporters following the story. Tyler Kendall from Bloomberg News joins us live here in our Bloomberg Interactive Broker studio. This seems like a pretty high-profile change at the top of the administration. What do we know so far about Mr. Watson stepping down?
Right, definitely high-profile, considering that President Trump really for weeks has said that he has backed Waltz, particularly after the fallout from this Signal group chat. Now, reports are saying that he's expected to leave today, as well as his deputy. And now we even have Politico reporting a potential name to replace him. That would be the special envoy, Steve Witkoff. And we have to keep in mind that there really has been this scrutiny on Waltz for really weeks at this point. We know there's currently an Inspector General report looking into how this Signal chat really came to be. And perhaps that might have ramped up some of the pressure here, since we know that that started on a bipartisan basis, that both sides of the aisle in Congress really did want some firmer answers when it comes to this. Now, Mike Waltz has long been a loyalist to President Trump, served 3 terms in Congress. I've interviewed him a few times on Capitol Hill in his capacity on the Foreign Affairs Committee, as well as Armed Services. He really has been a defender of President Trump's, and he's really led some of the big policy goals here, including his efforts on Ukraine. Mike Waltz was the one that went over to Saudi Arabia when the U.S. started those talks with Russia to really kick off those meetings. So he really has been at the forefront. So it will be a pretty big shakeup at the top for this White House as they try to move forward here with their foreign policy plans as we now enter 100 days.
What do you think the spin's going to be from the White House? They were really adamant that there was no national security breach here.
Right. I mean, at this point, President Trump had really been defending Mike Waltz. It said, I believe, that he learned his lesson, that he's, quote, a good man. That's really what he has been putting out here, because the Trump White House up to this point, there has been so much uncertainty with the other policies. They really are trying to show that unified front, particularly when it comes to ramping up its foreign policy, whether that be with Ukraine and Russia or restarting the talks when it comes to Iran. So we'll have to wait and see if we hear anything today. As of now, we haven't gotten any official readout from this White House, but they definitely will be wanting to show that unified front, and perhaps that is why we're seeing Steve Witkoff's name be floated, since he has been so integral in these conversations as well.
What does this mean for Secretary Hegseth? Does this perhaps reduce the pressure on him? Because I know he's come under, obviously, a lot of scrutiny.
Right. He also...
Or the opposite.
Yeah.
Right? Like, does it trickle down?
Yeah, maybe. I don't. So what do we know about Mr. Hegseth?
Perhaps, and actually that Inspector General's report, it's into the Pentagon. It really is looking at Pete Hegseth instead. Okay. So does this add added pressure? Remains to be seen. Of course, there had been other reports about potential misconduct when it did come to the secretary adding some family members, including his wife, to other Signal chats. There had been other additional reporting that really was ramping up the pressure. But at the same time, we are seeing this administration really push push forward with its plans to, as they say, streamline the bureaucracy, and they think that Secretary Hegseth has really taken a role in that, particularly at the Pentagon, canceling certain programs, rerouting funding to different initiatives, for just one example. So we'll have to see kind of what happens here and what sort of readout that we do get.
All right, Tyler, thank you so much for joining us. We appreciate your reporting. Tyler Kendall, Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Again, so the National Security Advisor, Michael Waltz, and one of his deputies stepping down, according to a report on CBS News. We'll have more reporting on that going forward. Let's get back to these markets. If Charlie Pella can say the markets are ripping, I can say the markets are ripping.
Just blame him, it's fine.
Yeah, exactly. S&P up 1.5%, the NASDAQ up 2.5%. Let's check in with the professional here, Marcy McGregor, head of portfolio strategy for the CIO at Merrill and Bank of America Private Bank. I like keeping the Merrill name because the Merrill name is one of the great names on global Wall Street. It makes the title really long. It makes the title really long, but I would have kept Merrill in the name. I worked at Merrill Lynch, so the Thundering Herd, all that kind of stuff. I tell you, when I worked at Merrill as a banker, I felt like we could get any deal. I don't care who I was competing against. I felt like we could beat them because that's how good I thought the Merrill folks were. So, Marcy, thanks so much for joining us here. Boy, volatility, I mean, if you like it, this is your kind of market, I guess. What kind of conversations are you having with your clients these days?
Yeah, I mean, we're trying to help our clients kind of navigate through what I think of almost as this dense fog of uncertainty, of course, on the policy front, on the macro front, and really trying to get our clients to take a step back, understand that being really well diversified, being really disciplined in a market that can probably continue to feel choppy from here is the most important thing we can do as investors. So I say, like, stay diversified, stay invested, really stick to our knitting here. This fog will lift and we'll be able to see through to the other side.
When you say diversify, everyone says that. What does diversify mean to you over there at Bank of America Merrill?
Yeah, when I think about our portfolio positioning right now, we do have a preference for equities over fixed income, and it's global equities. So we have a pretty significant strategic weighting, both to international developed equities and emerging markets. And then on the fixed income side, we're actually not taking huge positions on the fixed income side. We like to use fixed income as a diversifier, kind of as that ballast of the portfolio. And then, of course, for our clients that are qualified investors, alternative investments makes a lot of sense. Private markets makes a lot of sense in a well-diversified portfolio. And, of course, those big overarching themes. So, yes, we're in this moment of, I think peak uncertainty is behind us, fortunately, but we're in this moment of uncertainty about what the economy looks like going forward. But I think there's a lot of trends and themes that aren't changing, like the innovation in our economy, like investment in infrastructure, data centers, areas like that. I don't think those big picture trends are necessarily going to change because they're so long term.
Marcy, we've seen over the last, just here in 2025 and maybe late 24, kind of a move into international equities, maybe even fund flows, material fund flows out of the U.S. market into other parts of the world. How do you guys think about the U.S. versus non-U.S.?
Yeah, when I think about international markets, certainly a dollar coming off the way I think of it, like the eye-popping strength that we had seen recently. So we have this dollar that's moderating. Our view is that the dollar likely continues to moderate from here, really kind of lending some support to international markets. But what keeps me from getting outright bullish outside of the U.S. is we haven't seen the earnings come through. While the U.S. earnings picture expectations have clearly been trimmed over the last several weeks, we still think U.S. corporate earnings stay positive in terms of a growth rate through all of this uncertainty. So I need to see the green shoots on the earnings side to get me a lot more positive on international markets. But a dollar that is moderating, I think, will likely continue to help international from here, probably for the balance of this year. So the answer is I want to own both, but I do still have a preference for U.S. relative to the rest of the world.
What about other themes that we've seen? Like energy has just gotten crushed. Utilities were kind of rising with the AI play. They became a growth story, even though they're also considered a safe haven. What about those trends we were looking at like 8 months ago that now have kind of fallen out by the wayside?
Yeah, well, it's really interesting. If we rewind before April 2nd, this market weakness really started as a rotational correction away from kind of the most overvalued, expensive, magnificent 7 tech names. So our view had been it would be the other 493 that led the way for 2025. And that's still the case. I think it's going to be this broader market participation. We're talking to clients about playing defense and offense. So defense, as you mentioned, still looks like utilities, a way to kind of think about playing that defense just through the S&P 500. I also like dividend-paying stocks, especially in a world where we're wondering if the Fed will or won't cut as the economy shows signs of softening. I think dividend-paying stocks and dividend growers is going to be really interesting. When I think about energy as a sector, it's the only sector I think that's in negative territory in the most recent period for the index this year. I'm a little cautious on energy. I do think when I think about what else could come from Washington to provide a little bit of a cushion from growth, lower energy prices would be a boost to the consumer. We need the consumer to stay resilient here. So I would think about, so I'm less positive on energy. The area of the market that I think has the potential to continue to lead as we get to the other side of this uncertainty is financials. Financials are going to be insulated from some of this trade noise. As long as the consumer hangs in, and our base case is that the U.S. economy avoids a recession, I think that tees up financials, which have pretty strong internals, to once again emerge as market leadership. But to your point, artificial intelligence, innovation, none of those trends are going anywhere. So I think the investment cycle continues as we're in this kind of big picture arms race for technology and AI.
Marcy, my notes tell me that you're based in Savannah, Georgia. Please tell me that's not the case.
That is the case. That's where
how did you wrangle that?
He's just jealous.
Hugely jealous.
Well, if it makes you feel better, I'm in New York pretty regularly. But yeah, as I look out the window here, I am pretty.
I mean, that might be pound for pound the prettiest city in all of America. It is awesome.
Is it?
Down there? Yeah. And I mean, she went to Rutgers. Good. Yeah. But then she ends up in Savannah, Georgia for bank.
It's all jealousy.
It's all jealousy.
It's all jealousy.
Marcy, thank you so much for joining us. We'll have you back. We really appreciate getting some of your thoughts there. Marcy Gregor, she's head of portfolio strategy for the CIO at Merrill and Bank of America Private Bank from Savannah, Georgia.
I've never been to Savannah.
Oh, it is just awesome. It's a great long weekend trip.
I've heard
from
this.
New York.
Yeah,
it's good. It's highly recommend. S&P future, S&P the cash market. Hey,
there
we're open, kids. We're up 1.4% on the S&P. The Nasdaq's up 2.4%. The VIX right around 24 here, so still a little bit elevated on the VIX. We'll have more coming up. This is